Welcome to Traders Corner's Holiday Special Investors Summit. I'm Anthony Chapman, and we're thrilled to have you joining us today. We're right in the heart of the holiday season, and historically, this is one of the most exciting times in the market. Volatility has returned, opportunity is expanding, and many traders are watching closely to what could shape up to be a Santa Claus rally. Today, we've assembled an all-star panel of experts who will be sharing powerful, actionable strategies covering stocks, options, price action, and momentum to help you take advantage of this market environment and position yourself confidently for 2026. In the holiday spirit, each of our presenters has also put together a very generous holiday special offer, and after every session, I'll be posting the promotional link directly in the chat box. So let's get started. Our first presenter today is Melissa Armo of the Stock Swoosh. Melissa is known for her precise, disciplined approach to trading stocks that gap using a method she calls the golden gap. This system is designed to pinpoint institutional money in the market and identify high probability trades that often play out very early in the trading day, between 9:30 and 10 a.m. Eastern Time. Melissa will show you how trading just one carefully selected stock per day on the side of power money can create significant opportunity without spending all day in front of the screen. So please help me welcome the great Melissa Armo.
Thank you so much. Happy holidays, everyone. Let me know if you can see my slide. It's a white slide. Can you see it? Can you hear me? Do you have the questions set up for me to see the questions, Anthony?
They should be.
Okay.
I haven't seen anyone respond yet, so I don't know what's going on. People are sleeping in or something.
People need caffeine. They're gotta get moving here. Well, yes, we are rallying today. We gapped up today, but we had a huge sell-off yesterday. So for those of you that don't know what I do, I actually prefer to short. So we had a big day yesterday because the market fell off a planet, came all the way down to almost 600. And then we were up this morning on some economic data. But guess what? We have a lot of economic data out tomorrow too. So today and tomorrow could be a wild, wild trading period for the market. And again, 2025 was a very bullish year for the overall stock market. I will say that. So today I'm going to spend some time with you. We're going to talk about trading on the side of institutional money for success. Again, for those of you that don't know me, my name is Melissa Armo. I own my own company called the Stock Swoosh. I started trading in 2008, which feels like a million years ago now, but it's almost 2026. I've been trading now for almost 20 years. Time just keeps flying by. And I'm so glad that I know how to trade because I didn't like my previous career towards the end. I was doing mortgages and I wanted a new career. And actually, I live in New York City. I live in Manhattan. It's been freezing lately. And I'm so lucky that I can work from home because if I had to go out, if I had to commute, you know, it's not fun to travel if you live in the Northeast during the winter months. It's cold. We had snow this past weekend. We had a big storm. So if you can learn how to trade and make money in the market, it's actually a great career. So if you have any questions, you can email me at melissa@thestockswoosh.com. You can call me at 929-3200-GAP. And again, you can follow me as well. Probably the best place is YouTube. So I'm getting ready for 2026. I'm getting in the mindset, framing my, mind for thinking, what are my goals for next year? A lot of people get into New Year's resolutions. They want to diet, they want to lose weight, they want to start an exercise program in January, quit smoking, whatever. For me, I have in my mind goals. I'm more a goal-oriented person than a New Year's resolution person. So for me, I'm starting to think, do I want to change my risk for January? Do I want to up my risk for trading? We've had a good year. And I start thinking about goal setting for 2026. If you did not have a good year this year, you definitely want to figure out something that you can do different for next year. If you had a good year, you want to have a better year next year. You always want to continue moving forward, okay? But again, if you've been in a rut, if you've been trying to buy every dip, obviously that has not worked. Like I said, we had a big sell-off yesterday. So you've got to get out of a rut if you're in a pattern where you're not doing well. The end of the year, again, January, beginning of a brand new fresh year is a good time to start something new and to start a new trading program. So again, for me, my strategy is really based on a lot of common sense. I'm looking to make money in the market on a regular basis. I really only need one trade a day. For example, today we did Mu. Actually went long today. We went long Mu. I got in, got out. It was a quick day trade. But if you want to make money on a regular basis, then you have to have a set strategy, because if you're going to do this as a career, you need to make money on a regular basis. You have to have more winners than losers. And it's really, for me, all about common sense. I'm following the moves that the institutional money makes in the market. And by institutional money, I mean big funds, hedge funds, big professional traders that come in and take positions and put positions on or off in stocks in the market. And then I'm capturing those moves in a smaller time frame, in a small period of time daily. In fact, I'll pull up here. Can you see my charts without me flipping off? I'll just show you the move we did. Oops. We got in, got the move, got out. I was done in less than 5 minutes today. So I went long, got in, got out, boom, done. It's kind of funny here now looking back how this is read, because I went long this. So I really am an expert in capturing very quick, fast moves in stocks. And Mu had a gap up. It was a gap on earnings, but I use one system for my trades, and it's called the golden gap. Now, I was talking about shorting. We had some really nice shorts here, end of October, beginning of November. Here was BA. Stock closed here, gap down, fell. Stock closed here, gap down, fell. Now, what is a gap? A gap is the difference between the close and the open. So every day at 4 o'clock, the market closes, and every day at 9:30, the market opens again. So between here and here is the gap. So we shorted this, actually. And so you could do a day trade short, you could buy a put. So we did puts. So here was, again, I do options too. We did not do an option in Mu. Why? I didn't think it would continue higher, and I didn't want to do anything into the Christmas week this late in the year. But BA, we did the 210 puts that expired on the 7th on the 29th. So let me just go back and show you where this was. Here was the BA. So I bought the 210 puts, fell, dropped, boom, fell through the strike. Again, when you're doing options, you got to get the timing right, you got to get the direction right. You always have to get the direction right for a trade. Any trade you do to make money, you have to get the direction right. But again, the timing has to be right, and preferably you get a big move, which we luckily did have with this. So I got in it on the 29th. I exited it on the 5th. And again, I'll go back and show you that. Price was not half bad, $275. Sold at $14, which is a huge trade. Made 410%, and I risked $96.25. This is an advanced trader risk. I've been trading for a long time. Made $39,375. If you did a smaller risk, if you did 5 contracts and risked $13.75, you could have made $56.25. Again, you could do 1 contract. So just going back here and showing you the chart, here's the BA where we entered, got the drop. Boom. Took it down. Actually, you could have held this into the last day. I didn't. I just want to show you here. It actually broke 192. It's insane. So again, that's momentum. And this is an example. Again, when you buy a put is a short to the downside, okay? And why do I prefer to short? I prefer to short because stocks move to the downside much faster than they rally. Again, yesterday's a perfect example. So opportunity sets up daily and gaps, which counts for trading for a living. But even if you want to trade on the side, even if you want to make money on the side, you love what you do, you're working or you're retired, you've still got to get it right more than you get it wrong. Now, I'm showing you here, this is back a month ago. Just every trade we did this one particular week, there was one day we didn't do any trades, but my examples here just show you what we did this week, how you can make money just going after one thing a day. You don't have to trade all day. I don't. I mean, I couldn't be here with you right now at 11:30 if I was trading. So again, I told you I got in and out of that mute today in less than 5 minutes. That was it. I could have just gone to Central Park. So 1 trade a day, that's really all you need. And guess what? Then you're gonna have less losses. If you have more winners and less losses, you're gonna do well. And then some winners are big winners. So this was 42,740. My average risk per trade in my day trades is 4,500. So 11.7. Again, this is just a normal week. We shorted the market. Closed here, gap down, fell. We shorted this. We got the sell off here in the tail. Again, you see where we were here. This is basically where we were yesterday. Actually, that's where we were. Entry was 607.05, exit at 599.25. Huge trade, $21,840. This is a margin trade. So what if you could have done a daily expiration, daily put? I did not do a put of this. This is a margin trade. You can do puts for day trades and options. They have daily expirations. On the 7th, we did BA. Here was the short, closed here, gap down, fell. We did that one, shorted at 195.25, got out, boom, 193.30, made 87.75. That was a nice short. Again, it was a gap. Then we actually went long Amazon here. We did do one long here on the 10th. Stock closed here, gapped up. Again, very similar to the Mu. We got in, got out really quickly. Again, this was back a month ago, entered at 249.30, looking for $1, got out 250.50. Profit $3,000. Nice trade, in and out. And again, this was a gap up in Amazon. That was a long. Then we did NVIDIA on the 11th. Stock closed here, gap down. This tumbled yesterday with the overall market. We shorted this here, 11.11, got in 194.50. Again, look for $1 more, got out 193.15. Boom. Profit 47.25. So again, I'm shorting shares. You have to have a margin account or a prop account to do this. Or you could buy a put, but in NVIDIA, you would have bought the Friday expirations to do it. And then we did no trades on the 12th. There was no gaps that rated per my system to do in either direction. And then on the 13th, we did NVIDIA again, closed here, gap down, beautiful sell-off here. Beautiful sell-off here, again, in the NVIDIA. Shorted it at 197, got out at 189.60, profit 4,400. And again, this is a margin trade. So again, I like to day trade, and I also do options. When I'm doing options, I'm holding them longer. So I might hold an option and I'm holding it down, down, down for longer. For example, we did Oracle. We did Oracle a week ago, whenever it was, when it had earnings, and we got a sell-off in that. We did puts, and I held it overnight. So for 5 days here, profit was 42,740 with an average risk of $4,500 a trade, which is an advanced trader risk. You want to come a day trade with me, I call the trades live in the room. I call the entry, the exit, the stop. Again, if you were in the room with me today, you would have gotten the Mu. Now, a lot of people don't have the money for a margin account, so they're doing options. That's fine if you want to do that. Then there's people that are trading prop. Again, if you want to look into that, you can look into that, the same thing. Whether you do day trades or options, though, it's the whole point of using a method and a system that helps you pinpoint, number one, which stock to trade and what direction to take it, okay? Because it's all about putting the odds in your favor. And if you can do that, you will have more winners than losers. So that's how I ended up developing my whole system. So I realized that I only needed, one trade a day, maybe two. I realized I didn't have to trade all day. I realized it was about putting size on to make more money. And then I had to hone down, what my risk was to try to get big winners. So it's about finding a high win ratio system. And when I trade, I have a lot of conviction it's going to go, or I don't do the trade at all. I just won't waste my time. I won't waste my money. For a lot of people, they're 50-50 crapshoots when they take trades. Again, when I take a trade, I put in a stop. I know it might lose, but I don't go into the trade, taking the trade thinking it's going to lose, because you're working against yourself the second you do that. So your mind is very powerful. And a lot of times people are trading their P&L, and they're not really looking at what they should be looking for, which is the chart. Again, when I'm making chart decisions, I'm using technical analysis, okay, which is reading the price action. And I'm looking at the daily chart. So institutional money is in charge of the market and stocks at all times. A big flow of money going in a certain direction is what moves the market, stocks, creates momentum, and sets the trend in charts. When you're looking for the institutional money, you're really rating the side of the power in a stock. You want to be on the side of the power in order for you to make money trading. Institutional money is in charge in the market and the stocks at all times. Even if you think it's not, it actually is. And again, that's the genius thing about trading, is that you can make a lot of money as one individual trader without even taking a lot of size if you're in something that moves big. You could have had one contract yesterday and it put in the market and made a lot of money. You could add 100 shares. You shorted it and made a lot. Again, just quickly going over here. From tip to tail yesterday. Oops, can you see it? High of the day was 613.625. Boom. Low of the day was 628. This is a big bar for the market. It's huge. So it didn't matter if you had a small size or a big size. You would have made a lot of money yesterday if you were in the right direction, which would have had to be short. If you were long, you would have lost. Okay. Any questions here so far? Someone's asking a question. Could you show us trades that did not succeed, and also where do you place your stops as a 50% of the stop position? I'll show you a trade right now, actually. A trade that's down, but I think it still works. But I don't kill trades in the middle of options, if that's what you're asking me. So I take a trade in a day trade, I put in a stop, it's a limit order stop. I size myself to risk about $4,500 a trade. If I take an option, I'm risking more. My risk is my stop. I don't kill it at 50%, if that's what you're asking me. Now, if you want to do that, that's a tighter whatchamacallit, that's a tighter money management, but you are going to lose then in trades that go on to work. So if you want to have better results, then you would not do that. I'm in the 170 oracles that expire next Friday. The trade is down. I just did it yesterday, but it still could work. So here's an example, but it could lose. It might lose. It's upside down today, but I actually think it works. So did I kill it today? No. Why? I got more than a week left. So yes, I have trades that lose. Obviously, every person has trades that lose. If you ever have someone that tells you that they don't lose, that's not true. And I'm a very good trader. I've been trading, like I said, for almost 20 years. You just have to have more winners than losers. And then on top of that, you have to have some big winners. Going back to your 50% killing it though, I entered puts in Oracle here. The trades were down. I stayed with the position and I made money because the stock dropped and the trades worked. So going by your philosophy, you would have taken a loss here and you would have missed a good trade. So again, that's why I don't do that. You got to give trades a chance to work. And again, I'm talking about options. Don't get confused. If I do a day trade, it's a limit order. I'm putting the stop in. If I'd gotten stopped in the MU, I would have lost today. And actually, if I hadn't gotten out of the loss, the MU, I would have lost. If I'd been a pigger in MU today, I would have lost because that stock reversed. But I wasn't a pig. And no one should be a pig right now because it's the holidays. Volume is going to start to just go like that. In fact, today's kind of low volume. I got to be honest with you. I mean, I know everyone's like, oh my God, Christmas rally, Christmas rally. First of all, it's Hanukkah. And this is very low volume for the market. It's 11:30. This is like not a lot of volume here. So you got to be careful today. You got to be careful tomorrow if you're trading. But I think we have some movement tomorrow because we're going to have some economic data in the morning. Anyways, getting back to what I was saying, so we'll see what happens with my Oracle, but I actually think it could work. Becoming a successful trader and investor requires becoming a specialist in defining where the institutions are buying or selling a stock. Learning advanced technical analysis is required to be successful because price is really what counts. What does this mean? Reading price action and charts. Again, what's happening in Oracle? I don't think anyone on the planet that's an institution is going to buy Oracle. Yes, it's up today with the market, but actually it's trending down. So again, you don't just kill a position willy-nilly just because your P&L says it's down. Again, I'm looking at the chart and I'm rating the gap. I'd rather see people size themselves with less money risk so you can give the trade a chance to play out. Just size yourself smaller. Comprehending how to read, define, and trade with this power will have a huge positive impact on your profitability as a trader. Elevate yourself, your trading, your profits to a higher level of consistency and success by learning how to read the footprints of institutions trading in the market. So if you learn how to read the footprints of big position players before the momentum occurs, you can take the position in the right direction, and then you get out after the move happens for profit. So I'm not getting out unless I'm up, bottom line. Now, what if it runs into the last day and I'm down? Well, then I'm going to sell out of it at zero. Obviously, I'm going to, kill it or whatever, but I give it till the last day if I'm down. But I'm not going to stay in it till the last day if I'm up. Like if I get up tomorrow morning and Oracle goes to 165, I'm out. You know what I mean? Or today. But you have to understand how to trade with this side of power, and you need to know how to find it. Knowing how to read what institutional money looks like is essential to becoming a successful trader. And you can win big trading on this side of power. You can make money in the market if you know what to do. Many people don't. Many people don't. And they get sucked into bad trades or not focusing. So just don't do that. Just don't do that. Think before you take risks. Think before you take a trade. Have a set strategy. Look at your risk. Make sure to get out when you're up, especially over the holidays. No one should be a pig right now with targets. Okay? Any other questions here? Good questions. So again, I have one focus. First, I'm focusing on the gap, and then I go to shorts first. And if I don't find a good short, then I will look for a long, like today. I really didn't like anything really to the downside today, but I did like mu for a quick long. So I developed this strategy and system over the course of 3 years, and I called it the golden gap because I'm going through a 26-point rating system to determine which stock I want to trade each day. So what is a gap? A stock gaps on the opening price today is different than the closing price of yesterday's trading. A gap is a break in price action from one day to the next. Simple. Simple, okay? And you got gaps all the time everywhere. A million gaps. You have gap ups, you have gap downs. Here was Amazon. This had a gap up, rallied. This had a gap down, fell. See it? Someone's saying, Melissa, you can't be still shorting Oracle down here. Yes. Gap fills don't work. And Oracle is not at the lows. So all of that is false. Whoever just said that. So that's that. I can think of an example later, maybe if we have time at the end here. But if you're trading gaps to fill, you're absolutely losing. Because over the course, again, you have to win more than you lose. Gap fills do not work. That's not a strategy. Anyways, getting back to Amazon, closed here, gap down, fell. And again, you could have done a put, fell. PLTR, close here, gap down, fell. Again, we did this. Feels like a long time ago here. This was beginning of November. But again, this had a gap up over here. Closed here, gapped up, rallied. Okay, so you can do bullish gaps, you can do bearish gaps. And again, gaps have huge opportunity because they spot power money. How are you going to have a move like yesterday in the market? How are you going to have this kind of move? Again, you can say, well, we did this because of this thing, that thing, Trump, tariffs, whatever. People sold and dumped positions, or you would not have had a $13 bar. And again, look at the volume. Again, see the square, the third row down the volume. And again, compare that to today. It's like today is nothing. But again, this was selling. And again, we were short. You had some shorts, but it was selling. Again, institutional selling yesterday. Makes sense? So again, how do you find gaps? You find gaps everywhere. There's a million reasons for things to gap. Again, today we had a gap up in the market because of economic data. Inflation number came in low. You could have had a different reaction. We have more economic data tomorrow. Sometimes you have earnings gaps. Sometimes it's news gaps. So there's lots of reasons for things to gap. Could be a sector gap. So it's not hard to find gaps, but you have to qualify them. So I developed a system using a checklist. Gaps have to be qualified. The checklist tells you what to look for in the price of the stock. Again, do I want to buy it? Do I want to sell it? Do I want to do it at all? And you're making the decision, okay? So there is only one thing and one thing only that can move the direction of a stock, and it's money. Not a little bit of money, but a lot of money, or what I call power money. Power money is in charge. Power money is in charge of the stock's direction. Trends are set and moved by the power money people. Guess what? There's a lot of them in the market, more than you can ever think about, and that's why you have to trade with them, because you can get hurt if you trade against them. Again, whoever mentioned the gap fills, that's a perfect example of that. You don't want to trade against institutional money or you get hurt. So the only way to make money is to trade with it. Gaps happen in the market on a regular basis. However, some gaps are better than others. Some gaps are nothing gaps, and some gaps are very powerful displays of institutional money. Again, yesterday was a good example with that sell-off in the market. It was a beautiful sell-off, actually. And a lot of stocks sold off with the market yesterday, too. The most important gaps in the market are gaps that signify a change in direction or a bigger move in the same direction. Understanding which gaps are meaningful and which gaps are not meaningful in the market will help you to know what to do and when a change is occurring. That's how you know when the power money will flow to pay you. So I developed a 26-point checklist. This is what I teach in my class, which I teach once a month. So the next class is not till January 2026. But if you want to learn my system and the 26 points, you would come and sign up and take my class, and then you could join the room. Taking the class is a prerequisite to joining the room. I don't need a perfect score. I'm looking for 20 points or more. I'm looking for power money to move the stock. And then again, like I said, I'm focusing on shorting, because when you think about it, stocks definitely move faster to the downside than they rally. And while sometimes we go long, like the Mu today, I'm mostly short, even in a bullish market. So think about it intellectually. If you're with the right side, if you get the direction right, if you're with the power money, you can make money. And then again, whether you put on a small size or a big size, that depends how much you make. But the size you take has to depend on the size of your account. And everybody has a different size account. You have to be, go fit within your parameters. So I'm looking to pinpoint in the rating system the direction of the power money by reading the price. Again, here was an example. We did this PLTR. We got this sell-off. Again, we did shorts, we did day trades, we did puts. Again, the benefit of doing options is you can hold overnight. I know people like to do options because the cost is less, and you could say this is an expensive stock to day trade on margin, but again, you could have bought a put and you could have got the drop, or you could have done a day trade, got in, got out, could have done a day trade, got in, got out. So if you do a put, if you buy a put, you can get this move down, okay? And you get big moves overnight is my whole thing, and that's why I like to do options for the big move. I get that people like it for the cost, but it's really the idea of you're getting a big move. Here was another one we did, feels like 100 years ago now, but this was Meta. Stock closed here, gap down. This was an earnings gap. Stock closed up here around 750 something, gap down here to around 670 something. Again, dropped, fell. So from the initial day prior to the earnings, okay, the stock was up here around 750 something. It lost more than 150 points. How do you have a move like that? Institutional money. Institutional money. You would never have a move like that otherwise. And again, why they sold the Meta or shorted it, who knows? Who cares? It's just what it is. Remember, we also had some beautiful selling back in here about a month ago. This was the Qs. Gap down here, sold off. That was the 13th and 14th. I forget the reason for that. So again, it is very easy to press the button to make money once you know what to look for. And again, it's all about conviction. You have to have conviction to take the trade. If you don't, you shouldn't risk your own money, because chances are you're going to lose. And a lot of people take trades without any strategy. And again, you have a higher odds of losing then if you don't have a strategy. You need conviction to make money. Why? First of all, again, not every trade is going to go right away. And you also are in the market with millions and millions and millions of other people that are trying to make money too. They want your money. When you take a trade and you lose, someone else is making money. When you take a trade and win, you're taking somebody else's money. That's how it works. You're not creating anything. Like, you're not knitting socks and sweaters and selling them on the street corner in New York. You're taking somebody else's money. Or when you lose, somebody else is taking yours. Again, it's from the movie Wall Street. It's a zero-sum game. You know that? I should watch that movie over the holidays, actually. If you want to trade effectively, the bottom line is you cannot go with a crowd of day traders. The person that mentioned gap fills, that's what most people do. They don't work. Doesn't mean that sometimes it doesn't work, but consistently it doesn't. It's a losing game. So a lot of people do that, lose, and then they never want to even look at gaps or do them. They get scared and scared of them. They don't understand them. But again, if you're in with the crowd, you're going to lose more than you win. So you have to be smart about it. You need to have an edge. For me, my edge really came from shorting. Again, and also looking at the fast trades. I'm very good at reading very fast trades quickly on the 1-minute chart. Again, looking at the Mu, it's kind of crazy looking at it now, how I made money going long that stock today. So again, that gives me an edge too, because I'm doing the fast trades. And when you're reading out of something very quickly, then you're not at the mercy of, White House press conferences, news drops, things that happen in the afternoon, the Fed. It is easier to make money, I think, in the morning. And then my edge also is doing gaps, which again, like I said, I've been doing for a long time now. So I think whatever you decide to have as your edge, you need to have that, because there's too many people out there that are trying to make money and they're trying to take your money. You know what I'm saying? So it's really about earning power. knowing how to earn it and knowing what counts. So if you want to consistently make a lot of money in the market, the only way that will happen is if you have, number one, a high winning strategy, number two, good money management, number three, a good mentor to follow in the live trading room. Again, I call the trades live every day. If you're there with me, you take the trade, get in, get out when I do. I try to make it easy for people by calling the trades live. It's up to you to size yourself. You still have to press a button yourself. You still have to manage your own account yourself. You know, you still have to learn it. But like I was saying, the morning is a very critical time. It's a very important time. Actually, I don't think people realize how important the morning is. Its time of the day is really key. But like I was saying when I started talking, I love trading. I love that I can work from home, especially in the winter months. And I know a lot of people post-COVID now are being forced to go back to work with their employers or a certain number of days a week. I was on the elevator the other day, and these were executives. These weren't like, you know, like 25-year-olds. These were like older people, executives. They were whining and complaining in the elevator that come January, they're going to have to go back to work 5 days a week. And I kind of was chuckling to myself because, again, people really have gotten in the habit of not going into work 5 days a week since COVID. Even now, you know, all these banks, a lot of these places, they're making people go back starting January. Even places that were saying, well, you could go in 3 days a week or 2 days a week. Starting January, people are going to have to go back to work. And a lot of people aren't happy with it. So again, if you can find a career that you can work from home, it's definitely, you know, a nice living. Let me see if there's any questions. Someone's saying something about filling the gap. What bullish gap are you talking about? I don't know what you're talking about there. I don't know what you're talking about. I don't know what stock you're talking about filling the gap there, or a bullish gap. I'm doing short, someone's saying something long-term, short-term. I'm doing quick trades. If I'm doing an option, I'm doing it for a week. If I'm doing a day trade, I'm in about a couple minutes. Someone's saying they have no sound. If futures, as far as you can rate the market, someone's talking about Oracle. If I lose in this last trade in Oracle between now and the 26th, I still made so much money in the last week and it's shorting it that it doesn't matter. Again, some trades lose. So I'm telling you, I have this on, and if I add up all my Oracle trades since this day, I still made a crazy amount of money shorting the stock. So when you take a trade, you're taking risk, and that's the chance you take. If you're not willing to take risk, you are not going to get paid and you have no business trading. But I will say one thing. If I lose in that last trade that's into next week, guess what? Come back January when I'm back at it, I'm probably going to be doing it again because I have 100% conviction and no chance of failure that Oracle's lower. And whoever's talking about this that's saying that it's going to rally is dead wrong. So you can watch it in January. Somebody's talking about sound. Sorry, I don't know, Joe. If he has no sound, I don't know. Somebody's saying something about sound. What was he talking about? Okay, going back to what I was saying. So I teach a class once a month. It's called the Golden Gap course. It teaches a 26-point gap rating system to find the best stock to trade each day. And again, I'm doing short-term trades. I'm not doing leaps. I'm not doing swing trades. I'm not buying stocks and holding them forever and ever and ever. Again, whether I go long or short, it's a short-term trade. So if I do a day trade, I'm flat, usually in the morning or definitely before 4. And that's what I'm talking about, margin trades. If I do an option, I'm doing it out for 1 week, maybe 2. But I have no trades on actually out now till 2026. It's too far out. You can use it for stocks. You can use it for ETFs. There are lots and lots of places out there now for prop firms. I will say this, in 2025, there was a lot of places that went under. So you got to find a good prop place. I wish I could recommend one to you. I'm sorry, but I can't. I had a place that that I used to trade like a million years ago. I'm referred them to people, and then they sold the business. So a lot of people are trying to get out of that business. Either they're going under, they're selling. It's consolidation. You know, you saw that, remember, with the consolidation with the Ameritrade and Schwab. You always get a couple years, you get this consolidation, and then it seems like you have less choices. You get these brokers keep getting bigger and bigger and bigger and bigger, and I can't say it's actually good for customers, because then we have less things to choose from. So I can't really refer you to any prop place, but I will say do your due diligence. There's a lot out there, but 2025 was a year of consolidation for brokers. You know, a lot of places are not charging fees anymore, so they're not making that much money. And if they don't get the volume, they don't have the volume there to sustain themselves. They're not making money, and then they sell or go under. You know what I'm saying? So I teach a class, it's called the Golden Gap course. It teaches a 26-point rating system to find the best stock to trade each day. The course also teaches you how to enter and exit the stock on the day. The course teaches price analysis and technical analysis on an advanced level. So it teaches one solid strategy to trade gaps effectively by reading the side of power and charts. It teaches how to read support and resistance, take positions in the right direction, which is important because that's the only way you're going to make money. Again, we were talking about Oracle. Oracle's a short, could fall today, could fall tomorrow. Again, if you're in the wrong direction, you lose. Again, some trades lose, but the idea is to take very thoughtful trades. You want to win more than you want to lose. And again, if you aren't taking more winners and losers, what happens is people get this piggy mentality where then they double down, or they, you know, buy the dip, they do crazy things because they're thinking one big trade's gonna, you know, take away all the trades that they lost in. And that's wrong thinking. It's the consistency that people lack. It's something that I do very well. And I know, since I've been doing this a long time, that that's the way to make it. I don't know why people aren't consistent. It's because they're always looking for the next get rich quick thing. There is no such thing. Even if you come to me, you're going to take some trades that lose. But if you stay with me overall in the course of a year, you're going to win. And again, you have to learn it. You know, I'm here. You're going to have questions. This isn't brain surgery, but it's definitely new for a lot of people to come to me. I'll say that, even if you've been training for a long time. And the class itself is like a window into my mind about how I see things. I actually still think the market's lower too. I'll tell you that. In fact, I appear on TV, and Fox wanted me to be on before Christmas, and I can't do it. I'm going home for the holidays. So I might be on between Christmas and New Year, because I'm coming back to New York between the week of the 29th. So I might be on with Charles Payne that week. But I sent Charles my talking points. I think the market's lower. In fact, if I have time, I'll read it at the end. But again, people are buying the market today, which you could. You could buy the market today, get in, get out. But a lot of people are probably going to buy the market today and not get out. You know what I'm saying? So again, my class teaches a more proficient and advanced way to read charts, focusing on technical analysis and gaps. It teaches how to get conviction in your trading in the market as a source of wealth by trading with the side of power for consistent profit. So it's about chunking it out. You take the move, chunk it. You take the move, get in, get out. Take the move, get in, get out. This is income generation. It's not buying and holding and forever and ever and ever and ever and ever. You know what I'm saying? Even if we have a sell-off, and many of these things, Apple sold off today. Apple had a crazy sell-off this morning. We didn't do it. You know, again, you have to get the right pick. It's all about making money. That's all we're trying to do. But we need movement for that. We need volume for that. We need momentum for that. So again, I say 100% conviction. That's what you need. That's how you put the risk on it. I don't care if it's one, you know, contract or $100. You got to have conviction. You don't want to lose. Even if you're risking a small amount, it's still your own money. Otherwise, you may just go on a vacation or go gambling or go to Atlantic City or go out to a nice fancy steak dinner, go to a steakhouse in New York. You don't want to lose. So you want to be very thoughtful about the trades you take. So empower yourself to trade the market. Remember, education is a gift to yourself. Here's some testimonials. What else? Any other questions? So the next class for me is not until January. It's the end of the month, actually. Class is called the Golden Gap course. It's a full 2-day course on how to strategically find, pick, and play stocks that are professional bearish gaps. Class is online. Oh, shoot, I didn't put the dates in here. I'm so sorry. I just realized I didn't put the dates. This was the December class. Well, the dates are January. I will tell you right now, it's January 24th and 25th. Sorry about that. Here, where's the chat? I'll give you the dates. In fact, I don't even think I updated the website. I've been running around, getting ready to leave, did the class, having to buy gifts. The class is the 24th and 25th, 2026. There you go. There's something else I was going to say we're talking about. Picking a put strike. What about, I try to do at the money. Now, if I do something away from the money, I'm saying that's a target. Like if you wanted to do a new trade here in this, again, I told you I'm already in it, you could do a 180 Oracle put if you wanted to. So I'm trying to get it as close to the strike as I can. Look at that Apple. So this, again, I have no idea what happened. We did not trade this, but something crashed this thing here today. I don't know. Something happened here. It went boop, and the low was 266.95. Again, we ended up going long mu. I don't know what the heck happened to this thing, but something happened there. Can you show the slide that was right before the pig with the 100% conviction? Right before the pig. Trading is about chunking it out. It's income generation. Again, I didn't hold mu. If I had held mu, I would have lost today. I got in, got out. Why? I didn't know what the market was going to do today. And on top of that, it wasn't an earnings gap. It was just like a regular gap. It was news or whatever. And it was spreading. It had a big move. I had a big move in it. And on top of that, it's a holiday. It's low volume. So there's like a million reasons why I would just get in and out. But I would have done that any day of the week. That's what I do with my day trades. I hold options, and I did not do a mu option. In fact, if I had, I would have done it very fast out of the gate. I would have been down in it. It dropped, and I wouldn't do it here. You know, because again, you're going into the Christmas week. So again, time has to be right for options. You need momentum, you need movement. It's Hanukkah. I'm not Jewish, but it's also Hanukkah this week. So, I mean, part of the reason we're low volume here is because of the fact that there are people that are off. And again, that's probably part of the reason why this is low volume here in the market too. So again, today's a good example. Do I think institutional money is buying this gap today? No. Now we'll see where it goes. But in my opinion, the market could have another sell-off. When, what time, where, I don't know. I'll watch it and see. Again, I might, you know, not do anything next week, probably. Could be January, could be whenever, could be tomorrow. Any other questions here? So again, class dates are January 24th and 25th for the next class. Again, it's more than a month away. If you have questions, if you're interested, you can email me. You can go to my YouTube, and I have tons of videos. I have my television hits on there. I have training room videos you can watch on there. I did not post today yet. If you have questions, you want to find out more or get on my marketing list, email me about the class in January. But again, to get in the room, you have to do the class. But if you sign up and join and want to join, you could get in the room the first week of January when we're trading back and start trading before the class. I think that's the week of Martin Luther King. And earnings season starts the week before that. Earnings season starts actually the 13th. Any other questions here? If you have questions, you can email me at melissa@thestockswoosh.com. Oh, I put my email in, I think. Sorry for everybody or the dates. It's January 24th and 25th. And here's my email. Listen, happy holidays, everyone. Be careful.
Thank you, Melissa. Thank you for sharing such valuable insight into trading gaps and institutional money flow. Melissa has also put together a very generous holiday special offer, and Well, she said emo, so please email her, and she put chat box for you. Yeah. Thank you, Melissa. Have a happy holiday. We appreciate you.
You too. Bye-bye.
Yeah. Thank you. We appreciate it. All right. Let's move on to our next session. Our next presenter is Chris Sayre, lead consultant at bigtrends.com. Chris brings 38 years of experience in the financial markets, including roles as a portfolio manager and registered investment advisor. He specializes in systematic options trading and will be showing us how he trades SPY options using a precise 3:40 p.m. setup designed to capture overnight momentum. This approach focuses on short-dated options and small price swings that can produce outsized results. So everyone, please welcome Chris Sayre.
Hey, Anthony, how are you, man?
I'm good. How are you?
Doing well, thanks. Appreciate you having us on again. Glad to be here. You ready for me to get rolling?
Yeah, it's all yours. Thanks for being here.
Yeah, thanks, Anthony. Hello and happy holidays, traders. As Anthony said, my name is Chris Sayre, and we're going to talk about how to trade options on the S&P 500 ETF. If you're not familiar with that, the ticker symbol, as you can see there, is SPY, using the 345 signal and overnight momentum. Anybody out there trading SPY currently, or maybe SPX? While you're answering in the chat box, I've got to read the disclaimer to you. The information provided in this presentation is based on our proprietary research and is intended for illustrative purposes only and not to be construed as specific advisory recommendations. Stocks and options trading have large potential rewards, but also large potential risk. The past performance of any trading system or methodology is not necessarily indicative of future results. See our terms of use on the bigtrends.com homepage for more information. You see the contact information there at the bottom. Something pops in your mind after watching today's presentation, reach out to us. Our office hours are Monday through Friday, 9 a.m. until 5:30 p.m. Eastern time. Markets close, we're closed. Next week when it closes early, we'll be closing early, but we're here today if you have any questions, and be glad to assist you. As Anthony said, I work at Big Trends. If you've never heard of us, Big Trends was started by Price Headley in November of 1999. So last month, we just celebrated our 26th anniversary. Fun little fact for you, I was actually one of Price's earliest clients back when he launched Big Trends. You can see I have a background in the financial services industry like Anthony was sharing with you. And if you can look there at the last bullet point, I joined Price and his team in September of 2011, over 14 years ago, on the front lines, assisting, helping traders just like yourself. Enough about Big Trends, enough about me. Let's talk about you and why you're so gracious to share your time with me today. So the trading system, very simplistically named Overnight SPY Trader, okay? You can call it a newsletter, you can call it a subscription. We call them alert services here at Big Trends, but it is Overnight SPY Trader. We're going to talk about how to get laser focused and boost returns and tactics from our 26 years of experience. Success stories and chart examples so you can see what these trades look like. I'm quickly approaching 57 years old, been trading and investing since I was 18, working with people throughout my life. It seems like most people are visual learners. That's why I have lots of chart examples for you today. And as I said, the name of the trading system is Overnight SPY Trader. I'm going to reveal some of the details for you. And then, of course, at the end of my portion of the presentation, I will have a special offer for you. And if you sign up, you could, not guaranteeing, but you could get your first trade this afternoon. So capturing the overnight moves on the S&P 500 has historically been paramount to success. Let's look at some data here. So as you can see, this is from a company out of Australia, but it helps drive home the point of why our team created Overnight SPY Trader. So the blue line, as you can see there, is buying at the open and selling at the close. But the orange line represents buying at the close and exiting at the open on the next trading day, okay? Now, it's not that simplistic. You can't just click away and say, hey, I already know Chris's presentation. We add a few little wrinkles to this, if you will, but I believe this chart brings home the point that I'm trying to make. And of course, they make us tell you past performance is no guarantee of future results. So let's talk about some of the strategy guidelines. Average holding period. Check this out. 1 day or less, but no day trades. Again, being on the front lines here at Big Trends for over 14 years, that's something that I've heard from traders, is that they want to be in and out, right? but they're afraid of being labeled as a pattern day trader. If you don't know what that is, do a Google search, contact your broker. I'm not going to get into the details of that today, but you can understand and know if you subscribe to our overnight SPY trader, there will be no day trade. So what type of option strategy? Again, Price Headley is the founder and CEO of our team here, and he has a team of analysts. They use 4 different price action patterns analyzed on a daily chart. So every chart that you're going to see today, every candle, red or green, is going to represent 1 day of trading action. I'll touch on that again as I go forward. What options do we trade? Very simplistically, straight calls and puts. So if you are approved to trade calls or puts, you can be a subscriber to our overnight SPY trader. No debit spreads, no credit spreads, no condors, straddles, strangles, butterflies, none of that stuff. Plain vanilla calls and puts using 2 DTE expiration. What does that mean? That just means when we buy an option, we're going out 2 days until expiration. As I told you earlier, I've been trading and investing since I was 18, almost 40 years ago. And doing so back then, all we had were monthly options. Those were options that expired the 3rd Friday of every month. Now we're trading SPY, as you have learned. The CBOE started making weekly options available on SPY in 2005, so 20 years ago. In 2016, they released options that expired Monday, Wednesday, and Friday on SPY. And then in 2022, they started releasing options that expire every day on SPY. So that's why we can go out 2 days until expiration. So how many trades per month? Up to 14 signals per month. So not a trade every day, but lots of trading action. So a lot has changed since Big Trends was started over 26 years ago. Mobile trading, as I've told you, almost 57 years old. It amazes me what we can do from our mobile devices, whether it's your phone or some type of tablet device, right? It's truly amazing. So when I first started in the industry as a paid intern at a brokerage firm, you had to call into me to get a quote on where your stocks or options were trading. Yes, there was a scroll with the ticker on TV, but that was delayed data. Now we can get instantaneous data, and some things even trade 24/5. Daily expirations, we just talked about that. Truly amazing. And here's a big one. Substantially cheaper commissions. If you'd have called me back when I was a stockbroker, okay? Speaking of stockbrokers, my friend Joe K just said, hey, Chris, go Cats here in Lexington, Kentucky Wildcat fan. Hey, Joe, good to see you. So Joe can tell you, back when Joe and I were brokers, if you would have called us and wanted to place a stock trade for 100 shares of a stock or several contracts on an option, you were going to pay $50, $100, maybe even a couple $100 to do that transaction. Now we can trade stocks for free, and we can trade options typically for $1 or less a contract. So if you learn anything today, if you're paying more than $1 a contract to trade options, contact your broker and find out what it's going to take to get lower commission rates. If they won't work with you, start shopping around. It's a highly competitive industry. So listen, with all these factors, the search of frequency is what most traders are looking for. Now, of course, anyone can enter SPY into their trading platform and start firing off trades, right? So simplistically, I just told you, you can do it from mobile devices. You can do it at hardly no commissions. So playing the game, if you will, simplistic and cheap. But focusing on numerous signals with a quantifiable edge requires a more deliberate and strategic approach. Now, you may have noticed on my bio, I've got a degree, right, in business. I used to be a broker. I used to be an RIA, registered investment advisor, long-term money. I know how to read financial statements, okay? Price Headley, our founder and CEO, degree in economics from Duke University, CFA, CMT, several analysts, business degrees, all right, enhanced education. We all know how to read the financial statements. We could give a flip about that stuff trading the SPY overnight. Okay, we're technicians here and very systematic. So that's why we developed Overnight Spy Trader. This strategy is designed to find as many as 14 new trade signals per month. So how does it work? Well, let's kick off today's event with a recent winning trade. So a reminder here, every bar that you see, red or green, represents 1 day of trading action. So these are what? Simplistically, daily charts. Now we're going to be talking about money because that's what we're all looking to do, is try to make some money, right? All trades today are going to be based on allocating up to, but no more than $1,000 a trade before any commission or subscription investment. Now, before anybody asks, can you be a subscriber to Overnight Spy Trader for less than $1,000 a trade? The answer is yes. Why can I say that? Because I'm going to share with you later that the average recommendation over the past 12 months has been less than $4 a contract, the average. So $400 or $500 per trade, you can subscribe. Now, if you've never traded SPY or even looked at it, it's one of the most highly traded securities in the options world and even in the stock ETF world every day. So liquidity is there. My point is if you trade more than $1,000 a trade on these options, you can, because the liquidity is there, the bid-ask spreads are tight. But please, if you've ever heard me speak before, always trade with what fits in your financial situation. So we entered this trade on November 20th, okay? And yes, we bought calls. Now you may say, well, Chris, why did you buy calls after this big down move and this big red candle? Great question. Because our research says when you get this type of move, and our team uses a indicator called ATR, and they use a multiple of ATR plus the action of the candle, okay? So the action of the candle and the multiple that we use on the ATR said it was time to buy calls. As you can see, the very next day, we made 100%. Now, that is our profit target. We are targeting 100% on these trades, okay? And we're using a 50% stop, all right? So we're targeting 100%, stopping at 50%. So risking 1 to make 2. Risking 1 to make 2. Now I'm going to touch on this here in a few minutes, but not every trade is either going to be either or, okay? It's not either or. We'll get to that here in a little bit. But if you'd allocated up to $1,000 to this trade, you'd have made $794 before any commission or subscription investment. And as you can see there, bottom left, $397 a contract. As I was saying, $400 or $500 on average, you can trade these trades. So as I've told you and I just showed you, step 1, we're starting with a daily chart. New trades can trigger once per day, Monday through Friday. We enter these signals before the daily bar closes, and trade alerts are sent between 3:45 and 4 o'clock. Now, before anybody says anything, yes, I know the bell rings at 4 o'clock Eastern time. Again, if you've never traded options on SPY, you know what time they trade till? They trade until 4:15, right? They trade until 4:15. Be careful. Don't learn that the hard way like I did years ago. We'll leave it at that. And yes, we'll enter trades on Fridays and carry them over weekends. Have examples to show you that here in a little while. This defined scanning session eliminates noise and allows us to use the power of those 2-day until expiration options. Now, scanning for signals every day has resulted in high trade frequency and large profit potential, like I just shared with you. So how to get the most bang for your buck while managing risk? 2-day until expiration options allows us to get tons of leverage for a very small investment. The average contract price has been $3.62 over the last 12 months, okay? $3.62 over the last 12 months. Now, trades are exited the next trading day at 3:45 p.m. if the trade has not been closed before then. This avoids being affected by the final day of volatility. So we go out 2 days to give ourselves a little bit of a cushion, all right? And remember, we're targeting 100%, stopping with 50. But if we don't hit those, then we'll get out on the time stop. So the next day. So you're in these trades one trading day at the most, 24 hours, if you will, if it's during the week. If it's a Friday, of course, you got the weekend there, right? Step 2. So step 1, daily chart. Step 2, look for specific setups. So our team has broken down each trading day into one of 5 categories. 4 of those categories are tradable price action patterns. If the setup falls into the 5th category, then no action is taken, right? That's pretty obvious. Now here's something that our team has done, and this may be a new concept to you. We use the historical profit factor to determine which days were the best for long trades via calls, short trades via puts, or neither, sitting in cash. And here's what I can tell you. Some days sitting in cash is the right decision, right? We all want action. We all want to make money. But some days the best trade is no trade at all. As I told you earlier, our team is using an indicator along with the price action. That indicator is called average true range. Now, bear with me as I read this to you. The average true range is a technical analysis indicator introduced by market technician J. Wiles Wilder Jr. in his book, New Concepts in Technical Trading Systems. Here we go. The true range indicator is taken as the greatest of the following: current high less the current low, the absolute value of the current high less the previous close, and the absolute value of the current low less the previous close. The ATR, average true range, is then a moving average of the true ranges. As you can see there, that's from Investopedia. Anybody out there using ATR in their trading, average true range? Now listen, the exact settings are proprietary. You can understand that, right? But I am going to give you a sneak peek at what we look for. We compare the current bar's range. I showed you that on that long red candle in that first trade, with the average true range, a multiple of average true range, to identify momentum, or as it has there in parentheses, or the lack thereof. We look at the price action of individual candlesticks to determine if they provide bullish or bearish confirmations. This hint you probably already know based off that first chart. Green bars are not always bullish, and red bars are not always bearish, just like I showed you on that first case study. It was a big red candle, and we were buying calls near the close of that candle. Now listen, I'm showing you reality trading, okay? There's going to be wins, there's going to be losses. If you join today, you subscribe today with the special offer that I have for you here in a few minutes, do not expect every trade to be a winner. If you're looking for perfection, big trends is not your answer, okay? Now, not every trade's going to be a winner, so let's look at some losing examples. Why do I share this with you? Because losses are going to happen. That's why you hear me talk about allocating your capital correctly. Here's an example where we bought calls off a green candle. Again, it's based off this true range and a multiple of that true range. We're buying the calls. Next day, we get stopped out for 50%. Remember, we're risking 50 to make 100. Here's one, get in, get out. As you can see, it was an uptrend. You're like, hey, it's pretty intuitive, buy some calls. It gapped down the next day, and we lost 50.46%. Now, as I told you, not all winning trades will hit the 100% profit target or the 50% stop. Here are a few examples. Check this out. We call it a time stop. Remember, we will get out the next trading day at 3:45 p.m. Get in, buy calls, get out. And look, this is a time stop that was a minus 35.35% loss. Again, not all trades will be 50% losses. Not all trades will be 100% wins. Here we get into calls, and yes, we buy calls even after. Look at this gap action. Look at that gap action. And we still bought calls. Move we got right, but we had to get out. Per our research, we made 38.58%, $338 gross profit. Remember, all trades today are based on allocating up to, but no more than $1,000 a trade before any commission or subscription investment. Here's one just a few weeks ago. Got in on the December 1st, 678 calls. got out, made 24.47%, $206. Now, $206 is not a ton of money, right? But you may be able to go get a decent meal with your significant other, or maybe fill up the SUV, right? But we still made a little bit of money. Now, let me back up. You notice this? This was the 26th. We closed it out on the 28th. Nobody asked. Thought you only held for one day. You know what was in between there? Thanksgiving. We don't worry about holidays. We don't worry about weekends. If our system says get in, we get in. If our system says get out, we get out. And as I mentioned, frequency, right? Let's look at what I mean by frequency in action. So check this out. This was a Thursday in January. We're buying calls here. Again, red candle, we can enter calls on a red candle. As I said on that hint, not all green candles are bullish, not all red candles are bearish. Here's an example. So we get in, this is a Thursday, okay? We get out on the morning of the Friday, making 106.70%, $764. Someone may ask, well, how did you make more than 100? Well, you see right here to here, this is a gap up. That's how you make more than 100 at the open. All right. Now that was a Friday. That was a Friday morning. Did our team take Friday afternoon off? They're like, hey, we've already got a winning trade for our subscribers. Let's just take the day off, the rest of the day off. And guess what Monday was? The 20th. It was a market holiday for the Martin Luther King holiday. So they could have said, hey, we're taking off. We're getting a long break now. No. That afternoon, the system fired another signal. On Friday afternoon, we enter, and then we hold it over the weekend and the holiday. So the market's closed for 3 days. We didn't care. We made 50.52%. What's that called? It's called a time stop, right? Time stop. Making $386 gross profit before any commission or subscription investment. So that's the 21st, okay? How about getting into a new trade on the 21st after taking that 50% win? So we're riding this trend here, okay? Get out the next day, making 100%, $927. So you saw, get in on the 16th, out on the 17th, re-enter on the 17th, hold it over the 3-day weekend, get out for a time stop on the 17th or on the 21st, enter a new trade on the 21st to go for the 22nd. Okay? Action. Now, trading 2-day until expiration options can be seen as aggressive. I get it. But with proper trade management, it has been extremely successful. Of course, past performance is no guarantee of future results. Let's look at some more charts here. Back in the summer, we get this call trade. Exited next day, 100%, $789. Remember, we can enter calls on red candles, and look at that high to low move there. It fits within our multiple of ATR that we're using. Okay. Now, someone has not asked yet, which I'm kind of surprised this far into the presentation. This part right here. How do you all do the option selection process? That's part of the secret sauce. Now, I've told you a couple times already. Yes, I'm coming to you with a special offer at the end of the presentation. Not going to be ducking that, not trying to spring it on you. But one of the things included in the special package today is called the Settings and Rules Sheet. It is a 2-page PDF that bullet points outlines the trading system for you. Now, another resource you'll get access to is called a strategy session. Do you have to study those to be a subscriber? You don't. You don't. But when Price Headley, our founder and CEO, started Big Trends 26 years ago, he wanted to educate traders if they wanted to be educated. And in the settings and rules sheet, in the strategy video, you are taught the secret sauce of the option selection process. Buy more calls on a long red candle. Getting out the next day. How did we make more than 100%? Well, from here to there is a nice gap up. This trade made $1,122 gross profit. Remember, all trades today are based on allocating up to, but no more than $1,000 a trade before any commission or subscription investment. And of course, past performance doesn't guarantee future results. Look at this, calls. Are you kidding me? You guys bought calls after this gap down? Yep, we sure did. We sure did. Boom. And look what happened, folks. This is the 4th of August. This is the 1st. Got in on a Friday, carried it over a weekend. We don't buy into that myth. There's a lot of traders out there. Oh, I won't hold over the weekend. You never know what's coming. That's true. But if you have a tried and true trading system that you have confidence in, that you've done the research on, that you have a positive historical profit factor, then you can enter those trades with confidence. If you're out there trading based off the latest news you hear on CNBC, Fox Business, Bloomberg, read in the Journal or Investors Business Daily or follow on X, but you don't know if it has an edge to it, then I'm going to tell you, you're guessing. You're guessing. So we held this trade over the weekend. Our subscribers were happy, making 100%, $712 on a $1,000 allocation. Calls, again, red candle, next day, 100%, $879 gross profit. Just after Labor Day, green candle. Next day, 100%, $834. So listen, again, I cannot tell you enough. These are daily charts, right? If you just joined, these are daily charts, and our team is using ATR to let them know whether a trade is viable or not, okay? Here's a trade entered on September 9th, green candle calls. Next day, gap up 100%, $984 in gross profit before any commission or subscription investment. Now, I'm just going to review a couple more winning trades for you. Here we go. October 23rd, closed it out on the 24th. So that was a Friday, okay? That was a Friday, making 100%, $870 gross profit. So enter on a Thursday, out on a Friday. Look what happened later that afternoon. You've seen examples like this. We re-enter after making money that morning on a Friday. Again, we don't take off. Held over the weekend, made 100%, $951 gross profit before any commission or subscription investment based on allocating up to $1,000. And again, I want to repeat and drive home the point. You do not have to allocate up to $1,000 per trade to be a subscriber. As I said, as I've shown, you can do this strategy for as little as $400 or $500 a trade. But also, as I said earlier, you can do it with a lot more if it fits with your financial situation. Now listen, this strategy is currently sold out on our website. And Anthony, thank you for putting our website out there. It's very simple, bigtrends.com, okay? But we have a handful of spots available reserved for the Traders Corner community. And today's holiday summit package has never been seen before. Let me show you how it works. Now, it's only available until midnight, okay? You can get these real-time trade alerts when this strategy triggers a new signal. So if you've been with me through the entirety of the presentation, you know these trades can be issued at the end, near the end of the trading day, 3:45 p.m. to 4 o'clock. So it's almost 12:30 Eastern time now. Why do I bring this up? Because you could get your first trade this afternoon. Now, again, it's only available to 34 traders. The name of the trading system, Overnight Spy Trader. 3 months of trade alerts from the Overnight Spy Trader Alert Service. That's what we call them here at Big Trends. You can call it a subscription. You can call it a newsletter. Now, you've heard me mention this earlier, trader education. Again, Price Headley is our founder and CEO. When he started the company, he wanted to educate traders. Price does weekly video updates for you, okay? Weekly video updates. Settings and rule sheet, you heard me talk about it. It's a 2-page PDF. I have mine laying on my desk right here to my left as I'm speaking to you. Price recorded a digital on-demand strategy session video. Do you have to watch the weekly updates? Do you have to read the settings and rule sheet? Do you have to watch the strategy session? You don't, you don't, you don't. You can just simply sit back and get the trades. But if you want to know what's going on and why we're doing what we're doing, we give you those resources available. Now you may ask, Chris, what if I have questions? Well, you've seen contact information on some of the slides, but how about a dedicated email address to Price and the team of analysts for specific questions about the specific trades and your specific trading system? All of that information is outlined for you in paragraphs in your welcome email that you're going to receive today. You'll get 2 emails from us when you sign up today. You'll get a purchase receipt and you'll get a welcome email outlining all those details. Now, total package value is $891. It's based off the list price of $297. Multiply that by 3. Now, listen, holiday summit package for you here at Traders Corner, okay? Traders Corner holiday summit package. So follow me. 3 months of trade alerts from the overnight spy trader plus the trader resources. First 34 traders, and Anthony can vouch for me, there's more than 34 of you in the room today. $891, look what we're doing for you. We're marking that out, okay? It's the holidays. To me, it's hard to believe that Christmas is a week from now. You know what, yesterday the 17th, 2 weeks yesterday to the end of the year. I don't know about you guys, time is flying. How about 177? Does that get your attention? That's not per month, ladies and gentlemen. It's not per month. That's for all 3 months. And guess what? It does not automatically renew. Does not automatically renew. What'll happen? 3 days prior to your expiration, our client care team will send you an email presenting you with an opportunity to renew. If you miss it, you ignore it, no worries. Your subscription will simply expire in 3 days. We do not surprise charge you here at Big Trends. How do you take advantage? You go to bigtrends.com/corner. I'm going to throw that in the chat box for you, and then I am going to take you to our checkout cart. Let me send that to all of you out there. Hey, Ron, good to see you. Please email clientcare@bigtrends.com and we can get you that information for you, Ron. Client care, all one phrase, at bigtrends.com. So let me take you to that checkout cart. Let me show you how simplistic this is. And of course, it is secure. Top left, billing information, first name, last name, email. Now listen, most people have multiple email addresses. I want your trading email address. Put your trading email address in here so our information doesn't get lost in the mixture of stuff that I've heard from clients over the 14 years that I've been here. Didn't see it. I get so many emails a day. I get it. So do I. It's why I have multiple email addresses. Certain things that I consider important go to special email addresses. We want your trading email address. Contact information is at the top of the checkout card. It's also at the bottom. I'll show you that here in a second. Payment information, 4 major credit cards accepted today: Visa, MasterCard, Amex, Discover. If you glance down there to the bottom, PayPal is also accepted. So 5 ways for you to sign up. Very simplistically, it's a plain, simple 3-month subscription for $177. Again, no automatic renewal, okay? You'll get a purchase receipt. You'll get a welcome email. Terms and conditions are listed here and here. Contact information is listed a second time. It's 1-800-BIG-TRENDS. That's 1-800-244-8736, or email clientcare@bigtrends.com. And just below that, just highlighted that in blue, it says we're here to help. Remember, we just celebrated our 26th anniversary last month. FAQ, little frequently asked questions about our overnight spy trader. What type of strategy is used? Buying calls or puts that are at the money. How about that little secret sauce reveal? Didn't show you that on any of the case studies. So if you're following and paying attention, now you're starting to learn a little bit more about the trading system. How are you going to receive these trade alerts? Real time via email. That's why I stress the importance of putting your trading email in the checkout cart. Now you'll notice out here to the right that we also accept and use WhatsApp. What is that? First, you don't have to use WhatsApp. You do not. You can simply get your trades via email. But if you need a little notification beyond email, WhatsApp is the solution. We've been doing it for over 2 years. It's faster, cleaner, and more efficient than text messaging, because the cellular companies think they know what's best for you and I. So like the email providers, now the cell phone companies are trying to control what shows up in your text messages. Even if you give us permission, they're trying to block stuff. So that's why we gravitated toward WhatsApp 2 years ago. Do you have to use it? You don't. We give you setup instructions in 2 locations. One, in the welcome email that you've heard me reference a few times. You can also find it in your Big Trends account or the My Account. Again, you don't have to use it. Maybe you subscribe today. Maybe you give it a week or 2 and you're like, hey, I wish I'd signed up for WhatsApp. You can still do that. If you need help, as it says in the checkout cart, we're here to help. When are the trades sent? Between 3:45 p.m. and 4 o'clock. If you just joined me, yes, the bell rings at 4, but these options actually trade until 4:15. When are trades closed? The following trading day at 3:45 p.m. Eastern time. How many trades per month? Averages 14 trades per month. Day trades? No way. No day trades, okay? Average contract price over the last 12 months, $3.62 per contract. Come on, there we go. What are the included educational resources? Remember, Price Healy is going to do weekly video updates for you. You get access to the settings and rules. You get the access to the digital on-demand strategy session, and you got access to Price and the analysts should you have any questions, okay? Do you have to watch the videos? Do you have to read the settings and rules? Do you have to watch the strategy session? You don't. Now, I've told you a few times, I've been with Price for over 14 years, on the front lines, doing presentations like these. Back in the day, people would get on the telephone and have conversations. Now we've kind of gravitated toward email and texting, right? One-on-one texting. I thoroughly enjoy getting to know you as a trader and how you trade. Do I think we have the end-all be-all solution? No. You may not be able to stomach overnight trading activity. You may not be able to stomach 50% losses or 100% wins. That's okay. You got to go to bed every night. Now, if you like that concept, you like Trading Spy, you like our risk reward parameters that you've heard today, then subscribe. But one of the things I love hearing is how clients use us. What I'm about to share to you is an unpaid, unsolicited testimonial from Edie. I'm one of those people who has been disappointed over the years with subscriptions that gave no results. It is refreshing to find people who do what they say. I'm looking forward to learning the science behind these trades, so I'm not just following the leader. I want to understand how the markets work. So she's watching the weekly video update, she's studying the settings and rules sheet, and she's watching the strategy session. Again, you don't have to, but Edie wants to. And that is an unpaid, unsolicited testimonial. So I want to review a couple recent winners one more time. One more time. Now here's a trade that we got into just a few weeks ago. Remember I showed you this one earlier? We bought calls after the down move, after that long red candle, and then the next day we closed it for 100%, $794. Again, these trades are based off allocating up to, but no more than $1,000 a trade before any commission or subscription investment. Why do I show you this? 1, to show you what we do. 2, to show you the power of a single trade could easily cover your 3-month subscription today. But what if your first trade is a time stop trade? Remember this one? Got in, got out the day after Thanksgiving, and it only made 24.47% on this time stop trade. But if you'd allocated up to $1,000 to that trade, you'd have made $206. Remember you heard me talk about that earlier? I said maybe you could take you and your significant other out for a decent meal. or fill up the SUV? Well, if your first trade is something like this, it could cover your 3-month subscription. Am I guaranteeing a winner with your first trade? I'm not. Am I guaranteeing a trade this afternoon for you? I'm not. But the only way you find out those things is if you take advantage of what I have for you today. So remember, it's 3 months with the trader education, okay? Total package value, $891. Now, I shared you Edie's testimonial. I want to share this one with you. I told you I was one of Price's earliest clients back when he launched Big Trends in November of 1999. You by now know that I've been here over 14 years and love getting to know our clients and how they utilize us and value us. Yes, there is a lot here on this slide, but to me, this is impactful. You may not know us. I think Don K's testimonial will help you understand who we are. Don has been a client before I joined Big Trends, okay? Just so you know, point of reference, unpaid, unsolicited. Remember, 26th anniversary last month. Dear Price and team, happy 26th anniversary. I want to take a moment to thank you for everything you've done, not just for me, but for the countless traders you've guided over the years. Your dedication to teaching, mentoring, and building a community of clarity and confidence has made a lasting impact. Without your guidance, I truly don't know where I'd be today. What sets you apart is not only the technical knowledge you share, but also the patience, encouragement, and belief you instill in everyone. You've created an environment where learning is approachable, mistakes become lessons, and progress feels possible. That's a rare gift, and it's one I deeply appreciate. 26 years is more than just a milestone. It's a testament to your resilience, vision, and commitment to helping others succeed. You've built a legacy that continues to ripple outward, shaping lives and futures in ways you may not even realize. Thank you for being role models in both trading and teaching. I celebrate this anniversary with you and look forward to many more years of growth, learning, and shared success. With gratitude and respect, Don K. Unpaid, unsolicited. Don K. If you're out there today, thank you once again for giving us permission to share your awesome testimonial. So remember, Traders Corner Holiday Summit Package. 3 months of trade alerts from our overnight spot trader alert service and the trading resources for the first 34 traders. Once again, there's more than 34 of you in the room today. $891 at retail, but we're marking that out. Traders Corner Holiday Summit Package Special, just $177. And again, that's not per month. That's for all 3 months. And once again, it does not automatically renew. Simplistically, bigtrends.com/corner is how do you get to the checkout cart. I'm putting that in your chat box, also with the contact information. Remember, we're here Monday through Friday, 9 a.m. until 5:30 p.m. Eastern time. Market closes, we're closed. Next week, when the market closes early for Christmas Eve, we'll be closing when the market closes then, as you can probably imagine. Here's the checkout cart. Again, it's simplistic. Why do I come back to it? Well, you maybe just joined. I want to point out the email field highlighted in red. Please put in your trading email address. Get your relationship started with us on the correct foot. Contact information, I put that in your chat boxes, but again, it's in the checkout cart in 2 locations. 4 major credit cards accepted. Drop to the bottom, you also see that PayPal accepted. Simplistic, $177, as it says right there, for 3 months. 3 months in the order summary, not per month. $177 for 3 months. Again, terms and conditions are there, and the contact information is here as well. A second time, it's 1-800-BIG-TRENDS, 1-800-244-8736, or email client@bigtrends.com. And as I shared earlier, we're here to help. You've seen 2 testimonials. Edie, Don K. Again, thank you all. If you're out there listening today, thank you for being clients, and thank you for giving us permission to share your testimonials. 3 months of trade alerts, access to the trading resources, $177, bigtrends.com/corner. Anthony, it's 12:45. I think I'm right on the button. How's that?
Yeah, that's excellent. Thank you, Chris, for that excellent breakdown of SPY options and overnight momentum strategies. Chris has also shared a holiday special offer, and his promotional link is now available in the chat box. Thanks for being here, Chris.
Thank you. Happy holidays to you and your team, and happy holidays to everyone out there. Thanks again.
Thank you. We appreciate it. All right, guys, I'm just setting up for our next presenter as well.
Hello, hello.
Hey, how are you?
Hey, Anthony. Hey, guys. How is everyone doing today?
Good, good.
Come on camera here to say hello to everyone, if that's possible.
Excellent.
Hey.
Is it okay if I give you a quick introduction?
And cold Montreal. All right. Shall we get started?
Yes, can I give you a quick introduction?
Please, go ahead, yeah.
Our next speaker is Daniel Sinnig. Is it Sinnig or Signing?
It's German, so we would say Sinnig, but whatever you
okay.
want to do.
Dr.
Yeah.
Daniel Sinnig of Trading Indicators.
Yeah.
Daniel is a trader and professional software engineer who develops advanced trading indicators, analytics, and automated strategies across platforms like TradingView, NinjaTrader, Thinkorswim, and MetaTrader. In this session, Daniel will introduce liquidity zones, hidden landmarks, and price action to help traders distinguish genuine market moves from freakouts using AI-assisted technical analysis to uncover high reward, low risk setups. So everyone, please welcome Dr. Daniel Sinnig.
All right, well, great pronunciation. Thanks, Anthony. All right, so let's get started. So yeah, I hope everybody can see my screen. Anthony, please confirm this real quick, and then we're gonna get started.
Yes, we can see you.
Perfect. So first off, yeah, my apologies for this very complicated title, because it's a bit misleading in the sense that while it is accurate, we're going to talk about hidden landmarks that are hard to spot with the naked eye and which are very important to most trading, as certainly to our trading, which covers both swing trading and also shorter term trading. But the reason why I say it sounds very complicated, maybe too complicated, is because as you will see, it's actually quite mechanical, provided you are using the right tools. Now, we're going to ease into all of this, but before we do, let me reach out to you guys with a little perhaps controversial quote from a famous movie. The movie is called The Wolf of Wall Street. I bet that most of you have perhaps heard of it or even watched this movie. And there's this famous quote. I had to edit it a little bit for language, but it says that nobody, I don't care if you're Warren Buffett or Jimmy Buffett, nobody knows if the stock will go up, down, sideways, or in circles. And let me just ask you guys out there real quick, do you agree, or is anybody here in the room agreeing with this statement? I'm not sure if the commentary function is on or the comments function is on, but if it is, yeah, guys, maybe a quick feedback. Do you agree? Is anybody agreeing with this? Well, I'm not sure if you guys can put the answers in, but if not, let me tell you what I'm thinking. I 100% do not agree with this, because if you agree with this, then I think we're all here probably in the wrong place, because as traders, we believe, and I certainly believe, that the market is to some degree predictable, and there are tools, indicators, techniques, and knowledge that you can use to make predictions as to where price will be in the future. And let's face it, in trading, this is basically what we're doing. We're trying to predict when and where price will be in the future. And how we do it, and which tools we are using, and how we interpret the market, this is what I'm going to show you today. Now, real quick, who is this guy, quoting the Wolf of Wall Street, talking about predicting the markets? Well, real quick, and Anthony, thanks for your introduction. My name is Daniel Sinnig, here on the right-hand side, and I am one of the founders of tradingindicators.com. We are headquartered in Montreal in Canada. I myself, I'm from Germany, as you probably can tell by my thick accent, but I moved to Montreal about 20 years ago. And about 10 years ago, we have started tradingindicators.com, and as you may imagine from the name, which Trading Indicators is a platform specializing on innovative trading indicators. This is really our bread and butter. We've built thousands of those for clients all over the world. We've seen it all. We've built for TradingView, for NinjaTrader, for MT4, MT5, TradeStation, Thinkorswim, Modifwave, Metastock, and so on and so on. So we've seen it all, and of course we've built many indicators, some good, some not so good, and some amazing. And some of these have become our what we call flagship indicators, which really have turned our trading around and the trading of many of our clients. And what these flagship indicators are, how we use it to predict the market or where price will be in the future, this is what we're going to discover together today. Now, real quick to my background, as you can see here by this title, I used to be a professor in software engineering here in Montreal. I was doing research in software engineering. I was teaching in and around Montreal in software engineering, software requirements, software design, all these, programming, of course, as well. But you know what? During all these years, I was also fascinated by the world of finance and the markets and how you can make money in the markets. So what I did back then, this is many years ago, I started trading on the side. I'll play some trades here and there. And of course, as you start out, and I'm myself also a victim to this, you tend to make all kinds of mistakes. And so did I. So I took too much risk, of course. I overtraded. I traded when market conditions were simply not right. And after donating quite a bit of money to the markets, I came to the hard realization, oh boy, trading is not as straightforward as I thought, and I need help. And for me, needing help meant I need better tools, which will help me make better trading decisions. So I rolled up my sleeves and I started coding. And the very first indicators back in the day, which I've ever written, they were exclusively for my own purpose. But once I realized, hey, these indicators actually do make a difference to me. They actually do help me make better trading decisions. Then I thought maybe others could also benefit from these indicators. And this is really how the story behind tradingindicators.com started. All right, but enough about me. Let's talk a little bit about what we're all here for today, about how we interpret the markets and which indicators we are using right now to make these forecasts. Real quick, just a reminder that if you trade FX, futures, stocks, and so forth, keep in mind that trading does contain risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is money that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, or really anything based on historical data, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and strategies and trade setups discussed in this webinar should not be construed as trade advice. These are for educational purposes only. All right, so with this out of the way, here's what we're going to be doing today. Well, I will do a little bit of theory. I think it's important just to for you to understand of why we've set up the way we have set things up. It's important. It's not going to be too long, maybe 10 minutes, and then we're going to jump right into our 3 most powerful setups, and then we're going to go to the live charts right afterwards, looking at our liquidity IQ indicator and how it can help us to make predictions in the market. Sounds good? Let's get into it. And one more thing before I forget, if you have any questions, please don't be shy. Put these questions into the Q&A box or the chat box or whatever is available on your webinar tool. I will take a look at those, and I will be happy to answer these questions as we proceed. All right, let's get into it. First off, who agrees with me that oftentimes, I guess most of the time, in fact, charts seem to be quite unpredictable? Like this chart here. Look at this one here. An uptrend shortly reverses into a downtrend, only then to go up into an uptrend again. Quite chaotic, almost erratic. Really hard to make sense of what is really going on here. And we suffer from this as well. Some charts, just by looking at them with the, in quotes, naked eye, can be confusing. But guess what? This is what really turned our trading around. Every single chart, it doesn't really matter what it is. It could be a tick chart, a 5-minute chart, a daily chart. It could be a futures chart, a stock chart, an ETF. It doesn't really matter what it is. Every single chart has so-called landmarks, which are hidden levels of price to which price will react in the future. This is important, in the future, in a certain way. And if we are able to identify where these zones are, where these landmarks are, we can indirectly make predictions of how price will react to them and where price will be in the future. And remember, trading is all about forecasting where price may be in the future. This is what we want to do today. This is what I'm going to teach you today. Now, let me give you an example, a very abstract example. Let's look at this hypothetical chart here. So what do we see here? So back in the day, let's say a couple of years ago, it doesn't really matter. It's an example. Price made an historical high. We can see here price came up and then came down again, but this was the historical high back then. Then price came down, came up again. And then here we have a series of swing lows. So price came down, wicked up again, came down, came up, came down, another swing low, and then came up again. So these events, historical highs or multiple swing lows or multiple swing highs, and many other things, they can create, in some cases, important landmarks. And what do I mean by important landmarks? Because oftentimes price will revisit these levels in the future. And once again, in the future, this is important because we want to find tools and techniques which have relevance moving into the future. So for example, here in this very simplistic example, we can see price is reapproaching this historical high and seems to be bouncing off from this level and going lower again. And where does it bounce to? All the way to the level made by this series of swing lows and bounced up from there again. So there seems to be some significance to these levels. Okay. Now, we're not the first ones to discover this. This is a concept which has been out there for many, many years. And some people, give them interesting names. Very common names, such as, for example, support and resistance, or perhaps liquidity zones or liquidity levels. It doesn't really matter what you call them. What's important is that these landmarks exist and price may react to them in a certain way in the future. Now, let's say we are reusing these concepts of support and resistance. Then, we could try to investigate a little bit more, like going into theory. Why is that? Now, who is in charge of creating these levels of support and resistance? What is happening in the market? And of course, every theorist in finance will tell you, okay, a support level is created when demand exceeds supply. You can see it here, price goes down here, demand exceeds supplies, price will go up again. Goes down again, demand exceeds supply, goes up again. So something is happening down here at this level, preventing price from going further down. And oftentimes this happens because big block buy orders are coming in, driving the market upwards again, and the price pivots to the upside. Same for resistance, big money sell orders, block sellers are stepping in, preventing price from coming further up, and price instead will turn and pivot to the downside. Now, you may say, okay, this sounds like theory. What can I possibly do as a retail trader to influence the market in this way? And you're absolutely right. You can do absolutely nothing about this because these levels, these price pivots, these are not caused by us small retail traders with our small orders. These are caused by the culprits, the big money traders, the institutions, the ones who have the buying power to move the market in this way. But, and now it gets interesting, while these big players, they are calling the shots, what we can do as retail traders is we can follow the patterns and profit in the process. If we are able to spot where these key levels are, we can estimate how price will react to them in the future and find promising trade setups in the process. But of course, the question is, and we're going to get to this, how can we find these levels? But let's just assume for 1 second, let's say we know where these levels are. We know where these levels of support and resistance already are. Well, if we do, we can then predict how price will react to them. This brings us to our next topic, and we're going to get very practical very soon. The next topic is, what are my favorite setups? My 3 most interesting or my 3 most powerful setups. Well, here we go. First off, this is what we call the bullish bounce trade. You can see it here. Price is in an uptrend. Let's just assume it's an uptrend. Price has been going up for quite some time, but then retraced down to what we call a support level. And of course, support is called support for a reason. And oftentimes when this happens, price will bounce off the support level when some other factors also come together towards the upside, towards the middle, in between support, this red line here, and resistance on top. So you can see a price came down and then bounced to the upside. That's one setup. Another setup, which I like to trade a lot, in fact, I just opened up a trade with this setup, is what we call the zone break setup. In life, nothing lasts forever, but also in trading, unfortunately, nothing lasts forever. At some point, every support level, these red lines, or every resistance level will be broken. But when this happens, also new opportunities are opening up for us. Because in this case, we could simply, of course in quotes, simply trade in the direction of the breakout. So for example, here support is broken to the downside. You can see this red line has been broken to the downside, and then price is continuing in this direction. That's a classic breakout move. And we as traders, if we are able to identify these breakouts, we could simply enter in this breakout direction, anticipating, yes, price will continue to move to the downside. This is our zone break trade. And we have one more trade, which I'd like to discuss with you, which is kind of a combination of our bounce trade and the zone break trade. We call it the zone break retrace trade. Sounds super complicated, is actually quite simple when you think about it. So what's happening here? Price in this particular example broke above this green line, which is resistance. You can see it here. Price went above this resistance level, went up initially. You can see price comes up and comes up, but then it turns around, it pivots, and it goes down again. And then it stops where? Right at this broken former resistance level. And we probably have, or you've probably heard it before, when resistance is broken, what happens to it? Well, it changes its role. Resistance becomes support. That's exactly what happened here. Price stopped almost magically at this level and then continues in the direction of the original breakout. And oftentimes, these setups can be a nice launchpad for another massive move higher. Now, these are my three favorite setups, which I trade all the time, either from a swing trading point of view or from a day trading point of view. Now, of course, the question now is, how can we spot these lines of support and resistance? How do we know where these levels are? Well, guess what? You may have guessed it already. We have developed an indicator specializing on exactly this, on detecting where these key levels of support and resistance are. And we call this indicator the Liquidity IQ indicator. And it's on every single chart that we open up. It doesn't matter what we trade and what kind of trading approach we're following. This indicator is the only indicator which is always on my price chart, no matter what. Why? Because it shows me these super important levels on the chart, which will help me to make sense of an otherwise almost erratic chart. It will help me to make predictions about the future. For example, price to be bouncing off a level to the downside from a resistance, or the same from support to higher price levels, and so forth. This is the only indicator always on our chart. Now, enough theory. Let's look at some charts together. All right, so I'm going to switch over to TradingView, and just in case you were wondering, yes, our indicators will work for TradingView, but also for many other platforms like Thinkorswim or MotiveWave or NinjaTrader and so forth. We're going to talk about this in just a bit. Okay, so what do we have here? I'm going to start with a swing trading example, just to keep things simple. Let's ease into swing trading. I know the speaker before me talked about the SPY, the S&P 500, or the ETF that tracks the S&P 500. Here we have a daily time frame opened up with no indicator right now on it. What we can see here, and you probably know about this if you follow the market a little bit, we can see prices kind of stalled out a little bit in the last couple of weeks. This is a daily chart, and we came even down a little bit. And to me, and we talked about this in our trading room quite a bit, to me, this in fact did not come as a surprise at all. In fact, we have warned our users, hey, be careful. Yeah, if you want to go long here, maybe prices will stall out a little bit and perhaps correct a bit to the downside. You may now ask, why did I talk about this? Well, it's because of this indicator, which I will be enabling right now. Check it out. This indicator told us, once it's loaded, just takes a little while to load. It's a very complex indicator. This indicator told us, well, by means of this greenish box here in this little line, you can see it here. Well, we are approaching a key support level. This is when price came up to this level here. Key resistance level, my apologies. We're approaching a key resistance level from where price may have difficulties to push further up. And guess what happened? Yeah, we knew about this level back here on November 24th. This is not drawn after the fact. Price came up to this level and then turned around, pivot to the downside. And we warned our users in our trading webinar a couple of weeks ago. Yeah, be careful with your longs in the SPY. You know, selling puts or whatever you want to do. This might not be the right time to do it because we are approaching a key resistance level. Okay, so price respects these levels a lot, key resistance and also key support. Look what happened down here, just to give you a bit of an idea. Back here on November 20th, look what happened. Price also came down a bit. And where did it stop? Exactly at this red line here. This is a key support level. Price came down to support and then pivoted to the upside again. And I personally, when this happens, I sold some puts at this point because I thought, hey, this is going to be the bottom of this correction. There were some other factors as well, which we're going to cover in just a bit. And I believed, okay, the S&P 500 will turn around again, and this bearish correction will complete, and the overall bullish trend in which we are in, of course, in the SPY will resume. Of course, also we had a big high volatility bar here, which made these puts expensive, which of course is in your favor when you are selling puts. All right, so this was the SPY, and I want to show you two more things. First off, our indicator specializes in drawing these key levels. We already know this, but it does a lot more. We're gonna ease into these features step by step. First off, it has something called mentor mode. I had disabled it. I'm going to enable it right now. When mentor mode is enabled, give it a second, it will annotate your price chart with everything noteworthy. I sometimes have it disabled just because I already know it so well. I don't need these labels anymore. But for those of you who are starting off with this indicator, this can be really useful. For example, what does it annotate? Let's just have a look here. A zone break. Look at this one here. Back in June this year, we broke above a key resistance level. And look what happened afterwards. What a move afterwards. This is our classic zone break setup. The price just, really blast off after a zone is broken. Down here, it labels support zone, this reddish area. This is our support area, which oftentimes prevents price from coming further downwards, and instead price will bounce off this level towards higher price levels. Here we have a resistance level, resistance zone. Same principle. Price is bouncing off this level, but in this case to the downside, respecting resistance. And we have something called a liquidity capture event, which oftentimes are events where, you can see this little shaded area here, where the odds of having a bounce are further amplified rather than a zone break. We're going to talk about this a bit later. Okay, so this is the SPY. Let's check out some other charts. So the QQQ, the NASDAQ 100 ETF. What are we seeing here? All right, the indicator will be loading. Just a second. We can also hear price very similar. Here we had a zone break. You can see it here. Back on September 12th, price went up, but then came down again. And guess where it stopped? Exactly at this former resistance level. You can see it here. This was resistance, came down to it, and then it moved further up. And then came all the way up to this new resistance level. You can see it here and bounce off it again. And now we're kind of in the middle, in between support and resistance. One more example, gold, GLD. And then we're going to look at some short-term charts as well. What do we see here? Well, let the indicator load. What do we see? Well, gold right now, this second, well, not the second, but today at least, actually for the last couple of days, is where? Right in this resistance level. Do you think it's a coincidence that prices have been stalled out a little bit in gold? Kind of went flat? In my view, it is not, because we are right in this resistance level. And I would not be surprised if we do see a bit of a bearish bounce off this level in the next couple of days. So gold has stalled out. Let's look at silver. We'll talk about silver a lot. Silver has been blasting off quite a bit. And look at this. Silver did not stall out. Today is a bit of a down day, But overall, silver did not start out. It continued higher. People often say gold and silver are correlated. Well, they are oftentimes, but in this case, they were not. Why? Because gold was facing resistance. Look at this one here. We had resistance, whereas silver, back to silver, had nothing. There was no level above silver, nothing to hold it back. That's why silver continued to push higher and gold stalled out a little bit. So I hope this gives you a bit of an idea of how important the knowledge of where these levels is can be to trading. And not just to swing trading, these were all swing trading examples. Also, this can also be important to day trading. Let's check something out. I'm going to switch context now. So we looked at swing trading. Now let's switch context to day trading. All right. So what do we see here? Well, this is actually a textbook example of what happened today in the market. This is a 50-minute chart. Okay, look what happened. So we opened up bullish. You can see it here at 9:30. Prices pushed up. They pushed up higher, but then they kind of stalled out. And guess why? Once again, same principle. Let me just enable mentor mode. All right, same principle. We start out because, as soon as the indicator loads, because we hit, guess what? A key resistance level. We came near to it and bounced off this level of resistance. And then, look what happened. We came down. We had a big bearish bar at noon today. I was watching the market very closely. And guess what happened afterwards? We came down all the way to this support level, which we knew about. Let me just have to go back from here. Back on Wednesday, December 17, we knew about this level. That was yesterday. About this key support level. Prices came down to it almost to a T and bounced off this level towards the middle in between support and resistance. This is the power of knowing where these levels are. In fact, if you look at my trade alerts here in TradingView and my log file, we can see here that MES at 12:45, we did have, or a bit earlier even, we did have an alert alerting us, hey, for the micro S&P 500 futures, I forgot to mention this is the micro S&P futures, we had a bounce case with a liquidity capture. Liquidity capture means this candle, which wicks down into support, also has abnormally high volume. And oftentimes, this can be a sign, it's a bit agnostic, but to us at least, it's a sign that, hey, something is happening. Somebody's driving up the volume. Somebody's submitting big block orders at this point, potentially driving price further upwards. Remember when I talked about these big block orders coming in, preventing price from coming further down? These liquidity capture events, these can be the footprints of these ones. So just keep this in mind. All right, so this was the MES. Let's look at gold. What's happening in gold? MGC. Let me go to my watch list here. There we go. All right, so what is happening in gold? All right, let's see what's going on here on this particular chart. It's loading. Okay, here it's a bit more complicated. Here the picture is not as clear, but we can also see that, okay, this level up here, for example, this green level, this resistance level, this has given price a bit of trouble. You can see price came up to it. We have a bunch of liquidity captures, and then we came down again. And up again, some liquidity captures, and came down again. Interestingly, however, remember how I mentioned that these liquidity capture events, oftentimes they amplify the odds of having a bounce of the level rather than a break? Look what happened lately here. When we finally broke the level, we came up a bit. Then, of course, we came down a little bit, but there was no liquidity capture. We just broke above it with none of these extra high volume bars. And oftentimes, you can interpret this, hey, nobody's really stepping at this price point. Price is let to go above this level. Nobody's stepping in with big block orders, preventing price from coming further down. But these insights, they have become so important to our trading that we cannot trade without this indicator anymore. Now, I'm going to quickly back up and go back to my slides. And of course, if you guys have questions, I'm not sure if there are questions in there. Let me just maybe pop out something here in my tool. I'm going to check these out a bit later on. Okay, perfect. All right, so back to my slides because I want to introduce one more concept, which will complete this entire mix, which I'm showing you right now. So what we've seen so far is our liquidity IQ indicator. We call it the instant charting assistant, because it shows you right off the bat, as soon as it's applied to your price chart, what is important, what are key levels, Now, what are key events like zone breaks or liquidity captures? Right off the bat, so that you don't have to worry about this. All right, but there's more, because we have also developed a second indicator called MA Rush, which complements Liquidity IQ in a very specific manner. Now, before I talk about this indicator, let me ask you guys, have you heard about this proverb called "the trend is your friend"? Until then, of course. Probably the answer to this is yes. You probably have heard about this. Now, if so, you probably also potentially have heard that it is easier most of the time to trade with the trend than against it. You probably agree with this statement. The chances that the trend will continue are simply higher than the odds of the trend reversing. That's a fact of the market. Well, we have developed an indicator called MA Rush, which will show you directly on your price chart what is the current direction of the trend. And it complements the other indicator, Liquidity IQ, perfectly. Let me give you an example. So back to the price chart. There we go. I'm going to go back to my to the SPY on the swing trading time frame. There we go. And now what we're going to do is we are going to add another indicator to it. And this is this one, MA Rush. You can see it here. It will take a second to load. And once it loads, it's going to zoom back a little bit. It will, first of all, color these areas very nicely and beautifully. But more importantly, it will also show you, to go back quite a bit, what is the current trend direction. Of course, this here is the SPY, the S&P 500. Of course, the trend is bullish. And we can see it here by this indicator. There's a bullish label with the timestamp May 16, 2023. This is when the indicator recognized, okay, this bearish trend, which was predominant before, has turned around and we've been bullish ever since. And I use this indicator almost all the time to further filter my setups. What does that mean? Well, for example, let's say, okay, we're bullish. You can see it here. But let's say, okay, we are coming up to this key resistance level. You can see this little green line here, or bluish line. That's resistance. Price is coming up to resistance. And I could ask myself the question, okay, maybe I want to go short here, betting on the fact, okay, price will bounce off this resistance level towards lower price levels. But now, what I like to do to further increase my odds, I like to check, hey, what is the prevailing trend direction? And am I in line with this prevailing trend direction? In this case, for example, the answer is clearly no, absolutely not. In this case, price, this is a bounce setup, which would be a bearish move, but the trend is bullish. They don't agree with each other. So I probably would have skipped this short trade because it's against the overarching trend. Similarly, let's look at here. What happened here? Price came down to this key support level. It's a bit hard to see, but it's there. This red line here, that's support. It came down here, and again, I can ask myself the question, hey, do I want to place a trade here? Do I want to bet on the fact that price will bounce off the support level towards higher price levels? And in this case, I would have said, yes, absolutely. Why? Because it's also in line with the trend. The trend is bullish, and the setup is bullish as well. Two things are coming together, predicting the same price move. All right, so this is what happened here. And in fact, I did action on this with selling some puts. There's always different ways to engage into a trade. In this case, the options trade was the one I wanted to do because puts were expensive. That's always a good sign to sell puts when the volatility is very high. Up here now, did I go short when price approached this resistance level? I did not, because it didn't fit my trading paradigm where I only trade when everything comes together. I want, here, this is a short setup in a bullish trend. I didn't do it. Of course, I could have made some money here, but I'd rather skip these trades. I'd rather miss out on a good trade than being caught in a bad trade. And sometimes, and not taking a trade in the first place is the best trade advice that you can get. Not always, of course, but oftentimes this can be the case. So let's look how this could have worked for day trading. Back to our day trading time frame. What do we see here? All right. So it's loading, and I'm going to add now our MA Rush indicator to it. Let's see what the trend would have been. Let's check it out. Okay, it's loading. This is day trading, and we can see here, okay, our indicator here is bearish. And of course, we've seen this on this 15-minute time frame. We've been in a bearish move for a couple of days now. Price has been grinding a bit lower, mainly because we're hitting overhead resistance on the higher time frames. But the trend is bearish. So this would mean to me, okay, I probably would have not taken long trades here when price is approaching support. Instead, I was waiting for a zone break and then potentially enter in the short direction. Or when price is coming up to resistance, I definitely would have considered shorts here, because this would be in line with the overarching trend direction, which is bearish right now. This is also why I didn't take any longs here when price came down here, because it would go against my trend. Again, it would have worked out nicely. Of course, these levels are important. Oftentimes, price does react to them anyways, but not always. And I like to trade when the odds are stacked in my favor. All right, so let's have a look at where we are. So now it's 1:20. And Anthony, how much time do I have in this presentation real quick? Can you give me a quick heads up on this? If you do have a bit of more time, I will come back to the charts. But if we're running out of time, I'd like to let everybody know right now how you guys can get hold of these indicators, which I just showcased you. So
you have
all right.
10 minutes. Yeah.
Oh, 10 minutes. Perfect. Yeah. Okay. So I'm going to show everyone how can you take advantage of these two indicators, Liquidity IQ and MA-Rush. We call this the dynamic duo because they complement each other so nicely, like Batman and Robin, kind of the way the Liquidity IQ is our Batman indicator. It's so badass. It finds all these key levels, which will help you to make these powerful predictions. And MA-Rush is the assistant to it. It helps you filter these setups even further by looking at the overarching trend direction. Now, how can you guys get hold of these indicators? First off, of course, we have these indicators for TradingView. You've seen them on TradingView. They look beautiful on TradingView. We most of the time trade off the TradingView platform. But these two indicators, they work the same on NinjaTrader, on ModifWave, on Thinkorswim, and on MetaTrader 4 and 5. So if you have any of these other platforms, no problem. You can take advantage of these indicators. So normally, Liquidity IQ alone, this is for life. What I'm going to show you right now is for the lifetime package. Liquidity IQ alone has a price tag of $1,297. And you get this indicator for life. And I promise you, this indicator will pay for itself, period. The indicator, as you've seen, will show you these smart support and resistance levels directly on your price chart, along with some other important events like liquidity captures. We talked about these big block orders coming in or zone breaks. But we thought, as a big thank you for being here today at the Traders Corner webinar, at this event, we're going to throw in 6 additional bonuses. And one of them is my favorite one, but I'm going to get to it. Bonus number 1, and you probably would have imagined, it's our MA-Rush indicator. You're going to get this indicator free of charge for lifetime access. Secondly, you will also be, and this is a typo, you will also be invited to our next live trading workshop. It's not today, we just had one. It is scheduled for January 5th. I'm sorry for this typo here. January 5th is our next live trading workshop. And guess what we'll be doing in that workshop? We will be using these two indicators and our real money account, no demo account, to live trade the market open, primarily in the futures space, but also some stocks. Scheduled for January 5th. So this is a typo here. You will be invited to this workshop. You can observe how we configure these indicators, how we look for setups, how we set up alerts, all these things that you need to be effective with these two indicators. Bonus number 3 is an invitation to our exclusive live member sessions, which take place every single Tuesday at 12 p.m. Eastern time. And by the way, all these webinars, these are recorded. So if you miss one, no problem, you can watch the recording afterwards. So our exclusive member sessions take place every single week on Tuesday, a great outlet for anyone to ask questions, to learn tips and tricks, to see how we evaluate the market right now, and so forth. Bonus number 4 is an ebook on MA-Rush, the trend indicator. We also have a video guide on how we trade with magnet zones, the concept which I didn't even talk about today, and a second video on how to trade with MA-Rush and Liquidity View together. So all these 6 bonuses will be added to the package. But there's one more thing. On top of all this, we will also slash down the price tag from 1,297, which is actually much higher with all these bonuses, to only 997 today. And all you need to do, and Anthony, if you can, please put this link into the chat box, is to go to tradingindicators.com/IQ. So we call this the IQ indicators, consisting of liquidity IQ and our MA rush indicator. This is available for a limited number of packages, so don't wait too long. A unique offer, which we normally don't offer, available only today at tradingindicators.com/IQ. So check it out there. I'm gonna put also this link. Let me see if I can find the right. Oh, there we go. Is it in there? No, that's not right yet. Let me just quickly put this in here. How can I, all audience? So I'm gonna just copy and paste this link in there right now. So the Liquidity IQ Super Package. 1 second. There we go. Perfect. So the link is in the chat, and this package will allow you to get these two indicators along with all these bonuses for a special discounted price for life. No single follow-up payment is required afterwards. Now, what's in the package real quick? Of course, our Liquidity IQ indicator, which shows you all these key levels, which are so important to predict what may happen in the market next. That's included. Secondly, you will also get our MA rush indicator, the perfect companion to Liquidity IQ, helping you to filter your setups by trend direction. The indicator finds the trend direction automatically for you. We even have some users in our trading room who exclusively trade by these trend changes. They go bearish or short when they see a bearish label, and then they reverse the position when they see a bullish label. Now we've back tested this. This can be also very effective. That's included. And as I mentioned, January 7th, that's next year, Wednesday, when the market is back open, we will have our next live trading workshop where we will live trade with our own real money account, no demo account, the futures open, the cash open. Jan 7, that's a Wednesday at 9:30 a.m. And of course, this one is recorded as well. And we will be using these two indicators to find our trades. And thirdly, you will also be invited to our exclusive trading sessions every Tuesday at 12 p.m. Eastern time. Also, these ones are recorded, and you will get access to our Discord channel where you can ask questions, we can bounce off ideas, we're posting lots of charts in these sessions and so forth. So all this will be included. Now, let me see if there are some questions. Okay, there's a question. Is this indicator based on volume profile from Meyer? No, it's not. We do take into account volume, but not in the sense of a volume profile where we look at how was the volume at a certain price level. We will look at volume over time. For example, which bar, which candle had the most volume. We'll use that one. All right, so the answer is this one. Okay, let me see if there are some other questions. And before we close, so if you have questions, guys, please don't be shy. Let me just quickly go back to my price chart to see if I can spot an interesting setup here approaching. Let me just give me 1 second. I'm gonna go through some of the charts which I'm seeing here, because there's one more feature, one really cool feature, which is also very powerful. Okay, I'm gonna look at this one here, Platinum Futures. Let's check it out. So I'm gonna go back to my chart here. I'm gonna open up Platinum Futures, PL. What do we see here? On the 5-minute time frame. I hope this is the right one. Let me just quickly see. Just loading. There we go. Okay, so we can see right now, Platinum Futures does have a zone break right now. You can see it here. We're breaking above this zone of resistance in Platinum Futures, which by itself can be an interesting trade. But what you can also do, just bear with me for 1 second, you can ask the indicator, hey indicator, show me right now in an info box, what is the current setup? And as this loads, I hope this is, there we go. The indicator will tell you, okay, right now, we are in a long break scenario. We're breaking above resistance. If you were to trade this, your stop loss would be at 1950, which is basically around this level here, right below resistance, and your target at 1,997, just below the psychological level of 2,000. This is also what the indicator will tell you. And one more thing, and I'm going to close this presentation. You can even visualize these levels if enabled directly on your price chart. Check this out. So just enable those. I typically have it disabled because I want to keep my chart clean, but if enabled. And once loaded, you can see directly on your price chart, hey, my stop will be here at 1950 and my target right here at 1996. The indicator will give you all this information. In this case, a reward to risk ratio of 2. All right, perfect. So I believe, Anthony, this also brings me almost on the tee to the end of my presentation. It is 1:30. So I thank everyone for being here today. I hope you got something out of this presentation. If you have any questions which we didn't answer, you can always reach out to us at tradingindicators.com, our homepage. Go to contact there, or click on support, then contact, put your question into the contact form, and I will answer every single question personally. With this, guys, thank you so much for your attention. Have a great show, and hopefully see you soon.
Thank you, Daniel.
Yes.
Thanks for that insightful presentation on liquidity zones and price action. Daniel has also provided a holiday special offer, and he's posted the link in the chat. Thanks again, Daniel. We appreciate it.
Thank you, guys. Bye-bye.
Thank you. All right. Our next presenter is Lawrence McMillan of McMillan Analysis Corporation. Larry is one of the most respected voices in options analysis, and today he'll be sharing his current market outlook based on what key option indicators are signaling right now. So please welcome the great Larry McMillan.
Thanks. You see the screen okay? You hear me all right?
Yeah, we can see it.
Okay, good. All right, so we're going to spend a little bit of time talking about what the option market thinks of this current market we're in. Just a little bit of a background. We manage money. We started out actually as a derivatives research firm. That was a while ago. And then we also do a certain amount of option education, including webinars like this and mentoring, etc. All right, so I'll come back to this later, but the PDFs of this presentation will be available, and they will be, I believe, sent to you. You don't have to download them. I say PDFs because one is black and white and the other is color. If you're going to print it out, you probably don't want to print the color version. All right, so let's get started here. So the one most important thing that we look at is really the chart of the S&P. I mean, this year, S&P has just been since April in a huge bull market. Sometimes we've seen other indicators roll over to sell signals, but it really hasn't halted anything until perhaps just recently. We'll take a look at the equity-only put-call ratios. It's a very important and useful way of analyzing the market. We'll look at market breadth. That we have an option-oriented way of looking at that, and then we'll look at VIX, the volatility index, and various things related to the VIX index. So I have a couple of rules. One is oversold does not mean buy. So an oversold market can continue to go down for quite a while. You know, you can be on alert to buy, but we really don't buy until we get confirmed signals, and oversold is not a confirmed signal. The corollary to that is overbought does not mean sell either. So this market was so strong that in certain ways it's been overbought really since maybe June, but it kept on going for quite a few more months after that until just recently slowing down. So here's the long-term chart of the S&P. Nothing too unusual on this chart. We're in, we at the bottom of the 22 bear market, basically October of 22. We started upwards on that sort of gentle slope here, as identified by the blue line. We've had a couple of sharp corrections, mostly of the mild variety, but certainly not in April. That was a wild 21% decline in a month and a half, and it was really pretty ugly. But we bounced back from that, and now we've come up here and entered into a trading range. Really, we got to 6,900 there in late October. We've tried to go through it a few times, haven't been able to. And on the downside, we've tried to penetrate and test 6,500 several times, and we haven't been able to go down through that either. So the broad trading range is 6,500 to 6,900. If we zoom it in, This is a 1-year chart. You can see that there's been a tighter range here in the last few weeks between roughly 6,800 and 6,900. And even though we broke down below that this week, there was no follow through. We have a pretty strong day going today. So now SPX is right back up inside this trading range. The purple circles there are gaps on the chart. Not all gaps have to be filled. Most recent one was filled just this week. That's the one here at at 6,900. Well, actually, the gap was at 6,750. But there's some old gaps back there in April when the market was really taking off to the upside. Those certainly don't have to be filled and probably won't be filled. So, just the way we're looking at the S&P chart right now, sort of neutral. I mean, it's in this trading range. It hasn't been able to break out on the upside or the downside, and even this attempt to break out of the smaller range this week doesn't seem to have worked either. So if we do get a breakout, obviously we would trade it and expect it to continue for a while. But right now the nearest support is at 67.20. So if we were to close below that, that's yesterday's low, that would probably engineer a move towards the 6,500 support level, which had been tested 8 times since mid-September. Meanwhile, on the upside, the 6,900 has been pretty formidable as well. Actually, 6,920 is the actual intraday high. So I'd look, if we were going to trade an upside breakout, I'd want to see it close above 6,920 at least 2 days before we take a new position based on that. Another thing we do with the S&P chart is we draw modified Bollinger Bands. You may be familiar with regular Bollinger Bands. When John Bollinger invented them, he needed a definition of realized volatility, so he used the standard deviation of closing prices, and that certainly seems logical. But the math guys, the Black and Scholes, etc., they use the standard deviation of percentage price changes, and so it's a little bit different. But since we're in the option business, we need our implied volatilities that are coming out of the Black-Scholes model to line up with the realized volatility, so we calculate it that way. In any case, we draw bands around the S&P, and right now you can see this is the 4 standard deviation band right there, and then just inside that it's the 3 standard deviation band. So if we get a move outside, as we did back here, and then back inside, that's a sell signal. That sell signal was terminated when it traded down and touched the -4 standard deviation band. Now all those blue letters were unsuccessful signals. So this has really been over the years a very reliable indicator. But this time on the way up, because the bands were really kind of tight, realized volatility was very low. It was able to exceed the upper band a few times in a rather meaningless fashion. But we have a trading system built around it, so we took just a small loss on those. But now the bands are quite far apart, because once we had in early October, you may recall when President Trump was talking about tariffs on China, the market had another tariff tantrum, as they call it, and that increased realized volatility, and it's still stayed pretty high all this time. So the bands are pretty far apart, and right now we don't have a signal based on this indicator. But if you take our offer up and take a look at our newsletter, you'll see the long-term signals on this have been quite excellent. So you can apply this same logic, draw the bands, and if you move outside or back inside, you can apply that to any stock, any index, any ETF, futures contract, or what have you. So we have a service that does that. This is the way that S&P chart looks there. This is the service is run on TradingView, and you can see there's that last sell signal, and then here's these other ones that were there. So the sell signals appear as a red arrow. We had a good buy signal coming off the bottom there in April, a little bit late, but again, it's sort of in that realm of, oversold does not mean buy. So by that time, it was all the way up here before we got in. It was a good move though. And so just one I just grabbed here just to look at was NVIDIA. You can see that there was a pretty good sell signal here in November. It came down and it touched the lower band, so that completed that move. It's still not really getting away from the lower band though, and what we need to see is close below the lower band to set up the next buy signal. You can see that was a pretty good buy signal prior to that. All right, let's talk about put call ratios. Put call ratios were invented as an indicator by Marty Zweig back in the 1950s. And for predicting the broad market, we use the equity only put call ratio. In other words, all stock options that trade. So stock options trade millions of contracts every day, but we use that to predict the broad market. Now, when Marty first started out, he was getting his volume from, back in the 1950s, he was getting it from the ads that ran in Barron's every Sunday, advertising for the put and call dealers at that time, and they would sell how many puts and calls they had traded during the week. And he started compiling that data. At first he thought, if there's a lot of call buying, maybe this was smart money, but it turned out it was a contrary indicator. So too much put buying is actually, the market is getting too pessimistic, or speculators are getting too pessimistic, and that's really bullish for the market. And on the other hand, too much call buying is just the opposite. Everybody's getting too optimistic, and so eventually the market will go down. So quantifying what those mean is what we attempt to do. This is how a chart would look. Now, we publish about 1,600 or more put call ratio charts in an area on our website every day called the strategy zone. And each chart has the stock price and the put call ratio, because you really need to look at both. So let's say we have this stock and it's declining here. And as it's declining, people are buying puts. So puts, the put call ratio is just puts divided by calls. So that's in the numerator of the fraction. So as puts are increasing in quantity, the put call ratio goes higher. But eventually, the put call ratio forms a local maximum and begins to roll over. That local maximum is a buy signal for the stock. So now the stock starts to go higher. Move over to the left side. Stock's going higher. As the stock is going higher, call volume is increasing. That makes the ratio go lower. Eventually, you get to a local minimum on the put call ratio, and that's a sell signal for the stock. So that's how we treat it. If you're looking at the chart and you don't see this sort of mirror image, then perhaps something else is going on, usually an arbitrage of some sort, perhaps dividend arbitrage or a takeover or something like that. But in the normal course of just speculating and ebbs and flows between pessimism and optimism, this is the way the charts generally look. Now, this is not a current chart, but on top is the S&P 500, and on the bottom is the equity only put call ratio, all stock options that trade. So you can see the inverse symmetry here, and that's why we use the equity only put call ratio to predict the broad market. So here's the current chart, going back 1 year. So the most recent thing we've had here has been this a local maximum, kind of grudgingly formed and just slowly rolling over. But that is a buy signal, and so we mark that as a green because it's open. Prior to that, we had a sell signal in October. I'm not saying that was the best sell signal in the world, but we did have some market decline in here, and then before it bounced back. And you can see the various other buys and sells. The tallest that the chart got, the highest that it got, was there in April when we had that terrific sell-off. Pessimism bloomed, and eventually we got the local maximum, which was a buy signal very close to the actual bottom in the market. So this is what we call the standard ratio. This just uses the volume of all calls on stocks divided by, or not, the volume of all puts on stocks divided by the volume of all calls on stocks. And we can, compute that across all the exchange, all the American exchanges, which, I mean, I'm not even sure how many there are now, at least 9, I think more actually. Anyways, then when the computer came along, we were able to calculate another ratio, and this is the weighted ratio or dollar weighted ratio. So in this case, we're trying to measure how many dollars are being spent on put options versus how many dollars are being spent on call options. And it treats us the same way, local maximum, local minimum. You can see the signals occur more or less at the same time. You know, we just recently had this this buy signal here, and it's maybe a little more easily seen on this chart. And in the summer or in the April, we had the high all the way up there around 140. What 140 means is that $140 is being spent on puts for every $100 being spent on calls. That's a lot across all stock options, because in general, more calls traded than puts on stocks, and so the ratio is generally below 100. As you can see, it is most of the rest of the time. In any case, that's also on a buy signal. So we have a couple of buy signals working here, which is good, but you'll see as we go along, there's a lot of mixed signals because the market has been in this trading range for a while. So just to summarize that, we had those sell signals in October, they rolled over to buy signals now. And if these ratios would start to move higher again, that would cancel out these buy signals. But right now, they're on buy signals. So this is a longer term chart going back 8 years. And you can, this is way over here to the right is where we just were, was the chart I was just showing you. So maybe, you know, the last year or so is that chart I was just showing you. You can see that back coming out of the pandemic in 2020, the market really got bullish and we got an extremely optimistic market going then all the way through the really 2021 and up until we hit that bear market in 2022. So the put call ratio was lower back then than it is now, or than it was even, you know, just in the last time we were down at the lows. So the extreme optimism that we saw this past, let's say, early October, as was, you know, it could be relevant. Obviously, it was a lot of optimism, but it wasn't nearly as much as we had back there in 2021. Not that it's necessarily, it doesn't mean the market can't, it has to go back to where it was in 2021, but it was there, and it was there for a long time. So what do we buy when we're trading these things? So whether we have a volatility band buy signal, a modified Bollinger Band or McMillan volatility band buy signal, or we have the put call ratio buy or sell signals. We trade SPY options, typically just a couple of points in the money and probably only about 3 weeks out in time. So that option is going to have a fairly high delta. The delta measures how fast the option moves with respect to the stock price. So we're trying to predict where the market's going, where S&P is going. So we're trading SPY or E-minis if you want. And we want an option that's going to react to us, you know, in a timely manner. So if the market goes up and we're long calls, I don't want to have some call that's so far out of the money that I'm going to lose time value more than I'm making on the call. So that can be eliminated by just buying options that have a fairly high delta. Low delta means you're taking more of a gamble. A high delta means you have confidence in your prediction, and you want to trade. You know, you want the underlying and the option to move together. So this, as I said, ends up being a short term in the money, 1 or 2 points in the money for SPY, just a few weeks out. And that option will have a delta of 70 or so. And sometimes if we're looking at a longer term position, perhaps the put call ratio, we'll just buy an at the money. But even an at the money call has a delta larger than a half. And so it will move with the stock as well. Now on TV, you see a lot of the time that the traders they're talking, whether it's traders or mostly it's traders, I guess, they talk about these spreads. They're all wanting to spread. And what that means is they buy a call at this strike and they're bullish on the stock, but instead of just being satisfied with buying a call there, they sell a call at another strike. So between the two strikes, you're great. If the stock is moving up, you're making money, but as soon as you get to the high strike, you cut off your profit potential. Well, that's a pretty harsh thing to do to yourself, unless there's a really good reason. Now, the reason that you might want to do that is if volatility is very high. And we publish free volatility data on our website every Saturday. You can pay for it every day if you want, but there's free volatility data both in terms of historical volatility and implied volatility, and it's there for your use. It just it shows up. I think we actually updates Friday night. In any case, if the options are expensive, the implied volatility is high with respect to where it's been before, then a bull spread can make some sense. But in reality, most of the time, that's not the case, and most of the time, you should not be spreading. Now, the proponents of spreading will say things like, well, you're risking less. That's a completely false statement. What you're risking is 100%. Your broker will ask you to pay for the call in full if you're buying a call, or to pay for the bull spread in full if you're buying a bull spread. In either case, you could lose it all or 100%. So the risk is the same. Now, the dollar risk might be a little different, but you can adjust for that by changing your quantity. But what we're really, what we don't want to do is lose this ability here as if the stock really takes off to make a lot of money. So every time you do a spread, you've got a problem. Now, you can mitigate the negative aspects of a spread in two ways. One is to widen the difference in the strikes. So right now, if we're trading SPY calls, I'm probably just going to buy a straight call if it's expiring on January 2nd or earlier. But if it's after that, say regular January expiration is on the 19th, then I spread the calls 15 to 20 points wide, and then the puts, if I was doing that though, I'd spread those much wider, like 30 to 40 points wide, because the out of the money puts are much more expensive than out of the money calls. So that's one thing you can do. Widen the strikes so that if the thing moves in your favor, at least it will expand as the move is taking place. And the second thing is we roll if the short strike is hit. So what do I mean by that? So today SPY is trading around 680. And let's say you're bullish, but VIX is getting a little higher. You're thinking it's expensive, so you buy the Jan 680 call and you sell the Jan 700 call. So that's the spread we talked about. It has that kind of profit potential, and sure enough, you're fortunate enough to have the SPY go up to 700 before January. So what we do then is we sell that spread that we owned before. It'll be a profit, so we take a profit on that, and we buy a new spread using the Jan 700 call as the long side and the Jan 720 call as the short side. So what we've actually done, we started out with this the black spread here, and we moved into the red one. So we rolled it up, and our profit potential originally was just going to be cut off here at the higher strike when we got up to 700. But now we've released that, and now it can expand up to 720. And if the stock is to 720, you roll it up again. So this has a couple of, I think, decent benefits. One, you're taking a credit out, putting some profit back in your pocket in case a really terrible reversal happens. You will have at least taken something out of it. And secondly, it allows you to keep being bullish on a stock that continues to trend higher and higher. You just keep rolling these spreads up. The pricing right now is not all that favorable. The Jan 680 call this morning was trading at 10.20, and the Jan 700 call was at $2. So that means we would pay a total an 8.20 debit. We're buying for 10, selling for 2. 10.20, selling for 2. So we're paying 8.20, and the best we can do is get 20 points back out of this if the whole spread widens out to completely. I mean, that's okay for an option position, but it's not that great. On the other hand, if we look at puts, let's say instead of being bullish, you were bearish here. So you're buying at the money put, the Jan 680 put. You sell now 40 points out of the money, sell that put. And those two are priced at a way that you're paying $7.50 now, and it could widen out to 40. Well, that's much better. You know, it could widen to 40. I'm not saying it will, but you know, that's just that's much better, and it has to do with interest rates, etc. But and then you would treat this in the same way. If SPY traded down to 640, you'd take your profit on that spread, and you'd set up a new one, moving your strikes down 40 points on each side. Okay, so let's look at some individual put-call ratio charts. These are also interesting too. Now with these, we usually only trade the extremes if possible. So this is brown and brown, and you can see that we just got a local maximum here the other day, actually last week. And the stock has had a little trouble breaking out through this particular area right in here. So sometimes we'll combine some technical analysis with the put-call ratio signal. So that's a buy signal there, but that resistance is at 82. So we're not really going to buy unless it can close above 82. If it can't close above 82, then you know, forget about it. You can see the last buy signal was there a couple of months ago. That really didn't work out too well. But these little ones in the middle here, we don't really trade those because they're not at the extremes. This is a sell signal here on the extreme though, and that was a very good sell signal. Another one is ARC Innovation. This had a really nice buy signal last March, and it was a little bit premature, but the thing got rolling on the upside in April. And then it came all the way to where we had a sell signal in October because the chart came all the way down and it gave us an extreme low there in October. And now we've risen quickly. There's a lot of pessimism blossomed here. I'm not sure why. I mean, I really don't try to analyze why these things are taking place, but there was a lot of put buying that went on while the stock was having this decline. And now we've had a local maximum and a buy signal. So it started out good, but it's kind of fading a little bit right now. In any case, we hold these as long as the put-call ratio signal is in effect. So in this particular case, the put-call ratio is continuing to fall, and eventually it will roll over and form a local minimum, but it hasn't done that yet. So regardless of what's happening with now, if we did a spread, or sometimes we'll roll up if it moves a lot, that option gets say 10 points in the money, we would roll it up to a higher strike, that sort of thing. And we cover all those contingencies in our recommendations. This one's a little bit stale. We had a nice buy signal in gold in August. Then we had another one in November. It was pretty crazy. It just shows you how many people, this little minor correction in the gold ETF produced this huge move upwards in the put-call ratio. In other words, people jammed into buy puts, became very pessimistic on it for really no apparent reason, and then it reversed right back to a buy signal, which is still in effect. You can see the put-call ratio is still falling, so we're still in a buy signal there. Silver was even more. This one's gone off the top of the chart. That's the silver ETF, and again, it's still on its buy signal also. Now we can trade these with futures too. So we draw the put-call ratio chart using the futures options. So this chart right here is using the 10-year note futures options that trade on the board of trade. And then we use the same way, local maximum, local minimum. In this particular case, though, we don't have to trade the actual futures or the futures options. In other words, we don't have to have a futures account. We can trade an ETF. That IEF simulates the 10-year note, and you can trade that future. But sometimes you'll get a signal. Here we just had a new buy signal in orange juice, and there's some resistance there, but if it can break out over there, that should be a good buy. But there is no ETF that simulates orange juice or trades orange juice futures, so you'd have to actually trade the orange juice options that trade on the ICE. They're pretty illiquid. but if you're trading small size, it's probably okay. All right, the next thing I want to talk about is market breadth. Breadth is advances minus declines, obviously. So you can keep a cumulative total or you can keep an oscillator. So we do both. This is the oscillator value going back about the last 8 years. Down low on the chart, those green areas are where it got very oversold. You can see here the pandemic, it was extremely oversold. This is another oversold here in December 2018. Then during the bear market, we had a bunch of oversold times. There were so a lot of spikes. Where's my? A lot of spikes down. I see, lost track of the mouse. Oh, there it is. So we had quite a bit of during the bear market, but now again, not so many. We did have that one there in April, and then during November, we had that correction coming off the October highs. We got oversold, we bought, and now we got overbought, and we just got a sell signal from this indicator yesterday. So this is our very short-term indicator. It does have a lot of swings, and when you have a lot of swings in an indicator, you will have a number of small losses, but it also has some pretty big gains. So right now, this one had just turned bearish. Today's market's kind of all over the place. It was higher, of course, earlier in the morning, so that's going to mean breadth is probably positive today, but we'll see how it ends. And so this is one of the shorter term indicators that we follow. Now, another thing you can do is cumulative volume breadth. In other words, the volume on advancing issues minus the volume on declining issues. This has been much more in alignment with the stock market. Regular breadth has not been all that great this year, even since April. The market has been driven by a smaller number of stocks, so breadth isn't as wide, but those small number of stocks have a lot of volume. You know which ones they are: NVIDIA, Microsoft, etc. So this indicator has made a new all-time high 47 times since May. So that's right up there with the S&P, and they typically move together. If this is making new highs, then S&P will make new highs as well. So this just made a new high last week, December 10th and 11th. So that's a positive thing there. Eventually, you might see a negative divergence. We did have that at the top of the bear market in 2022, but right now there's no such negative divergence here. It's all in line, very positive. So this is on the top here is the cumulative volume breadth, and the bottom is the S&P. I'm just showing the April lows there. That's that dip where the line is showing here. This made a new high, came back and made a new high well before the S&P did. So you could buy S&P here and ride it up to there, just planning on it would match the new highs, and it did. They've both moved much higher since then. New highs versus new lows is something else we watch, and I should mention here too that we differentiate between New York Stock Exchange breadth and another breadth that we call stocks only. Stocks only is all optionable stocks. So it's over 6,000 stocks that have options now. So that's the data set we use to determine what we call stocks only. So this is usually kind of an intermediate term indicator. You can see by the buys and sells on the right-hand side there. They're not all that frequent, but just this last October, November period on the left-hand side here, we started to get a lot of kind of crazy buy, sell, buy, sell, buy, sell. But we finally had a buy here in late November, and we're still on that buy signal right now. So this indicator is positive, and will continue to be positive unless new lows outnumber new highs for 2 days in a row. So let's move to VIX now. I just want to keep the pace going. VIX is the CBOE's volatility index. We can look at the VIX chart and discern a couple of things. First of all, the trend of VIX is important. It should be trending opposite to the market direction. And then also spike peaks are buy signals. The people panic, they buy puts, that forces implied volatility higher, and then the panic disappears and VIX spikes right back down. So this is 1-year chart on VIX, all those B's along the top of the chart are spike peaks. So, you know, in April, crazy VIX went all the way up into the 60s and came back off. But many of these other ones have been spike peaks that are tradable. We have a trading system where we build around these things. And of course, we just had a spike peak buy signal here in late November, just right around Thanksgiving. Now, the trend of VIX is that pink signal at the bottom. VIX is trending lower by our definition, and so that was a buy signal too. So that is a buy signal. So this is, volatility has not really increased that much this week, even this week with the market declining a bit. And so this is a positive. You know, the volatility, implied volatility is taking a positive viewpoint of the market right now. Now, just those are the two signals and how they would be stopped up. We cover these things every day in our daily letters, or every week in our weekly letters. So, but you can't trade VIX. You can use the chart to trade SPY, but VIX itself has futures and futures options, and you can use them for some information as well. Now, one very important thing is the trend of VIX, or I mean the term structure of the VIX futures. If it's sloping upwards like this, in other words, we just list the futures prices. I'll show you an example in a minute. If it slopes upwards like that, that's bullish, and that's the way things go most of the time. But occasionally this happens. It happened last April. It happened a lot in March of 2020. It happened a whole lot in the financial crisis of 2008. When it inverts like that, there are ways to make money, but it's indicating that it's a very dangerous stock market when that happens. Now, we almost had an inversion like that just this past November, about the week before Thanksgiving, but nothing came of it. In any case, here's the way we stood this today at noon, and you can see that VIX is trading at 1596, and the Jan futures, which is the first futures contract that just became the front month yesterday, the Jan futures trading 1810. So if we subtract 1596, it gives us 214. So the futures are trading at a premium. And you can see here that each successive futures contract is at a higher price than its predecessor. So that means the term structure is sloping upwards, and they're all trading at this nice fat premium to VIX, all these premiums here. So that whole picture right there is very bullish for stocks. If you're not, you can get those future prices, by the way, on the CBOE website delayed, but you can also get all of these indices the CBOE publishes all the time during the trading day. There's the 1-day VIX. I mean, that's probably not too useful unless you're trading the 0-day expiration options, but there's a 9-day VIX. There's the regular VIX, which is a 30-day measure, then a 3-month, a 6-month, and a 1-year. So again, today at noon, this is how those were priced. You can see each one is higher than its predecessor. Again, the term structure is sloping upwards. Again, that's bullish. So this is all very positive. And what we watched, you know, it's probably, if you just want to watch one thing, one simple thing, and you look at the front month VIX future, which is now January, and compare it to the second month, which is February. And as long as January is trading below February, which it is right now, 1810 versus 1953, then that's not a problem. That's good. If they invert, then you might have a problem on your hand. And as I said, that happened the week before Thanksgiving, and it really looked pretty scary there at one point in time. The December futures were trading 2 points below November, and it was really the kind of thing you see when the market is really about to break. But it didn't. It had a bad day or two, but then that was pretty much it. So unusual, but that's what does happen. I mentioned realized volatility for our purposes. That's the 20-day historical volatility of SPX. And that got very low last summer. It got down to about 6% and then started to rise. Well, any kind of volatility is rising. That's generally not so good for stocks. So this did eventually get up to about 17. It's now back down to 12, which is sort of normal. But, you know, it was too overbought. There was an indication of an overbought market. Was down at 6. Is better off here when we're at 12. So how's this all add up? So if we look at the various indicators, this is what we had. So the S&P chart, I still consider that to be neutral in here because it's in this trading range. And we don't have a volatility signal, so that's also neutral. On the negative side, we have this realized volatility. I didn't push it, complete negative would be way over here. It's just somewhat negative. That it's sort of still in an uptrend. That's the realized volatility. And of course, the breadth oscillators I showed you, we just got a sell signal from them yesterday. But on the positive side, we've got a number of things. We still have the new highs outnumbering new lows. We have that spike peak in VIX, which happened just after Thanksgiving. The trend of VIX is trending lower. That happened in early December, still in force. Those equity only put call ratios, remember, they had the buy signals there. And then this last thing we just talked about, the construct, the term structure, they're all sloping upwards. So those are all bullish. And we throw in one more thing too, and I'll show you that in a minute. Seasonal, this is a seasonally bullish time of the year. So the trading range is really the most important thing here because I still go back to the fact that the S&P chart is the most important thing to look at. However, the weight of the other indicators is slightly to the bullish side, so I'm still thinking that we could break out to the upside here. Our best chance to probably do it would be before year end because the seasonally positive things end just after January or the beginning of the new year. But there are 3 seasonal patterns that do take place. One is the post-Thanksgiving trade. We didn't really have much of that. That's a week or two after Thanksgiving. And now we're in what's called the January effect, which takes place in December these days. But you may have noticed the small caps are outperforming. That's a very clear sign of the January effect working. And then finally, at the end of the year, the last 5 trading days of this year plus the first 2 trading days of the next year is what's called the Santa Claus rally seasonal period, and that usually kicks in too. So this is just a little bit more weight of the evidence being on the bullish side. Perhaps that's why we couldn't get any follow through on the downside yesterday. It's just enough positive stuff around that. If the market sells off, then people with money are looking at these other things and jumping in. So as I said, we're going to make these this offer of all 3 of our top newsletters, 1 month of each for a total of $99. A normal value of over $642. If you just go to that URL there, you can sign up for that. Regardless, we'll send you the PDFs, and you don't have to take the newsletters all at once. You can take them back to back to back so you don't get overwhelmed with data. But the 3 newsletters are daily volume alerts, which I write every morning. This is all the signals that we've talked about here, plus the occasional takeover. We did have the Warner Brothers takeover before it happened, and we're still holding a position in that actually. Then the Daily Strategist, that's our primary newsletter. That comes out twice a day. And then the Option Strategist newsletter comes out once a week. That's the oldest, and that one will have articles about various things. The others are more or less just trading or data or data. So the Option Strategist, for example, we've been having some real success with earnings, buying straddles on earnings. Sometimes it's just buying straddles on other things when they're cheap. Where there's a strategy we have is called hard to borrow. So these are things you're probably not going to pick up anywhere else unless you really do a lot of work. I really see other people latching onto them too much. And in all these cases, we do trade these signals, and we trade use the weighted put call ratios, which that's rare to see anyone else having that as well. So we have a new website. Just drop by there, browse around if you feel like it. We have a YouTube channel. You can subscribe. There's a market comment goes up there every Monday, and we have a couple of other newsletters too. So See, I see that URL says Traders Corner. I think it's really supposed to be MCM Web at the end of the URL. If you're interested in our money management, you can visit that website. At the bottom there, I will say our minimum account size is $100,000. So I think I just about made it on time. Let me turn it back to you. I don't know if there's any questions or not. Yeah, so looking through the questions here. Okay, I guess that's going to wrap it up.
Oh, thank you, Larry. Really appreciate it here at Traders Corner.
Sure, let's do.
Yeah, thank you so much. Have a great holiday. And
Okay.
thank you for that timely, insightful market outlook. We really appreciate it. Larry has shared a holiday special offer, and I put the link in the chat box for us. So thanks again, Larry, for being here. We appreciate it.
Okay. I hope to see you again soon.
Thanks. Thank you so much. Up next is Dan Gibby of Master Trader. He will tackle one of the most misunderstood areas of trading, and as knowing the difference of when bottoming patterns are buyable or if they are traps. With over 30 years of experience in equity and options trading, Dan specializes in identifying high quality price structures and avoiding costly traps. In this session, Dan will explain why most bottoming patterns fail and why oversold means very little, and how to apply master trader criteria to determine which setups are truly buyable and which should be avoided. So everyone, please welcome Dan Gibby.
Good afternoon. Thanks for that introduction. We have a
Oh, you're welcome.
We have a fabulous presentation here this afternoon because everything we teach is going to be amazing, and breakouts occur in all types of trends, up, down, and sideways. Today we're going to be focusing on a particular type of breakout that's from a bottoming pattern. So bottoming patterns happen after they have been beat up for whatever reasons, who cares? And that leaves what we call a price void, which means that they've had a momentum move lower, they've stabilized, supply and demand has equalized, and now demand is exceeding supply, and there's various tells, as I call them. Tells, it's kind of a poker analogy. I don't play poker, but there's a lot of professional similarities to what poker players do to what we do, in my opinion, as technical traders. This is a snapshot of a one-page summary of our approach to trading anything that moves, any time frame, any instrument, stocks, options, cryptocurrency, futures, commodities, it doesn't matter. This is how I'm going to find opportunity. We are looking for a compelling price pattern. The reason, I mean, we use candlesticks, of course, but people lie. Analysts lie, officers and directors lie, analysts lie. Charts don't lie, as we say. So a chart reflects the sum total of all market participants that have put their money on the line, and that forms a picture that we are trading to be on the right side of supply and demand. And these are our concepts. So give me a price pattern. Then we take that pattern and we say, okay, well, you know, where is this picture in the overall trend? So is it on support or resistance? What is multiple time frame analysis? Are they in agreement to increase the probability of the bias of the time frame you're trading to succeed? Is it showing relative strength or weakness to the broader markets in the sector? You know, we say volume and moving average. You'll see them on my charts here momentarily. We call them secondary because I don't need them. all I need is price action. I need a pattern and in connection with trend, support, and resistance, etc. But we say they help speed up the analysis. And I'll obviously show you that. And that's going to be an important part to trading bottoming patterns. You're going to see, I have a lot of charts here. We'll get through as many as we can in the allotted period. If we just write this down, since we're talking about bottoming patterns, stocks that are beat up, just and if you have software even to do this, but you'll see them once we get through the examples. I want the setup, the breakout of a bottoming pattern to be far from the 200 period moving average, because that confirms that it's beat up. And then I want the 20 and the 50 to flatten out. So that's a visual sign telling me that the selling has eased by definition, because what's a moving average? It takes the closing bar, adds up the prior X bars, divides by that number, and prints a squiggly line. So if the 20 and the 50 are flat, by definition, that's telling me it's consolidating. Now that consolidation could be a consolidation in a downtrend. And I'm purposely going to show you some examples here to say, look, these are bad examples. It's bad price action. There's no tell that it's going to break out, etc. What are the broader markets doing? Of course, we have different market internal levels for both day trading and swing trading. And listen, folks, if you don't have proper position and money management in your trading plan, and trader psychology, which I can kind of summarize that says, look, do you have the patience and discipline to follow your trading plan? That's what trader psychology is in a one sentence to me. So the nut behind the keyboard, our courses can teach you exactly what to do, but it's the nut behind the keyboard based on emotion or lack of experience, lack of knowledge of what we teach, that they're going to do, some things that don't make sense. But that's part of the learning and seasoning process. But everything starts with a solid education. And from that point forward, you start trading very small position size. And then everything's about the seasoning. Like, I'm a private pilot, among many other things. I only have a couple hundred hours of experience. I know many commercial pilots that have over 40,000 hours of experience. Who has more seasoning? I mean, right? That's a rhetorical question. But I've been at this full time for over 25 years, 50 years, if you count my days trading in the Schwab office when there was no internet in the lobby on their little cubicle over lunch. And so I have this unbridled confidence when I see a pattern. That doesn't mean a trade's not going to work. If anybody tells you, oh, I got 99% accuracy, follow me, I got the magical indicators, you know what? You should run, because that's such BS. I mean, we have like an 85% batting average, which I think is just incredibly impressive, because there's some people who think charts don't work and they think it's a coin flip and they trade mechanically, they don't believe in charts. Well, 30 years, 85% is pretty impressive. So, if somebody claims they have a 99% chance, then they would have billions of dollars thrown at them from Wall Street to have an ATM machine. So, there's no pill for you to lose weight, and you can eat whatever you want and don't have to exercise, same kind of thing. These are all just bullish setups. And then you go to the prior slide, and like I said, okay, well, here's a buy setup. Is the buy setup in an uptrend? Is it on major support or minor support at the rising 20? Multiple time frames are in alignment. The sector showing relative strength to the sector in the market. And then I got a high probability trade. So we're not talking about any one of these today, but we have many setups. Today we're talking about bottoming patterns. Let's continue. I said in the intro that breakouts can occur from any trend, up, down, or sideways. It could be a breakout from a continuation in an uptrend. It could be a breakout from a sideways trend. And today we're going to be talking about, again, after a prolonged downtrend, it is stabilizing supply and demand. It's moving sideways for a couple of weeks or months, and then it's breaking out of a bottoming pattern. Here's my little poker guys that you're going to see. Every chart I'm going to show you, I'm going to talk about the tail, because many people say, well, how do you know it's ready? Well, I can't put that. I can't give you a black and white answer. I'll tell you when it's ready when I see it. And that's part of the education, to teach you how to see it also. Here's just some considerations here. Greg Capper, my partner, I've been working with him for 25 years. He's just the best technician I have met in my life. And this is one of his saying. Bottoming patterns are treacherous, particularly if you don't know what you're doing. But you're gonna be significantly more knowledgeable after it's completing this 45-minute webinar today than you were beforehand. I promise you that. So we're looking for these clues to make them not treacherous, but to make them high probability setups. Starting point, see, they're in downtrends. So they failed to make a lower high, so they break the downtrend. That does not mean it's a breakout. It just means that's step one. They broke the downtrend. Like I said, it could be a consolidation to resume the downtrend. We're looking for turns. Typically, it's not required. The charts I'm showing you are mostly going to be on the daily charts today. But when you think you're close, you're on major support, it's down a lot, it's okay to go to a smaller time frame to get in on the turn, anticipating the larger time frame to follow through to the upside. I'm not talking about topping patterns today, but the reverse of everything we're going over today is the same. And particularly, so this is not today's session, but I'm going to give you a gift right now. Write this down. This is a gift. Climactic buy setups. So they're down 5 or more fluid bars far from the 20-period moving average. You're waiting on a turn. Drop down to an hourly chart. I use a 65-minute just so there's an even 6 bars per day. And wait for a breakout on the hourly chart to get into that climo on the daily. I know you can't talk to me right now, but conceptually, does that make sense? All right, so we're looking for something here to give us the, this is old, remember Jacques Cousteau, the investigator? That's the event I'm looking for. I'm looking for clues that it's ready to go. All right, now we're going to just go through as many examples as we can now in 30 minutes. This is our daily chart. This simple. Color-coded candlesticks, color-coded volume. The blue is the 20, green 50, red 200. So notice, folks, I could actually take the candlesticks off the charts. We do not trade moving averages. But the point I want you to visualize is if you take off the candlesticks, I have a long-term uptrend, the 200 MA. I have a short and intermediate term correction or pullback within a long-term uptrend. Now, all three moving averages are converging. What is my tell here? What is my tell to say I am ready to buy this stock? The tell is this red bar was a small little rejection. It closed under two candlesticks rather. The next day it gapped up, traded above this ugly red candlestick. In the term price void means there's insignificant resistance because of the big move down. So here's where it broke down. And here's where it's rebuilding over time. So the entry on this is over the red bar. Share size it with your stop loss under the low of this red bar and manage in between. Now, when I say share size, our spreadsheet, we have 3 different advisory letters at Master Trader, and we just our spreadsheet just assumes a $300 max loss per trade. So the spreadsheet says, okay, if you're entering over the red bar, stop under here. It looks at the entry and the stop, and it spits out the number of shares that you should be buying where you have a $300 max loss per trade. That's right on our spreadsheet. And so you buy there, you manage in between. Now that I have this wide range bar, stop is under this low, and I'm managing in between. I just grabbed this. This is after we entered. Look, let's say we entered at 950, let's call it. You know, just 970, whatever. I don't have the exact number. Look, it went up to almost 13 bucks. We're swing trading. I'm not marrying these things. You aren't going to hear me once say I'm talking about core longs. And we define core longs as holding period from weeks to months. You're not going to hear me say that today. We're traders. Swing trade to us is 2 to 10 days as a general rule. So we were in this 3 days, nice return, off to the next trade. Momentum moved down. It's rebuilding over time. My 20 MA is flat. And you can have multiple tells. Remember I said, I'll tell you when I see it. Do y'all remember the US Supreme Court in America when they were trying to define profanity? And they said, well, you know, or maybe it wasn't profanity, but and the justices said, well, you know, I'm not quite sure how to define it, but I'll tell you when I see it. So it can be, I could be watching bottoming patterns for weeks. So let's start here. Wide range bar, bull 1, 2, 3. Broke down, snapped right back. So this is now an inverse head and shoulders if it breaks this neckline. This bar was a bearish gap down that filled the gap, range expansion, and closed bullish. Do I buy over the high of that bar? No, because there's no, you got resistance. But I'm paying attention now. Now it broke out, went sideways, gap down, small little green bar. Now I'm buying over the high of this bar. This is a closed trade. We track all open and closed trades in the members area for subscribers. We give them the date, the symbol, stock or option trade, and we give the technical setup. breakout of a bottoming pattern at the 20 MA, W bottom and new low plus weekly. Remember I told you on the first slide, multiple time frame alignments it's one of our attributes to support the bias of this. Well, this is beyond today's discussion, but I see the W bottom. How do you see that, Dan? Well, I'll tell you, because 5 bars on the daily is 1 bar on a weekly. So here's my momentum move, here's my counter trend, and here's my new low reversal. So that's a W bottom right here. It's a W bottom, new low plus reversal weekly. We're buying here on the breakout, and we give obviously a stop loss, and we manage in between. So we were in this 12 days, made 15% return on capital. Here's an example, horrible quality. Let's talk about that. Why is this horrible? It just fell out of bed. This has to be news. That's an igniting gap, continuation gap. Has it stabilized? Yes. Still below the 50, 20 MA flat now just because of these bars going sideways. So if this were to break out, I wouldn't mind selling a put spread under support. And that's what we call an income trade, where I would never buy this because it's garbage quality. But if this takes out the high of this little red bar here, I would, and we have a checklist, you got to make sure they're liquid, good premium, no, pending news. I have a whole checklist. But I would be looking to sell the 210s, buy the 200s. That's what's called a bull put credit spread. The net credit received as your potential maximum gain. And as long as it stays above 210 by expiration, you keep the money. It's a wonderful strategy. Look at this piece of garbage. Kind of same, it's the same garbage. But this one couldn't even get up to the neckline. So this one's weaker than this one. So this one put spread, this one 0. I have no interest in you. There's no pattern, no setup. Momentum move, breakdown, igniting bar that closed above all these. Let's just call it above 10 bars. Would I buy over this is what we call a 1, 2, 3 continuation. If you go to the slide that has 9 bullish pictures, this is one of them. One of my favorite setups. Would I, Dan Gibby, buy over the high of this? No. Why? Look to the left. There's still a lot of resistance to get through. But I'm monitoring it. Once this bar closed like this, I am watching you day by day. Deep retracement, still iffy. Gap down. Now I have a closing breakout of these 20 or so bars. Bull 1, 2, 3, but it didn't trigger. It didn't, the 1, 2, 3 is triggering over the high of the 2 bars. It continues to go sideways, bobbling around. My 20 and 50 are now both flats. Now I'm ready for the trigger. The trigger could have been over the high of the stopping tail, but this trigger was a gap breakout. We love gap trading in our green trading room. So I'd probably buy a 5 or 10 minute high, or if it pulled in a little bit intraday, buy setup on minor support. But that's my entry, stop under the low, manage in between. Yeah, Greg, my partner, he's funny. He has all these, I call them capperisms. And on any trade, those 9 pictures, even though we have many more, he says it's the same but different. And that's where you want to get to in your education, is having the knowledge to interpret price action to come to the same conclusion. you're never going to get the identical bars, but the message is the same. Similar to the poker player. It doesn't matter what hand he or she is dealt. They have the knowledge and experience of how to handle that deal. Same but different. Collapsed, new low reversal, breakout, going sideways, red bar ignored, 180 reversal. Actually, I don't have an arrow here, but this would have been a very suitable entry right here. It's called a buy setup after a breakout of a bottoming pattern. See, these red dots and blue dots are pivot highs and lows. We have nothing proprietary. You know, some people try to sell you that bag of goods to try to line their pocket, and you know, that's not our style. We give you everything. We give you everything. So a pivot high is, the way we define it, is simply 3 or more lower highs to the left and the right, pivot low, 3 or more higher lows to the left and the right. This created over a pivot high, so it broke the downtrend. And here's my bottoming pattern. You could have bought here. I guess I didn't see it at the time, obviously. But here's a secondary entry, a 180 reversal. A 180 was also on that slide of 9 bullish pictures. Here's my price void. Price void means there's insignificant resistance to the left to allow for a big move up. In this one, we bought call options instead of stock. That's a directional option trade, and I love buying calls and puts when they are liquid. That is the biggest problem, that there's only, I'd say, 125 liquid options, but you get the benefit of leverage and limited risk. So on this thing, instead of, let's just say, instead of paying $12.56 a share, I'm paying 55 cents a share. So if this thing gaps down to $1, let's say, I lose 55 cents a share. And if you bought the stock, you're going to be seeing a psychologist on the loss. Here's another one, different stock, momentum move, same but different, same but different. This broke out, bullish price action, could have bought here, this buy setup, I have this one marked. And then it broke out again, red bar ignored, bottoming tail. I would buy over the high of this red bar, target 28. Resistance over here. Same but different, same but different. Rising 200, 20 and 50 flattening out. This bar looked good, but no follow through, it didn't trigger. But that's okay. It's going sideways for 4 bars, building a bigger level of support. We're going to buy over this green bar, target, gap fill, and then go into trail mode. Wide range bar breakout from a bottoming pattern at the 20 and 50, and just 3-day swing trade. We're swingers over here. No tells. And so you know, one visual clue. Let's look over here. Some of you might say, well, Dan, you know, based on these other patterns that you've been showing us, why momentum moved down? Why could I have not bought here? And had I had a potent enough turn, I would say, well, you could have, but I'm giving you another gift right now on bottoming patterns and the 20 and the MAs. Remember I told you, and I'll go look at all the other examples. I want the 20 to flatten out at a minimum, preferably the 50 also. Look, had you bought here, look at the angle of this 20 and 50. The angle. Those two parallel and down is telling me that selling is monumental. You cannot get sucked in with one green bar. Does that make sense, you all? Look, this is a different chart, but the same, it's same. It went sideways, it stabilized, but this is a consolidation in a downtrend. This is actually Tesla back earlier in the year. So, you know, most of these I take the symbol off because it really doesn't matter. We're teaching patterns, right? But I wanted to leave this one on here. I'm looking up right now. I have 6 screens set up here in my office. Tesla is now trading at $485 from this setup. We were watching this because the weekly chart was a climactic buy setup on major support. So I was watching this the entire time. We actually did buy this one for a little swing trade, sold puts, came down, red bar ignored, sold puts. I'm still waiting to go directional because of this. It's trading chaotic. Now it broke out from a bottoming pattern and is bullish price action. We gave this to subscribers to buy over the high of this consolidation. Not saying I'd still be in it. Trust me, you know, I'd never mislead. I'm just making a fact that it's $485 from this turn on the daily weekly. Go check it out. This is what we call a 1, 2, 3, 4 from a bottoming pattern. So downtrend, right? 2050 down, deep move into resistance. Where is my entry? I'll tell you when I see it. It's surely not after 5 up bars. It surely ain't there. Go sideways, bottoming tails. Bottoming tails means there's buyers lurking below. The 20 MA flattened out. Wide range igniting breakout, inside bar, second inside bar that takes out the low of the other one. That's what we call a 1, 2, 3, 4 instead of a 1, 2, 3. Price void. Just now, this one I would only sell half because this is powerful. This is a powerful reversal from a bottoming pattern. So I would sell half under a prior bar's low. My next target is 108. 108. This is powerful picture right there. This one flat 20 and 50. Look, this was a gap breakout, but it ran too much. And then the next day it gapped up. I ain't buying that. I'm not chasing. I don't chase. So I watch for a setup. Here's my setup, a buy setup, wide range reversal, bullish 1, 2, 3. I'm buying over the high of this 1, 2, 3. Look, it has a bullish weekly and monthly, even though you can't see it. We held on to this 13 days. I guess we bought this buy setup right here, but you could have added on the 1, 2, 3. So we bought call options. Look, 160% return on our call options. So our green room here is, we start at 9 a.m. and my partner Greg Capra gives market review, intermarket analysis, just gets you ready for the market day, having a bias for day and swing trading. I come on, I go over open trades, gap trades. I love gap trading, and it's an amazing place for hands-on learning while the market's open. I mean, hopefully you all are learning a ton here, but we're looking at PowerPoint slides, right? So some people are probably correctly sitting there saying, oh, well, okay, Dan, you know, you sound like a genius, but you know, show me in real time. I will be happy to do that. We do it every single day in our live trading room. And people ask questions, we show charts, we scan. It's like, you know, you go get the course, and this is hands-on application of the course every single day. This is our year-end specials. I'll show you a different page in a few minutes here. We only have 10 minutes left, but it's, I heard Greg say the math today. It's like $1.60 a day for you to come into our green trading room. The amount of education you get in there is unbelievable. These trades I'm showing you where I say, oh, this is a open or closed trades. This is our advisory swing and options trader. We buy stock and options, and we give you the setup, the education. So you're actually earning while you're learning. Another bottoming pattern got shellacked here. Supply and demand are stabilizing. You could have bought over the high of this green bar right here. Topping tail there. We entered there. This one we just shorted a put spread. And then you collect 65 cents a share if you do a 10 lot. As long as it stays above 70 bucks in 4 days, you make $650. Breakdown failure, deep retracement, going sideways, breakout. Weekly, here's my new low reversal. Remember I showed you a different chart where I said how could, you know, I can visualize a new low reversal. Momentum move, made a new low and snapped right back. Here's my new low on the daily, snap right back. Gap breakout of a bottoming pattern, followed by a bullish engulfing bar at the 2050 right here. We bought calls on that, manage in between, has a price void, daily, weekly. This is a different type of bottom, a W reversal pattern. So it's down a lot. There's my momentum move, bounces. This is like a textbook W bottom. You know, there's different flavors, same but different. So it comes down to retest support, and we're looking for the tail. There's my tail, my wide range bar that closed above these prior 4 bars. That's my entry. Inverse head and shoulders is another type of bottom. Gap down, you know, it doesn't have to be a gap, but that's my left shoulder. The head is a new low, and then it makes a 100% retracement of up to the neckline, and you have bullish consolidation. Here's my bullish close at the neckline. That's where we enter. You have a price void, target cap fill around 56 or whatever. What is my tail? 20 MA flattened out, made a new low, 1, 2, 3, 4, no brainer long. See, I have, you know, like my pilot friends with 40,000 hours. I have so much confidence in technical trading when I see it. Greg and I, you know, we just give each other symbols. We never say, well, what is that? What are you thinking? As soon as we give each other a symbol, we know exactly what we're looking at. Now, sometimes I might say, are you thinking put spread or directional? Because this could be a $50 put spread, but all directionals have the quality to qualify for a put spread. So this one's a directional, but I would also be looking at the option table to see what I will get paid for selling a $50 put or $5 white put spread. I just saw these questions. My bad, y'all. Okay, green bar above red bar. Richard. All right, sorry. I'm not sure I got to that late. Email me, Richard. I'll be happy to help anybody out. Everyone, email me, dan@mastertrader.com with any questions. I mean, Greg and I, you know, some people say, well, why do you and Greg teach? I mean, you two are amazingly qualified. Why don't you just sit in your office and trade yourself? The answer is, I'm going to tell you the answer. Number one, it keeps us sharper. To get prepared to present to our clients. We're on YouTube every 9 a.m. with our pre-market review. Go check it out. It keeps us sharper. And of course, we both trade our own accounts very aggressively. We enjoy teaching and helping people. We have thousands of testimonials of changing people's lives. We love that. So many people we get, unfortunately, come to us when they say, I've been beat up, I got misled, I got, you know, some dude sold me his oscillator, magical lines, my wife's divorcing me, and now I know I'm at the conscious uncompetence level. I'm so glad I met you. We get those people, and we have fun in the trading room. We have, you know, all 100 people in our trading room, and so those are additional eyes of people feeding us good trade ideas. All right, let's continue. I only got a couple minutes left here. And we also do what we call Master Trader Live Wednesdays on YouTube. So Greg and I, we just pick a subject. We've been doing it for 10 years now, and we give you free education, just like we're doing right now. And it's called MT Live on YouTube. Igniting bar, flat, 20 and 50, price void. Y'all see, I can go over 100 charts here. You see, it's just same but different. Price void, flat, igniting, 1, 2, 3, 4, boom. It's same but different. Okay, why is this one the same but different? Because I have a downside shakeout. And I have a 1, 2, 3, 4. And then it went sideways. We'd be buying over the high of this green bar right here. Right there. This guy is a downside shakeout. This red bar suggested lower prices. Totally agree with that bias. Guess what? Using bar by bar analysis, your bias better change with facts. Here's my price void. 1, 2, 3 continuation at the 20 MA after downside shakeout. Do y'all see this? Same but different. 1, 2, 3. Same but different. 1, 2, 3, going sideways. You can do it again here. This one, the weekly, is a climactic buy setup. Going sideways, far from the 20. What got our attention on this one was the gap reversal on negative earnings. Ha-ha. You had a chance to break down and you didn't. And you closed bullish. That's my tell to go long. Buy over the high, stop under the low. All right, so you can see here's a buy setup after a breakout, just vanilla. Oh, write these down. These are 2 on our watch list right now. OEC, I grabbed this chart an hour ago before I started. This is a bottoming pattern. 20 MA flattened out. Buy this tomorrow over the highs of all this. Stop under these 3 bars. There you go. Bottoming pattern. This one, FMC, you can buy over yesterday's topping tail. Marijuana had a big old gap on some news. I'm watching these, but because the gap was so big, they need to give me a pattern. So if they can go sideways for a week or 2, then I'll tell you when I see it, right? This I'm just showing you for fun. This is back in 2020, Bitcoin. This was the absolute low of Bitcoin for all-time lows. Bitcoin right now is trading at about 85,000. And look at this breakout from a bottoming pattern. Today's subject. Boom. This is our holiday special. We only do this once a year, the most amazing specials. We have bundles of stock and option. I do all the option courses. Greg, my partner, does obviously the technical analysis courses. We have them separated if you wanted to buy the separate one, MTS courses, option courses. Here's the green room. I showed you the link above on the green room and the advisory letter. I showed you those links. Best prices of the entire year. Do yourself a favor, buy yourself a Christmas present. Buy one of these courses that we have folks buy these who have been in the business 20, 30 years, and they email us saying, you've drastically changed the way I look at the market for the better. So again, any questions, email me, dan@mastertrader.com. Happy holidays, and look forward to seeing you in the next webinar.
Thank you, Dan. I was definitely paying attention to that myself. Thank you for that important and eye-opening presentation. Dan has also provided a holiday special offer, and I put the promotional link in the chat box, so be sure to check it out. Really seems like a great thing to have there. All right, we're going to keep it moving. Our next speaker is Oscar Carboni of Omni Trading Academy. Oscar is known for his no-nonsense chart-first approach to the markets, cutting through headlines and opinions to focus purely on what price action is telling us. So everyone, please welcome the great Oscar Carboni. Oh shoot, Oscar, I think you're on mute.
Unmute.
Now you're not. Yeah, you're good.
Beautiful. You know, I've got 3 microphones and 3 cameras on this same system. It was grabbing another microphone. All right, so I am live, right?
Yes, you are live. Yeah, we can see you. Thank you, Oscar.
All right, so good morning, good afternoon, and of course, good evening, traders from across the globe. Traders Corner, thank you so much for what you do. You have great presenters, and these are fantastic shows, if you will, that you put on. And a lot of traders get to learn a lot about what's going on out there. That should happen today. I'm slightly different possibly than some of the other presenters because I actually don't have products to sell. I mean, I kind of do, but that's not what this is about. I've got nothing here to sell you because what I offer is free. I've got a live trading room where I'm on camera and microphone, free to you, no credit cards are required. I put out videos every night. They're free to you, nothing's required. So you can hang out with me anytime you want and no credit card will come out of your pocket. So don't worry about that. But I would like to teach you a little something today if I can, or at least I'd like to answer the most important question that I've been asked in the past couple of weeks, especially in the past 5 days. So in the last webinar, about a month ago, there were some questions and I answered them for my Omniacs around the world. Well, I did a poll over the last few days and I didn't even have to do a poll, just listening. There's a lot of worried traders out there right now, a lot of worried traders that we are in for a market crash. So here's what I hope to do. I hope to answer that question. The most asked question of my Omniacs around the world this week is, Oscar, are we going to see a market crash? This presentation should answer that question. So we will try to answer that together. Now, as we know, analysis changes gears, and from one day to the next, anything's possible, right? News can come out of the woodwork that we're not ready for, and the landscape can change. Barring no changes in the landscape that are so major they're not already in the charts, which just about everything is, I should be able to answer that question today in today's session. So, I don't know how many of you know me. My name is Oscar Carboni. I've been in this business since 1982, spent most of my life down on the trading floors in Chicago and Manhattan, and I've been one of the foremost analysts to ever come out of Wall Street. I helped develop point and figure charts, get them onto computers and have bar charts, get that broadcast around the world. Then I was able to help exchanges go on the internet, So I've been part of this since way back when we used to do things with pencil and paper. And I'm pretty well entrenched and can read the charts really well. So let's see what I come up with for you. So the videos, by the way, if you want to find those videos, every night I do a YouTube video or just about. In that video, it's geared to tell you what the markets will do the next day. So there are thousands and thousands of them, and there'll likely be another one this evening to tell you what should happen in the markets tomorrow. If you like those videos, you can come to livewithoster.com. In fact, let's log out of it for a moment just to show you what it would look like. So you would go here to livewithoster.com. And from there, you simply hit register. You fill out a few pieces of information, and the only thing that you'll have to watch out for is you'll get an email and it'll go spam, most likely. Unspam it, respond to that email, and in just a moment, you will be logged in. You can click into the chat room, and boom, you will be in a live chat room that basically looks like this, but my cameras are always on, except for right now because I am using that camera to do my presentation. So if you like what you see, come to livewithoster.com, come hang out with us. It's a live trading room. It should be called Live with Oster because I just live my life through the markets with camera and mic on as much as possible, and my Omniacs around the world get to share in that. If you really like what you see, you can go to omnibootcamp.com and fill out an application so that you can work with me for 4 days in one of my Omni camps. Barring that, let's go to work. I hope many of you can make sound money making positions or take some positions based on this presentation. If you do like what you're about to see, make sure you join me in my free live trading room. Kids, let's go to work. So what are we looking at? We're going to look at a chart, do a little exercise on this chart. It's the same exercise I've been doing in my trading room for the past 3 or 4 days while the market is starting to crack. So you're looking at the daily YM or the Dow itself. This is the YM, the future of the Dow, watched by everybody in the world. The Dow is the Dow, right? Everyone watches the Dow. So I'm going to tell you right now that repetitive patterns are the cornerstones of technical analysis. If you do not understand that repetitive patterns are what this whole game is about, that geometry, it's what the whole kit and caboodle is about. If you don't recognize that, watch this video. So, repetitive patterns, the cornerstones of technical analysis. What does that mean? Well, let's move this out of the way and take a look for ourselves. We are looking at the highest high the market has ever traded in its entire life. Since the beginning of the stock market, of the Dow, since Charles Dow created this, the highest it's ever traded in its life is 1, 2, 3, 4 sessions ago. 4. That is it, kids. 4 sessions ago. We were at the all-time forever high, and immediately the panic comes out. Oster, this is it. Here it is, the big crash. Oh my God, we're 4 days away from the all-time forever high. Where does that panic come from? I've never seen anything like it, but that's what happens. I've got some guys in my trading room, and all they talk about is the downside, the downside, the downside, the downside. And let me ask you a question. How much downside do you see? How much downside do you see? So let's go over this chart. Here's a repetitive pattern, and here is why I am not calling the top in this market until it stops repeating. Because a repetitive pattern repeats until it stops repeating, then it's done. Repetitive pattern. All-time forever high gets made in the stock market right there. What's it do? It has a pullback. Another all-time high gets made. It has a pullback. Are you watching? Watch this. Another all-time high, the forever high, it's never been higher. What does it do? It has a pullback. Then we make another forever high. It has a pullback. A new higher high. It has a pullback. A new higher high. It has a pullback. Another higher high. Now here we are. Another higher high. So it has a pullback. How on earth does that make 1,000 analysts out there say the top is in, that's it, it's over? And I say to myself, How do these people tell the market what it's going to do? Why don't they listen? How could they tell it what it's going to do? So it is not telling us the top is in. There is nothing here that would indicate that. So we've got what we call an Oscarism, known as an F flag. The market went around the F flag, popped out of it for 2 days, back to the bottom of it. There's no reason to call this panic yet. I mean, this does not look scary. I don't care who you listen to out there. If people have their own opinion, that opinion comes from a place of fear, a place of greed, a place of, I don't know if I have enough money to pay my alimony or child support or whatever is going on in their heads. That is also their opinion squashed in there. The chart removes all of that nonsense and shows you the truth. The truth at this point, as of today, is not a major top as in yet. Now, another thing to think about when you're calling major tops, for you people out there that just love to call the top every time it goes down for 2 days, you must realize we have been rallying since 2009. Then COVID knocked us down for a short period and we rallied out of that. Then we had Trump speak earlier this year in April and we rallied out of that. 3 dips since 2009. All this does is go up. You know what I mean? Where is the opinion that we're in a bear market coming from? It's all over the street, by the way. Where is that bear market? Do you see it? I don't see it. Another thing that I like to do, simple, is if a market starts on the bottom left of my screen, right? Let's just make this a little thicker. If a market starts on the bottom left of my screen and heads all the way to the top right, I have never once in my life called this a bear market. Not once, not ever. It's never happened to me. Do you call that a bear market? Because if you do, you need to hang out with Uncle Oscar a little more. It's not bearish. It could turn bearish, but this panic I'm hearing on the street because the market made an all-time new high and now needs to pull back. It made an all-time new high and now wants to pull back. It made an all-time new high and now wants to pull back. Where is that panic? Where is the end of the world coming from? But we'll keep looking. Maybe it is the end of the world. Let's go look at more charts. Chart number 20 is what we like to call chart masterpiece. It's the NASDAQ weekly bar. Another repetitive pattern? Do markets actually trade in repetitive patterns, or is my 44 years totally wasted time? You tell me when we're done with this. What you're looking at, I can explain everything on this chart, but there's no need to. The only thing you need to know is the repetitive pattern and is it working? Okay, so what's the repetitive pattern in this chart? Off the average, major rally. Holds the average, major rally. Holds the average, major rally. Gets through the average where? Just to the bottom of the channel. That's it. Major rally. Holds the average except for Trump decides to put out tariffs. We went down, and by the way, this is exactly where I put out my year-end call for 75.12. Had to do it on the downswing. And we got back above that average. Okay, so now we're right back in the repetitive pattern. Only had a quick mishap, back into the pattern. Makes an all-time forever new high. Rallies up, has a bit of a channel. What could happen? It comes down to the repetitive pattern average. All right, so markets have to fluctuate. They don't just go in one direction. There is nothing wrong with this market pulling back either to the green line or to the blue average like it always does. What's the worst that can happen? It could get to the bottom like it did here, like it did here. So what? So what? That is not the top. That does not call a top. No, not my opinion. Maybe it is, but I've been hearing this all week and I'm a little angry about it at this point. I can't believe how blind people are. Just they put their blinders on and then they just yap anything that comes to their mind. Oh, look, it's the top. I heard it on the news. I read it on the internet. Sell everything. You know what? Learn how to recharge people. If you're going to give opinions to others out there, don't make them panic for no reason. Read the chart. Show them a chart reasoning why the top is in, what you cannot do right now. If you can, you're magical. So let's go look at another chart. Let's just keep testing this thing for, is the top in? All right, monthly now. We did a daily NASDAQ, weekly NASDAQ, monthly NASDAQ. The monthly chart shows nothing more than a big old bull flag. Oh, it goes to the top, to the bottom. Is that the worst thing that could happen, that we have a pullback to the bottom of a bull flag? Is that a reason to go, oh my God, this is it. I knew Trump was going to run the economy. Everybody out. Is there a reason for that? When you look at that chart, I'm trying to calm the crowd down. The community needs to calm down. We're 4 days away from the all-time high. You cats need to cool out a little bit. I hope this video will help. This is a testament of the power of technical analysis. So one of the things you can do with the chart is way back here in November, we made a call while the NASDAQ was exploding, and we said by April 25th, we should hit 15,300. The market drops right after that call gets made and just ka-toom, just about hits 15,300 and explodes. I mean, come on now. You can't do that with a crystal ball. You can't conjure that up, and you can't call Uncle Bill and have him give you those numbers. The charts are the Bible. They will always tell you what's going to come next. So my call was for the bottom of this green line here. It actually got there. I missed it by that much. Is that not insanity? That's what the power of technical analysis is. And if you listen to anything other than these charts, you're listening to pure opinion. The charts are pure dynamite. They will always tell you the future movement if you read them correctly. So far, I cannot call this a top. The other thing is we've been booming, as I mentioned, since 2009. When a market moves up that far, it capitulates when it comes to an end. It doesn't just put a few bars in, you know what I'm saying? You get an event, and the market came to an end. There's been no event. Stop calling tops, people, until they call themselves. All right, what else is out there? Let me see if I can make this even clearer. 24, I think that's another chart I had played with earlier this morning. Yes, it is. So, you know what? Let's not go there yet. I'll bring that up next. Let's go here. Let's stay with the indices. Is the 7512 Omni call still valid? Well, hey, anything's possible, right? We got a couple of weeks left before we get to the end of the year. Anything can happen, but forget the exact number of 7512. Is the market crashing? That's what this is about. Is this another repetitive pattern? Well, I don't know. What would you call this? You tell me. Makes a new high, drops to the average. Makes a new high, drops to the average. Runs up again, drops to the average. Makes a new high, drops to the average. Runs up, drops to the average, but then Trump does his tariff call. Boom. At 48.32, the Omni call for 7512 comes out right down here at the lows. Bingo, 7512 call. What happens? Exactly what we'd expect so far, but we'll get there. So we get under the average, boom. Right after that, we get back above the average and we go right into a channel, test the average, run back up. We're testing the average again and the channel. So far, there is nothing there calling top. There is nothing there to scare the crap out of you. There is no reason to not think we get above 7,000 before this year is over. God knows we get 7512. Boy, would I be good, huh? We'll see. I can't make markets go anywhere. I can only control how we behave inside the volatility, but I can't tell markets where they're going to go. I do a good job listening, though. So listening to this, unless we break this, and then we break these lows, and then we break these lows, we're not in a bear market. You know what I'm saying? We're miles and miles and miles and miles from a bear market. So stop calling this bearish, people. Learn how to read charts. What's next out there? Let's stay with this. Transportation average. The Dow Jones Transportation Average, another one of the indices that everyone's calling the downside on lately because they don't believe in charts. They believe in their opinions. Much, much stronger than Wall Street, proof, what you see before your eyes, and the truth. Opinions are much stronger than all that combined together. Opinions are bad. Anyway, the opinion out there that this market is crashing. I showed this chart several weeks ago in my last webinar, in fact, and I said there's something called a triple top. Now, triple tops are known in just about any book you're ever going to read as the top. It's the end all be all. It's over. The top is in. Sell the farm. Goodbye. It's over. But then I started looking at head and shoulders, and I started looking at double tops, and I started looking at triple tops way back in the 80s. And I would go in the pit and I would test those theories 400, 500, 600 times a day, 1,500 times a week, 5,000 times a month, 6 months in a row. Way more than any of the people who wrote those books ever had a chance to try out their theories. And I promise you, most of it is hogwash that I've read in books. They just don't get it. They're very good at reading books. They're very good at filling chapters of information and quite the jargon there to make you realize just how great they are. And their indicator is, I find most of the stuff I've read in my life doesn't actually apply to what happens in the charts. For instance, the end all be all, the triple top is the top. Oscarism version, I've been saying this since 1987. The triple top is not known as a triple top. It is something that will put in top 1, top 2, you'll get top 3, you will get a brief pullback, the brief dip, and you will run up to new highs. What did we get? We got a pullback, which is a brief dip. We ran up and made new highs. Now we're in a bull flag, getting ready to possibly break out of that bull flag. And half the people I speak to are ultimately bearish. This is to convince you that you shouldn't be bearish until the chart tells you to become bearish. That could start on Monday, but that's not what we're seeing today. Let's continue on. Now we'll go to that crude chart because that popped up before and there's a reason for it. This is crude oil. Did you know that crude, when it gets cheaper, is a worldwide stimulus? Not only is it a stimulus, it goes right in your pocket immediately unless you own nothing but Teslas. It is, in fact, if you own a Tesla, electricity gets cheaper when crude gets cheaper because they use crude sometimes to create the electricity, as crazy as that sounds. So let's just go back to charts. Crude oil is a worldwide stimulus when it goes down, and it is absolutely the most treacherous thing on the planet when it goes up. But when it goes down, every company on this planet, everything that transports anything, every one of us who drive or have houses, it makes life cheaper, just like that. It's a worldwide stimulus. Now, another thing that when crude does go down, giving that worldwide stimulus, it pushes markets up. Well, this is crude oil. And I don't know, maybe some of the crazies that are calling the top of the market right now are going to call this a bull market when they look at it, because it goes up and then drops. It goes up and drops, and it goes up and drops, and it goes up, drops. Maybe those nuts think this is bullish and the stock market's bearish. Let them do their thing. I'll explain to you what's actually happening. Crude going down, when crude goes down, that worldwide stimulus helps to buoy markets. The price of crude is not just going down, it's starting to go down quickly. And not only are you getting out of the bottom of this major wedge, and it failed every time it got to this average on the way up, failure, gets through the support, starts here, goes here, support. Not only are we through the support, guess what else we're about to hit? A double bottom. And I'll promise you right now, there are sell stops waiting below this double bottom because that's how this thing works. Why? Because when you hit here and it went back up, all the stops in the world were put here, and they're still being held by long-term fund managers. Well, guess what happens when we get back here? More stops will get added, and we'll bounce just like you see. And then we will take out those stops because the market always goes to the most work in the book. The book being upside orders, downside orders. If there's more volume on the downside, the market will take out those orders first. I promise you there's a lot of stops under this red line right here, and crude is going to take those out. It's already proven it wants to go there, and it might not be tomorrow, but we will take out the stops under this double bottom because that's what crude does. Seeks the most volume. Now, of course, there can be some weapon that goes off and crude can go crazy tomorrow if it just sticks to its chart patterns, which I am a chart reader. I don't read the future, I read the charts, which kind of tell me future market pricing. But I can't tell you what news is going to come out. I mean, that would be a crazy person, right? That can predict news before it happens, or a medium. But I can predict market movement that's shown to me off the chart. We will take out those stops. You know, it did it earlier, by the way. You had one here, double bottom, went up, then took out the stops. Right? It's just what happened here. Now we have a deeper double bottom. It might go up, but you will take out those stops, and that will help the rest of the world with cheaper crude, worldwide stimulus. Also, a reason to think the market should not crash, the stock market. What else is out there? Let's go look at another chart now. These are your 30-year T-bonds. Now, I don't know if you know this or not, but inherently, when 30-year bonds move in the down direction, rates go up. When 30-year bonds move in the up direction, rates go down. Jerome Powell does not have to say a word. The market will just correct itself and rates will go up when the market goes down, 30-year T-bonds. And when they go up, the rate goes down. When the bonds go down, the rate goes up. When the bonds go up, interest rates go down. So overall, we have been going up, but lately, this is a weekly now. So every one of these bars is 5 days, 1 week, 2 weeks, 3 weeks, a month, 1 week, 2 weeks, 3 weeks, 2 months. We've been going down for 2 months and a week. That's a long time. So we have been going down. That's actually putting pressure on the stock market, but it is the only outlier I have found in all the work I did before this presentation. The only thing I found that's not working to push the markets higher overall are bonds. And if you want to look long-term, they actually are working long-term towards the upside, just not in the last few weeks. And we are shorter-term minded traders in this world usually, right? Unless you're running a long-term fund, we're shorter-term outlook traders. That has been interest rates being moved up, which is not the best thing for the stock market, but not dramatically. And you know, there is a fundamental, we heard it last night, the president of the United States came on TV and said, the next guy I install in the Fed's going to lower rates a lot. I don't know that he could force a Fed to do that, but that's what we heard. If that's the case, bonds should go up, and that should help the stock market. So that's the only outlier I have found, but there are some other markets I thought we should go over together. One of them is silver. Now, I don't know how many of you know me and how well you follow my calls and how often you've actually watched, but when I was in Australia a month or so ago, some clown came out and called the top in silver the all-time high. Here it is, the top's in silver. And I literally had to rush to the camera and do a video and say, listen, if you believe in these entities on YouTube and on social networking that are calling the highs in silver, don't listen to them. They don't understand how this works. It couldn't be the high. I promise, I said it once again, let Uncle Oscar tell you when highs come in. Why? I grew up in gold and silver. I started there at 18 when I was a child. I know those markets well enough to kind of not call tops and bottoms unless they call themselves. Anyway, this really big entity comes out online and starts saying the top is in silver. And my videos were, do not listen to him. The top's not in. I'll let you know when that top comes in. So we were able to convince people that the top was not in yet, and they did not get short until we made a call for interim top. That actually worked. And we came all the way down. I mean, we came down a lot from 58 to 50, but we're not topping in silver yet. You know what I mean? Look at this channel. First, it worked its way in this channel, which is a pretty steep channel, but then it just, I mean, come on, look at that. There's no top call there yet. Well, silver looks good. Metals themselves, insanity. Look at this. Look at this gold move. Now, gold is a creature of the channel formation. It's just what it likes. Gold loves the channel formation. In fact, Omni gave us a buy in gold down here today, and it went all the way up there where we got out and made thousands and thousands of dollars in gold today. Actually took back our silver loss from Monday. Thank you, gold. We appreciate that. So gold, daily. It's a creature of channels. What would make me say that? And you know what? I have eyes, and so do you guys, right? You can see that. It runs in channels, even in little baby channels, but major channels, it just runs in channels. Then it starts to explode a little, comes back down, and just creates another one. Gold loves to stay in channels. Now look at the latest channel that's been created. Look at this one. Gold is a creature of channels. Why? Who cares why? I don't look to reinvent wheels. It's put them on my car, make them go round and round. Gold and its channel creature habit formation is another wheel for me. And I use it to go round and round, but you'll see that gold likes to get itself into channels. And there are actually smaller channels inside the bigger channels, so gold likes to do that. One of the few markets that just likes to be symmetrical. Gold is one of them. In fact, what we had here was a bull flag right before, and then the market went up and created this other flag that you now see. So that was a bull flag, right? Continued up, stayed inside the channel, inside the bull flag, And now it created this pennant flag, and it's starting to break out of that. And just watch gold inside these channels. Gets out of one channel, drops to the other, usually holds. Hope these things help you if you drop these charts for yourselves. What else? Oh, look, talk about gold. Watch this guy. If you're not metals traders, look at what's going on out there, kids. This is your platinum daily bar. Talk about a massive channel that was in, but look at the channel it's in now. This was a massive channel, right? Massive channel that it stayed in. But look at what it's doing now. Acceleration time. When did it accelerate? Remember this, after a flag was made, then we accelerated. You could call that flag either this, or we can move that around and call it this. Either way, that was a bull flag, and you had your explosion afterwards. The metals are behaving as, here's what I'm seeing. Fund managers are buying gold for a week or so, then they come in and they buy silver for the silver gold ratio. They actually have the silver gold ratio at 2.2 right now, which is an amazing ratio. Excuse me, the platinum gold ratio. We're doing platinum. The platinum gold ratio is like a 2.1 or a 2.2, which I've never seen that in my entire life. And I grew up in the platinum, gold, silver, and copper pit. You know what I mean? This is insane what's going on here. But you can't stop what's happening, and you shouldn't fight what's happening. Metals are all running. Silver, gold, platinum. Hey, by the way, join me each day at livewithoscar.com. Cost you zero, not even a credit card, and you can hang out with me in my live trading rooms. But let's just keep looking. That was your platinum, right? Look at this. Look at the palladium. My God. Look at this palladium. A huge cup. Maybe a handle being built. I don't know. I figured maybe it wants to stop now for a handle. My goodness, the metals are just going gangbusters here. Get yourselves long on dips. It's not going to stop tomorrow. And then what else do we have? Copper. Look at this crazy copper run. Now copper is getting involved, right? The other metals went without copper. Why? Because there was a lot of tariff talk back here. This big drop, it's all tariff talk right here. Then the tariffs were taken off, and boom, now copper is joining the parade. And I don't know exactly what this is here, but it's some kind of flag-ish looking formation. Right? It's something going on right here. I don't know exactly what it is, but it's trying to speak right now. It's telling us probably wants to go higher. So the metals are just gangbusters moving higher. But there is this. You've had gold move from $275 in 1982. You've had it move all the way to 4,000 and change, 4,300. Platinum didn't go, silver didn't go, copper didn't go, palladium didn't go. They are now playing catch up. Their ratios, gold, silver, gold, platinum, gold, copper, platinum, gold, you know, they're all silver, gold, they're all pulling in their ratios, meaning gold has gotten so expensive now at this point, the ratios are out of line and they're buying the other metals to catch up with the gold ratio. Now, funds have been holding a lot of these metals for many, many decades. That ratio makes a big difference to them. It stays in line if they can keep it in line. I see that that's what's happening here. They're buying the outlier metals in order to get the gold / whatever metal price to come more in line with where it belongs. Now, this is an absolute true thing because I did this, I think, in my last webinar too, but it's worth showing you again. Back in 1982, maybe 83, when I started in the silver gold pits, I put a silver coin and a gold Krugerrand in my pocket. I promise you, this was worth about $265, and this was trading around $21. In my 44 years, this went to 4,300 in silver up until the last 6 months was still at $20, $21, $22. It never did anything. Copper was 65 cents. Gold went from 265 when copper was 65 cents to 4,300. Platinum used to be worth more than gold. Now it takes 2 platinums to equal 1 gold. They all need to catch up to the price of gold. And that's what's been happening lately in your precious metals, if you wanted to know what's going on there. What else did I have for you cats? Oh, let's move out to some crypto. Bitcoin. So what has Bitcoin done? Bitcoin amazingly went all the way up to the Omni 126,000 target like it was scripted. And you guys know that's been my target all year, right? Hits the target and just falls apart. But then we call for 80,200 and it goes to 80,400 right here. Put in a bear flag, broke down out of the bear flag, and I would think more downside coming for this guy. However, if you remember, I've been saying this for the last month or so, that my calculations are such that come towards the third week of December, maybe first week in Jan, right around there, my calculations are that the end of crypto winter should come our way. Crypto winter starts with Bitcoin. Nothing else goes into a crypto winter, just Bitcoin. It takes everything else with it. Bitcoin is the leader of all the other cryptos, as you know, but it doesn't always move the other cryptos. It's more of a leader of Ethereum and Solana than it is any like smaller coins. But the major ones out there, Solana, Ethereum, Bitcoin. Bitcoin is your leader, and your leader says, you know, we still got more downside. Hopefully my calculations are right. Everyone's got their own way of calling crypto winters. Hopefully my Bitcoin winter does end before this year ends, or maybe in the first week of next year. Would be good because I own a lot of it. What else is there? 15 is another chart for us to look at. Ethereum traders. Last time I showed this chart, none of these bars existed. We were right here, and I called it a do or die level. Traders, we're at a do or die level. If it gets above, fantastic. If it doesn't, we're going to die. Well, it got above. It did. It didn't die. It literally got above. Thank goodness, because that's not usual. Right? Lately, you ain't no getting above that channel, but it gets above. Stays out, starts to test the channel, and here we are now. We're literally testing. If it settles down here, well, then we failed at the do or die area. You never know. Let it do its thing. I'm considering or assuming, we don't like assuming, but in this case we have to, that if Bitcoin has more winter left, so does Ethereum, right? Being that that leads Ethereum around, so you'd have to think Ethereum is going to head back into this channel, but we'll play this one day at a time. We'll know by the end of this week. Then we can roll out to something that I will have to thank each and every one of my Omniacs for. If I could find it, I'll show it to you, and that is the Omni trading token. Omniacs, I love you guys. Look at what you've done with your community, my community. You know, I back you guys 1000%. I am there to help you. But we have had success in our Omni trading token. It is now sitting in a bull flag. In fact, let me see if I can show that in a better way. Same token. We've got two bull flags. You got a big one and a little one. So there's a little one inside the bigger one. We have two bull flags. Now, I just showed you a bunch of charts where you've seen the bull flag. Once you get out of a bull flag, generally you have a breakout. Congratulations, Omniac. So far, so good on our Omni token. We had this bull flag, it broke out. We had that bull flag, it broke out, exploded, another bull flag, above the average so far, most of it. I say we just keep doing our thing, Omniacs. You're doing great with this token. I promise I will be there to support you. But bravo on the work we've all done with our Omni token. And then that brings me to a gift I would like to give you. That gift is here. Tesla. How many traders out there trade Tesla? Love it, hate it, does not matter to me. I love the company. I think Musk is a great man, but I only look at charts. We have a double top, and we know the old adage, when we see a double top, we sell a double top. Now, you've got a top here, and it went all the way over here to put in the second top. The likelihood is that will be a double top, but here is how I would ask you to handle this. The daily bar right now is still under that double top, today's daily bar. If we drop down and have a daily bar that drops lower and settles by the low of the daily bar, you could basically call your double top in place. I wouldn't just blindly sell this because you might rally above it and then it wasn't the double top, right? We don't give anything a name till it names itself. This looks like a double top. I think it's a double top. I won't name it for sure and trade it until it proves that to me. How will it prove it? Well, it simply just needs to drop down a little bit. If it drops down, let me fix that trend line because there is no way it's going to let me play with it in this fashion. It should be on none. Sorry about that, kids. Let's make it a little thicker, being that we're here. All right. So if you get this and the settlement somewhere down here, the settlement, if you don't know, that's a dash to the right, one with the close like every other, then you can call your double top. So my gift to you is watch, because this is a monster move. If it goes, it's going. Where would it go? Well, if you ask me, if Tesla drops, it already told us where it's going to go. It's going to go right there. Why? Because that's it. That's the bottom for Tesla, the entire run. That is the bottom if you get there. So maybe it could go there. That'd be a nice fat run, right? 410, 409. We'll take it. So I wanted to show you that. It is sort of my gift to you. It's your setup. Keep your eyes on it. You get that bar down, you can go short. If it gets above, all bets are off on the double top. Traders, that's my presentation for you today. I really hope this helps. I hope this helps you see what's probably happening out there versus what people say when they just belt out an opinion, all based on their heart pounding too much. That opinion I just showed you is 100% chart based, has nothing to do with a bias in any direction. Traders, that's my presentation to you. The last thing I'd like to say is stops are in. Emotions are out. That is the truth. Put those stops in. Keep your emotions out. Rock and roll, traders. Thank you all for tuning in. With that, Traders Corner, I yield you back my time.
Hey, thank you so much for another exciting presentation. We appreciate all those nuggets of gold you gave us. So thank you again, Oscar.
Sure, I hope it helps. And traders, be safe out there. Make sure your stops are in and listen to the charts, not opinions. You'll be much safer.
Thanks, Oscar. You've proven yourself once again. And thanks for sharing your chart-driven perspective. Be sure to check out Live with Oscar and his great YouTube videos. As you can see, they're definitely worth visiting. So thank you again, Oscar. We appreciate it.
Thank you. Have a great weekend.
You too. We're heading into our final session of the day. Our final presenter today is David Wyse of Right Line Trading. David is known for his disciplined, rules-based approach to trading options on the SPY. In this session, he'll be teaching the SPY Super System, trading options with laser accuracy, a precision-focused framework designed to help traders identify high-probability opportunities while filtering out market noise, which you just saw Oscar do as well. David's system is built around key edges such as relative strength and weakness, trading in the direction of the broader market trend, and timing entries and exits near support and resistance. These principles work together to create clean, repeatable, high probability option setups, especially in volatile market conditions like we're seeing right now. So please help me in welcoming the great David Wyse.
Hello, good afternoon. Thank you very much for a nice introduction. Appreciate that. I'm coming directly from, thank you very much. I appreciate that. I'm coming directly from trading, and of course I'm going to miss the last 15 minutes of the day, but I'm coming directly from trading to the webinar, and I appreciate everybody being here today. We're going to talk about a few things. I'm going to talk about the SPY Super System. It's a piece of software that I'm going to show you that I use. I have it running on Thinkorswim. I don't trade on Thinkorswim, but it identifies when institutions are in the trades and when they're not. And again, as Oscar mentioned, and I agree completely with him, we trade the charts. We trade what the technical charts are selling us, nothing else. We don't listen to what people say, but what we read about or what we see about on social media. We trade what the charts tell us what to do. And right now the charts are telling us that the market doesn't know which way it wants to go. So anyway, we're going to go ahead and get into the presentation. Thank you very much for being here. Again, we'll be looking at the software. We'll be looking at a trading room. I have a live trading room, which I just came from. I'm in there every day from market open to market close. I have an alert service, and we're going to talk about both of those We're going to talk about the results we've had using this software and the technical analysis I do. And we're going to talk a little bit about Heikinaichi candles. If you haven't heard of Heikinaichi candles, it's a good way to help you smooth out the price action, identify entries into trades. So let's get started. Again, my name is Dave Wyse, and I've been doing this for full-time for about 17.5 years, part-time from before that. So I've been basically a full-time trader for many, many years now at this point. Okay, first thing I have to do, of course, is the disclaimer. All signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, on we go here. If you have any questions, I'm going to leave the question box open in case you have any questions for me during this presentation. I will try to answer them as they're put out there. If you have a question I can answer, such as some of the software purchases or the subscriptions to the room, etc., you can go ahead and call Rory at 786-732-4656, or you can put your name and phone number in the question box or the chat box, or your not Skype, it's Teams now, a Teams username. I have a Teams a group that I work with, and you can put your Teams username in there and Rory can hit you up on that. Okay, let's get started here. I know it's been a long day for everybody, but I certainly appreciate you staying for the presentation. I think you'll find it very useful in your trading. The first thing I want to talk about just briefly here is this is called the Compass Text Alert Service. The software that I'm going to show you is called the SPY Super System. It was initially called the Compass when it first started. It's been enhanced since then. We now call it the SPY Super System, and but the alert service is basically SMS text alerts to your phone of high probability trade setups that we find in the trading room, and we send them out to the alert members, and they can put them in. You get an alert with an entry price, an exit price, etc., expiration dates. And we just finished one off today. Yesterday, we took one yesterday with Roblex short, and we took it off today for about 25% profit on Roblex, and that was on an alerted trade. Okay. First thing I want to talk to you about briefly here is what drives the market, what moves the market up or down, or what makes it chop around. And we got two groups of traders. These are retail traders here, these little small marbles. I'm a retail trader. Most everybody in this room most likely is a retail trader. Important thing to understand about retail traders is we cannot move the market. We can't drive the market direction. We can't create trends. We can't break trends. All we can do is trade with the trend if there is one, or not be trading. That's basically what we want to do. What moves the market is right here. These are the institutions. These are the big boys, the folks like JP Morgan, Morgan Stanley, Bank of America, all the big banks, investment banks. But there's 4 different groups that make up institutions. The investment banks, there is then the mutual funds, such as T. Rowe Price and Vanguard. They're very big and very active with billions of dollars. Then there's hedge funds, and there's hundreds and hundreds of hedge funds, which have, again, more and more billions of dollars to invest and to trade. And then there are things like pension funds, police pension fund, fireman pension funds, state worker pension funds. All of that group is what makes up the institutions. And what we're trying to identify is when enough of those institutions are pushing a stock or an index in the same direction. There has to be there's always, the institutions are always in there. There can be some buying, some selling. What we're trying to identify is when is there enough force in the market pushing a stock up or pushing a stock down based on the number of institutions doing it. That's what we're looking for. Once we can identify that, we want to trade with them. If there is no direction to that based on the institutions, we don't trade at all. All right, we just step away from that. Okay, so that's how we find high probability trade setups. When the institutions are in there trading, we follow along. We're going to take our money from these other retail traders because we have better information than they have. We've got the SPY Super System. We can tell when institutions are in there. We get better technical analysis, and we've got better methodologies than they do. So we take money from these folks. We're not going to take money from the institutions, but we want to follow them. Okay, this is it seems like a little off topic here. This is a blackjack table. There's an ace and jack spades, nice blackjack. couple $100 chips. This is a nice, if you like play blackjack, this looks really nice. You'd like to see that. But you're probably wondering what this has got to do with trading. Well, when I first started trading, and I imagine this is what happens when you talk to anybody who you know about trading, or your relatives or your friends, they're going to tell you that trading is first of all, they'll say it's manipulated, you can't beat it. They're going to tell you that it's gambling. They're going to tell you basically you're gambling. You might as well gamble as do that. And there is some similarities between, or there's some accuracy to that. But what I want to kind of explain here is when I was much younger, I made my living playing blackjack. I was what's called a card counter. They don't actually count cards. We track the value of the cards as they're removed from the deck. As the little cards are removed from the deck, and then that gives the player an advantage over the house. As the big cards are removed from the deck, that gives the house a bigger advantage over the players. So what I did was track those cards, deuces through 7 for small, 10, jack, queen, king, ace for big, kept track of that. And by doing that, I knew if I had an advantage over the house or if I didn't. And if I have an advantage over the house, then I would make big bets and multiple bets. And if it went down to where it was in the house's favor, then I would bet the minimum with one hand. I bet, at that point in time it was like $2 or something, but I bet the minimum. So knowing what was going on with the composition of the deck, that gave me a mathematical edge over the casinos by knowing the cards are in my favor. Right, so this was very successful. I mean, you can do this as long as they don't catch you and throw you out, which happened to me several times. I get barred from several casinos, but generally speaking, I still got to play for a good long time, a couple of years, and made my living doing that. So why did I bring this up? Well, trading stocks and options is very similar. Okay, in that without knowing what the institutions are doing, you don't have an edge. You don't have any big edge over the other retail traders. You've got to know that. So in essence, they're gambling. So if you're trading without proper information, without proper tools, then you are gambling. And so that's why I brought this up. Now, one of the things to keep in mind here is when you're trading stocks or trading options, I trade mostly options, or you are playing blackjack, there's two things that are required for both of those to be successful. You can have the perfect system in stocks or in blackjack, but you require discipline and emotional control. You've got to have discipline and emotional control to be able to be successful at this, because it's your mindset that can ruin both of these things, right? You lose a couple of hands and you get mad and you start to overbet. Same thing if you're gambling or you're trading. You make a couple of trades, they go against you, you get emotionally involved, you start to revenge trade, etc. So they both require discipline and emotional control. The SPY super system, which I'm going to show you here, is what I call my card counting system. This is the method that gives us an edge over other traders, allowing us the ability to become consistently profitable by following the institutions. And the SPY super system, in conjunction with identifying the best high probability trades, can lead to consistent profits. It's important to understand there can be several stocks at one time that are being pushed up or pushed down by institutions. What we want to be able to do is find the best of those. We want to find the very highest probability trade of those very good trades. So that's what we're going to talk about. Now, in the room and on the alert service, I have a couple of rules to trade by. First thing is we trade the best and skip the rest. Sounds really simple. It's not that simple, but we find the best trades, and if the trades are not high probability, we skip them. This is a kind of an overlooked advantage, because if you don't take a trade that would have been a losing trade, that's just as good as a winning trade. I mean, you basically kept money that you would have lost. So this is very important. And by skipping trades that appear to be a high probability if you're just looking at the chart, but the institutions aren't in there pushing that trade, we can stay out of it. We've got a much better chance of avoiding those, right? And that's what the SPY system does a lot of. Second thing is our objective is not to make trades. Our objective is to make money. In my room, we don't take an awful lot of trades. Some days we don't take any trades. I don't think we even put a trade on today. No, we closed out a Roblex trade from last night, and we had a trade yesterday in the room as well. that we closed out for a profit yesterday. But a lot of days we won't have any trades. Some days we'll have 2 or 3. It just depends. And there's a couple of different type trades that we do that we'll talk about. But again, our objective is not to make trades. Our objective is to make money. This is to try to instill in traders patience. Please don't feel like you have to be making trades all the time. You don't. You don't have to have 10 trades a day to be successful. You can have 1 or 2. That's all you need, as long as they're very good high probability trades, right? So over trading is one of the biggest problems that most retail traders have. They'll trade too much, too many trades. They're sitting there in front of their screen. They feel like, I'm a trader, I've got to have a trade on. They'll justify trying to take a trade. So again, our objective is not to make trades. Our objective is to make money. Now, maintaining discipline is very critical. This means learn and follow the process. In other words, in the room, I have the SPY super system up and running all day long. So I can see, when we look at stocks, I can see if the institutions are in them or if they're not in them. All right, so that's important. And then we have particular strategies and methods that we follow, certain strategies and methods that we follow using the SPY super system to identify the stocks to take, right? You have to learn and follow that process. It's important to understand what criteria makes a high probability trade. It's not that complicated, but you need to know those and stick to it, which means you got to maintain that discipline. I had mentioned that already. And then remain patient. And again, this is another critical one. Impatience can be a real killer for retail traders. Again, going out looking for trades to try to force trades, and then in your mind you justify this trade based on something that's close to what you really want to do, you end up losing money. I mean, you can have 1 or 2 good trades, then you get bored and you get impatient and you start taking trades, and at the end of the day, most of your profits have been drained away in these bad trades. Please remain patient. Wait for a stock to come to your support level to get in, or your resistance level to go short. Very important. Okay, now as a profitable trader, obviously we need edges over the other retail traders. Our edges are the SPY super system software. In other words, what are the institutions doing? Are they in the trade? This is a big edge right here. Trading relative strength and relative weakness. This is not RSI. This is not the relative strength index that you can see on your chart. This is looking at what your stock is doing versus what the S&P 500 or the SPY is doing at the same time. If the SPY is moving sideways and down, and you've got a stock that's stacking green candles, you've got relative strength to the market, and vice versa on the weakness side. This is very important. This gives you a big edge. And it's surprising to me that very few retail traders even understand or use this. This is very critical, because if you have a stock that has relative strength to the market and the market turns against you all of a sudden, your stock with relative strength is not going to drop as fast. It gives you plenty of time to get out. So by having that relative strength, you've added to your percentage win. You've added to your likelihood of being profitable on the trade. Trading with the market trend, obviously, this is, you always hear about this all the time. If there is a trend, trends come, trends go. During the day, you may have 2 or 3 different trends. But if there's a market trend, you want to trade in that direction. If the market is having a bullish day, you want to be long. If it's having a bearish day like yesterday, you want to be short. You notice we took Roblex short yesterday. And even though the market gapped up this morning, Roblex was still successful, was still profitable, because we took a stock with relative weakness to the market when the market was weak yesterday. So when the market gapped up this morning and went long, it started moving up, Roblex kept on going down, and we were able to take profits in it. And buy near support and sell near resistance. This is number 4, and this is really important. Don't chase stocks when they're ripping up or ripping down. Wait for them to be near support or near resistance and buy there, or sell there if you're going to be selling near resistance. You're going short. Buy near support, sell near resistance are really a good rule to live by. Sometimes you may miss a trade. It may take off and it may not come back again, but most of the time, stocks just don't keep going in one direction. They'll come back and test support or test resistance. Okay, the Compass system, which is now called the SPY super system, it identifies high probability trade setups by identifying when the institutions are in the trades and when they're not. When they are, we can see by the chart that they are, and we can then make our decision based on the fact that we're trading with the institutions. The Compass system, or the SPY super system, does this by identifying when the institutions are driving the move. It does this by looking at some fairly complex data, momentum, money flow. There's several different things that it looks at, trend, etc., to come up with this, but it's going to display it in an easily identifiable format. It's visual, so that you can see colors, which is going to tell you whether the institutions are in there or not. And this makes it really, really easy for inexperienced traders, even though if they don't know technical analysis or I can't read price action, they can tell whether the stock is a good trade or not a good trade. Okay. And this is how we get an edge over retail traders. We're only taking trades that are being driven by institutions. They're trading stocks that have relative strength or relative weakness, and we trade in the direction of the overall market, right? So again, our trades will be supported by the institutions. The stocks will be outperforming the SPY, and they'll be moving in the direction of the overall market. If you can follow just these three things right here, you'll be ahead of about 95% of the retail traders in the world, and there's millions of them. Okay, now the SPY super system, as I'm going to show you the system, I want to go over something. I'm going to go over the results that we've had in the room. This is closing in on 4 years. It'll be 4 years at the end of December. We started in January 2022, and we haven't had a losing year. Of course, we only had one losing month last year. This year, I don't think we have any losing months, and we've been profitable every year significantly. But those good results, I want you to understand that it's coming from the SPY super system. The SPY super system is the critical element, right, in finding and trading the highest probability trades. The SPY super system software is the engine that drives our results, right? Remember that. This is what's driving the results. The ability to identify when institutional players are driving a bullish or bearish move, and when they're absent, is a key factor in pinpointing high probability trade setups. This is the function of the SPY super system software, and it's the critical component. Okay, very important. I am on YouTube every day. Rightline has a YouTube channel. I'm on there every day from 11:30 to 12:30 or so, sometimes 11:40 to 12:40, but I'm on there for an hour each day where you get to see the room. You can hear me talking to the traders in the room. You can see our charts up there. You can ask questions. Okay, I'm going to go over this kind of quickly. The most common mistakes that retail traders make. I did a video on this, but these are really important, and these are all mistakes that I made when I was learning in my career. Not considering the current market conditions when you take a trade. Really important on whether it's a 5-minute trade or an intraday or daily trade off a daily chart. Make sure you're looking at what the current market conditions are. If the market is choppy, then you should be taking very few trades and you should be taking quick profits. If the market is trending, you can take bigger risks and you can stay in the trade longer. But you've got to look at it and see what it's actually doing. Over trading, we've talked about this big one. Taking too many trades, always wanting to be in a trade. Trading your P&L instead of your technicals. This is a huge, it's one that I think is very important. A lot of traders will try to make a determination if their trades are working or if their strategies are successful based on their P&L. So they're getting in and out of trades based on their P&L. If they're in a trade and it looks good, it goes green, they stay in the trade, turns around, goes red, they start to panic, it goes back up, it turns green, they dump the trade and take a small profit and leave. Not because the way this trade was set up has gone bad. It hasn't broken down through support. It's just they get out because their P&L went from green to red back to a little bit of green and they get out. That's emotion. You were trading out of fear when you did that, right? So that's very important not to trade your P&L. I don't even look at my P&L during the day. Trading what you think instead of what the price says. I'm going to talk about this a little bit. Over leveraged, if you get too much risk on, I think everybody knows about that. Not using the daily chart for swing trades. Somebody sees a nice 5-minute chart, they take the trade long, they don't look at the daily chart, they don't have any idea whether the stock is bullish or bearish. Big mistake. Lack of patience, another important one. Forcing trades, again, this is related to lack of patience. Attempting to pick tops and bottoms. This stock can't go any higher, I'm going to short it. This stock can't go any lower, I'm going to go long. You don't do that. You shouldn't do that. What you do is, if you think a stock is topping out, wait for confirmation that it's reversed and headed back down. You've got to have confirmation of those reversals into another trend, okay? Not waiting for confirmation to enter a trade, same thing. needs to be able to confirm that the support's going to hold or the resistance is going to break, etc. And fear of missing out. Those are the 11 most important ones, I believe. Trading what you think and instead of what the price is. I'm going to talk about this right now for just a quick second. This is a quote from Stephen Hawking. And he says, the greatest enemy of knowledge is not ignorance. In other words, not knowing anything is not the biggest enemy of knowledge. It's the illusion of knowledge, right? This illusion of knowledge is if you trade something, you have a trade bias based on what you read somewhere, you saw on CNBC, you saw in a social media post on X or on TikTok or somewhere that this particular stock was going to go up, or this particular stock was going to go down, or the whole market should be bearish. This is illusion of knowledge. Back here in the spring, when the market went down quickly and up quickly on the tariffs when they were put on and taken off, there was a huge amount of bearishness sentiment in the market. And for a couple of months after that, everybody, all these gurus were saying the market should be going to correct, it's going to go down, it's bearish, and people were taking trades based on what they thought was going to happen and based on what they told them, right? They went short. They went short for May, June, July, and guess what? The market went up May, June, July. It just kept marching higher and higher. They were in trade short, getting clobbered because of their bias, because of what they thought they knew. This illusion of knowledge was causing them to take bad trades, stay in bad trades because they didn't want to be wrong, thinking that eventually they were going to be right, and they finally had to give up the ghost. They lost their money. Not only did they lose the money on the shorts that they took, all right, but they also lost the opportunity to get into trades long. We were basically long during this whole period of time. Once those tariffs came back off, we were long that whole time, even though we were hearing everybody go tell us go short, go short. And believe me, I was dealing with this every day in the room with everybody wanting to go short, and I was trying to keep them focused on going long. We're trading what the market is doing, not what the market what we think it should be doing. So again, remember this. It's the illusion of knowledge that's the greatest enemy of knowledge. No, trading something that you think you know when you don't know it. Okay. A question here. Hey, Ed, the system works. You've tested and tried it. My main enemy to success has been myself. Yes, Ed, I appreciate that. Ed has been with the system for quite a while. Does a lot of intraday trading, fairly quick intraday trades, and has had very good success doing that. Thanks for that, Ed. I appreciate that. Now, on the SPY Super System, it's color-coded, as I had mentioned, all right? So you've got 4 colors. You've got green. Green indicates strong bullishness. You've got blue. This indicates a bullish trend. It's not very strong bullish, but it's a bullish trend. Red indicates strong bearish, and a yellow indicates a bearish trend. Okay, so this is the color scheme that you're going to see on the charts themselves. And the chart is on Thinkorswim. It's going to be Thinkorswim. It also works on Ninja, but I use it on Thinkorswim. Now, I don't have to trade off of Thinkorswim. I can trade off of I trade off of Tradier. You can trade off of any trading platform that you want. Okay, so I'm going to show you a couple of slides. This was the SPY Super System a few weeks ago. I've been updated it since then. So I'm going to move along to the updated one, but these are the things on the chart that we're going to talk about, right? And this, by the way, is some scanners here. That we have multiple scanners to be looking for relative strength, relative weakness, potential swing longs. So this is the older chart that we've modified, and we also added this market. This is the current market momentum. We'll talk about that on the new methodology. This is also the same chart, but notice it doesn't have the other indicators on here. This is just for the current time frame that I'm going to show you. This is for folks who just want to trade off the 5-minute chart. In other words, intraday, fairly scalpy types trades. All right, so the updated SPY Super System chart that we've done here, again, I optimized it for clarity and precision. I added the 8 exponential moving average to provide improved signal confirmation and trade timing for both entries and exits, which we'll show you. So this is what the new layout looks like. I dropped you're not going to see the scanners out here, but they're there. I just enlarged it so you can see it more clearly. All right, so here is the SPY Super System. This, by the way, is still the market internals. This shows you what the overall market is doing on a 5-minute basis right now. And that means when I say the market, I'm talking about all of the New York Stock Exchange stocks. All right, are they bullish, trending up, like this case, or they could be trending down, or they could be very bullish or very bearish. This tells you what the current condition is of the overall market, all 6,000 stocks or so. Right now, on here we've got indicators. This is going to tell us what the institutions are doing. This is called a modified Laguerre. This is an oscillator. And oscillators, most oscillators measure divergence and they measure momentum. This measures momentum only. It's modified because we don't have divergence in here. Divergence, I don't think is very effective at all. So we went with straight momentum, and this is the actual indicator. But what we're looking for on a chart is we're looking for, this is the current time frame momentum. This tells us what the institutions are doing with this particular stock on this particular time frame. This happens to be 5 minutes. So what's going on a 5-minute basis, current time frame. This is multi-time frame momentum. This is 3 different time frames. This is the 5-minute on a 5-minute. This is the 5 minutes, the 15-minute, and the 45-minute on a 5-minute time frame. What I'm looking for, if I'm just trading intraday 5-minute charts, is I'm looking to just use the current time frame. Is it green bullish? Notice how it went bearish here. You see how the stock dropped down? Right there when it went bearish, that's the institution selling. Right, then multi-time frame. For a swing trade, you need to use multi-time frame and current time frame together. Both of these need to be either bullish, green or blue, or bearish, red or yellow. You wouldn't be taking a swing trade on a daily chart if one of these was bullish and one of these was bearish, because you don't have confirmation or enough information to tell you that the institutions are actually in it long. And then this is a long-term trend, and this gives you an overview of the trend for a long term. And it's useful if this will match your other indicators. It doesn't have to, but if it does, it gives you a little bit more confirmation of that direction. Right, now up here in the 5-minute, this is the 5-minute chart. Up here, there's a few different indicators that we use, or a few different moving averages that we use. This is the VWAP, the volume weighted average price. If you don't have that on your chart, on your 5-minute chart, you definitely should have this on your chart. Okay, very, very critical that you have the VWAP on your chart. Volume weighted average price. This is all the institutions use this. Every institution uses a VWAP when they're getting in and getting out of positions. The next one you see here is a 15 EMA. This is a 15 EMA of an EMA. It's a smooth EMA. That's another exponential moving average. And then I've recently added the 8 exponential moving average right here, the white line. So you've got 3 different lines. These are support resistance levels that we use to get into quick trades on a 5-minute chart. We use either the VWAP, the 15, or the 8. And the 8 and 15 can be used in conjunction with each other. If the stock breaks down below the 8, a lot of times it will support on the 15 before it breaks down. So when it breaks down to the 8 and the 15, that would be where you could take it short. Okay, and the VWAP as well. If it breaks below the VWAP, that's an entry for a short. Breaks above the VWAP, that's an entry for a long. As long as your current time frame momentum is indicating that institutions are long if you're going to go long and short if you're going to go short. Right, so that is what makes up the SPY super system. It's just color codes to tell you if the institutions are in there or not. It's calculating lots of information, a lot of data to come up with this information, but it makes it easy to see. Right, you can see here that they were buying pretty much here on this 5-minute on the SPY. All right, now just I want to cover quickly a couple of trades we took using these charts, just so you can see how they're in action before I get into a little bit more detail. This was a trade we took on NVIDIA back in 1024, a long time ago. But what I want you to see here is what we're looking at here on a 5-minute chart is this is what we're interested in. What are the institutions doing on a 5-minute basis? Okay, so it's this price is above the VWAP, which is bullish. The 8's above the 15, which is bullish, and then it slides down here. But you notice how it touches the VWAP and then bounces. Now look what the institutions are doing right now. They're selling. They were buying here. They're selling, selling. Then they switch to buying as it goes from red to blue. This is the institutions coming back in. What's happening at the same time? The price is bouncing off the VWAP and going through the 8 and with a moving up here. And one of the things that we have on the SPY super system is these arrows. These are called pop symbols, or pop out of the box symbols. This tells me that compression is breaking to the upside, and on the blue ones, compression to the downside. This is another indication this is a place to take the trade right there. This is where you would take the trade. It goes from bearish to bullish. It breaks through the VWAP and the 8, the 15. You take it right there. You ride it up. As soon as it starts to lose momentum, you take it off. See how it went back to yellow here? That is your trade for the NVIDIA. Take it long here, get out right here. Buying calls on that thing is very nice. And again, this is a 5-minute chart, right? So this is just an intraday trade. We also do a lot of swing trades, right? And I'll show you some of those. This was a trade in the SPY short, okay? See how it's moving sideways. Here's the 8 right here, the white line, and the 15s of the red line, and the VWAP is the pink line. Here's where the stock breaks below the VWAP and the 8 exponential moving average right there. Okay, it breaks below it right there. See what's happening here on the current time frame momentum? It's going from buying, which is green, to selling, which is yellow. This is where the institutions just started selling it. So you take it right there. This is the entry we took. And then you ride this thing down. As long as it stays below the 8, because that's basically your closest resistance, is you just ride this thing down and stay in as long as you want. Now, when it starts to pop around like this, you could get out. But notice they're still selling it off. You can see the amount of red on here. The institutions are selling it. I mean, there's no question about it. Okay, this is another trade in the SPY. This was a long trade in the SPY. You can see it goes from selling yellow to blue, right, for buying. Pops out of the box right here. You take it right here, and it goes up, right? Same thing. And this was a Tesla trade, an early morning Tesla trade. Pops above the VWAP, goes to buying right here. Take it right here as it stays above the VWAP. As long as it stays above the volume weighted average price, you stay in. Starts to flatten out right here. Take it off right here. Notice it goes back to yellow here. They're coming in to sell. You're up. You take your money. Okay. And this was a swing trade we took not too long ago. This was in NVIDIA. Notice that this was a swing trade. So we need the current time frame and the multi-time frame to be aligned. They're both green. Everything's green. And the institutions are obviously buying like crazy. We've got the trend moving up, but I'm not chasing it here. I'm waiting for it to come back down. And you see how it comes back down to the green line, which is a 15 EMA. And this pink line, by the way, is a VWAP. You do not use this on the daily. I'm going to have this thing removed from the daily chart. But it comes down to the 15 and bounces off here. This is what's called a PBO, in my opinion. Or in the room, we call it PBO, a pullback opportunity. A chance to get into a trade after it pulls back and hits support. This is where we take the trade right here. Notice this green candle as it bounces off the 15. Institutions are buying it. We picked our spot. In other words, it was bullish here, but we didn't want to chase it. We wanted it to come back. Remember I said, buy at support, sell at resistance, be patient. Here's where you're patient. You take the trade here, and we ride it up here, and we get out right here on this little spike. That's where we get out, and it's still bullish. Okay. This was a trade in SMR that we did right after earnings. Here's the earnings. Went from selling on the earnings day to buying the next day. We take it right there on this bounce. We get in at 513, out at 515, 56% profit. If you invested $2,000 in this in options, you would have made $1,170 on this. I use $2,000 as my baseline for how much to put into each trade, just so when I do my specs at the end of every month and every year, I've got something I'm using a consistent number. Doesn't have to be that, obviously. You can trade whatever you want, but I just use that so I can judge month to month. Okay. Let me turn off my news feed here. Just hold on a second. Okay. And this was Wendy's. This was another short one. Again, daily chart goes short right here as it goes from blue to red. We take it here. We wrote the same day. Boom, in and down. Notice the selling right here, selling across the board. Okay. This is just something I threw in here, just a little humor. This is a person who's trading with emotion, trading, maybe doing a FOMO trade, fear of missing out, jumping into a trade after it's already pulled up a lot and now it turned around and heads back. Now they're freaking out, or they just looked at their P&L on a trade and it's red. Now they don't know what to do. They don't have a methodology. They don't have a system. They don't know if the institutions are in the trade or not. This is what a normal average retail trader feels like when they're trading, right? We don't want to feel like that. This is what we want to feel like. We want to feel like we have control over what's going on. We feel confident in the trades that we're taking. We know that over time the trade's going to work out. Our win rate in the room is between 85 and 90%, month after month after month, year after year after year. And so we have great confidence in the trades that we take, even when we have losing trades, and we do. Everybody has losing trades. Okay, process precedes results. I'm going to talk about the criteria that we use to find trades. But what I'm going to point out here, it's very important to understand what the process of buying high probability trades is, and memorizing that or internalizing that, because that's what you're going to do. That is the process. Learning how to take the best trades. If you're focusing on your P&L without having a solid process to follow, it's going to end in failure. You've got to be having a good methodology and strategies that are defined. High probability criteria for trades, for stocks that you enter, and you use those and learn those and stick to those, right? Because you can take a bad trade and it can go good, can go profitable, and you can take a good trade and it'll go against you. The P&L is not telling you whether it was a good trade or not. Okay, this is the high probability trade setup funnel that we have, that I use. This is a checklist we go through. Is the daily chart bullish if I'm going long? Is it bearish if I'm going short? For swing trades, this is important. The daily chart must be bullish if I'm going long, must be bearish if I'm going short on a swing trade. On a 5-minute trade, it's not as critical because I'm going to be in and out fairly quickly. Then once I get into a swing trade off the daily, then I try to use the 5-minute to try to find my best entry off of like the support level, like a VWAP. A trade with a trend, both stock and market. If there is a trend, if the stock's bullish, the market's bullish, obviously you want to trade it bullish. Then the SPY super system. This is the deal breaker. The SPY super system must align. If you're going long, the SPY super system has to tell you that the institutions are in the trade bullish. If you're going short, it has to tell you that they're in the trade bearish. Very important, right? Without that, the trade is not going. I'm not going to take it. Now, if that works out, then I'm going to look for the best. If maybe I got 5 trades here that look good, I'm going to look for the ones with good relative strength or relative weakness, and focus on those. And then I'm going to identify a support or resistance level and try to get in right at that support or resistance level. If I want a 5-minute chart, I'm looking for a bounce for a long off the VWAP, the 15, or the 8 exponential moving average, right? Or a break through it as it goes through there. I want to buy very close to one of those levels, the VWAP, the 15, or the 8 exponential moving average. And that is the high probability trade setup funnel. This is what we look for. This is where the high probability trade setup come from. Like I said, this is not the very complicated, but it's important to follow these things. It's very easy to get sidetracked when the trading is going on during the day and read about something or just decide you want to get into a trade and you ignore some of the criteria that you need. Okay, inside the room and on the alert service, these are the kind of trades that we take. We take straight calls and puts. Obviously, we had a straight puts on Roblex last night. I do straddles and strangles. This is a non-directional trade that you're just looking for a big move up or a big move down. Don't care which direction, as long as it makes a big move. It's called a straddle and a strangles, either one of those. We use debit spreads using weekly options expiration. This is a way to take a trade long or short, limiting your cost because you're doing a debit spread. You're buying, for example, a call and selling a call at a higher strike price to reduce the cost of that trade. And I usually weekly options expiration. It's going to expire this week for any trade that I take like that. We do time spreads over earnings. I just did one tonight on CCL. They have earnings tomorrow. This is a non-directional trade. This is just looking for CCL to move inside of its expected range tomorrow. I don't care which way it goes. I just don't want it to move more than what the market makers are expecting. So if the market makers are expecting a 10% move, I just want it to stay under 10%, either up or down. Because what happens is with the earnings, the market makers jack up the price on the premiums, so the puts and the calls. They jack them up to cover themselves because they don't know which way the stock's going to move and they don't know how far it's going to move. So they do this by increasing the premiums on the puts and calls by using volatility. They add volatility. Once the earnings come out and they know where it's going and they know about how far it's going, the volatility comes out of the trade, and the time spreads are a calendar spread that is the point of it is to capture that volatility crush when the earnings come out, and that's what we're trying to do on CCL tomorrow morning. I have a weekly ATM strategy that I have on right now on KSS and Coles, and it sells puts every week against a stock that's neutral to bullish. We sell puts every week to capture premium, and we take a longer term debt, longer dated long put way out in time, like 6 or 8 weeks out in time, to protect ourselves in case the stock turns against us. Very, very easy strategy to use. Doesn't take much management. It's very forgiving. Really an excellent strategy as long as the stock you pick meets the criteria. And then we do credit spreads to capture premium over a few weeks. And then we do what's called the SPY Super System methodology trades. This is where we take trades in the room off of a 5-minute candlesticks based on the indicators I was showing you earlier. And we do this for the SPY, the Qs, the IWM. You can use it for futures, or you can use it for any stocks, right? This will work on any stocks that it uses. They'll use the SPY Super System criteria on the Thinkorswim platform that I showed you. That's what we do for this. These are very quick trades, and I can't post these in the room because they're too fast. But I do teach the methodology. I have a video on it, and a lot of people with Ed that was talking about how good it has been successful uses this. This is what he uses all the time. All right, the alert service. It's designed for day trades and short-term swing trades. This is not an investment letter. It's designed for traders who can't watch the market all day. It puts out real-time alerts on highest probability trade setups, which are stocks that the institutions are in, and the market internals are also in agreement. And then we do some technical analysis. So that's what the alert service is. All right, this is my equity curve for this year, I guess. Yeah, for this year. This is based on trades we took in the room at $2,000 a trade. These are not trades that I took that I didn't post. This is just posted trades in the room. All right, now I'm going to talk a little bit about Heikin-Ashi candles. Is there anybody here that knows about Heikin-Ashi candles and uses them a lot? Or is there anybody here that has never even heard of Heikin-Ashi candles? Hey, Sayre, you, okay. All right, use them a lot. And they're very, very effective. But you know it from my room. Okay, thank you very much. Heikin-Ashi candles are a different construction of price movement. I mean, that candlestick is nothing but price movement, right? So we're going to talk about that right now. These are Heikin-Ashi candles. It says it's on the British pound, Japanese yen. Doesn't care. It doesn't matter what this is. This works on any stock. This could be gold. This could be Tesla. This could be Microsoft. This could be pork bellies. It doesn't make any difference. All right. Rudy, on the posted trades in the room, the same as the alerts that are sent out. We take trades in the room that I don't alert on, right? And there's a reason for that. If I take a trade that's very quick, even though I post it, in other words, I expect to be in and out inside of a half an hour or something like that, maybe 45 minutes, I'm not going to alert on it because it's not going to give the alert members enough time. But anything that's going to be like most of the day or overnight, anything overnight, time spreads like the time spread I'm doing in CCL, things like that, those would be sent out an alert unless it's too late in the day. I don't send out alerts after about 3:35, 3:40 because it's not going to give the alert members time enough to get them. So the alert service doesn't have as many trades each month, but the win rate of the alert service is basically exactly the same as it is in the room. And you're just not going to take as many because I can't alert on every trade if it's going to be too fast. And some of the trades we take sometimes are very speculative, and I'm trying to keep the alert service to only get the very best trades, right? That we send out. Okay. All right. So these are Heikin-Ashi candles. A couple of main things you're going to remember. You want to remember. Bearish Heikin-Ashi candles have flat tops. See the flat top right there? Flat top, flat top, flat top, flat top, flat top. Maybe remember these are made up of 2 candles at a time. Flat top, flat top, flat top, flat top. Right? See, notice this interesting thing about Heikin-Ashi candles. You see how the beginning of this candle starts in the middle of the previous candle. Every single candle of Heikin-Ashi candle starts in the middle of the previous candle because of the way these things are calculated. Right? So this is a bearish Heikin-Ashi trend right here. Flat top candles like this are very bearish, Heikin-Achi bearish candles, right? And they come down and they start to get smaller, and they're still flat tops. Bullish Heikin-Achi candles have flat bottoms. Flat bottom, flat bottom, flat bottom, flat bottom. Notice the flat bottoms. This is a bullish trend. This is a bearish trend, okay? What we're looking for in our trading, how do I send alerts? By text, code, or through Discord? A couple of ways, Matt. I send them, the alerts go out by SMS alerts to your phone, but they're also posted in the Discord room. Okay, that is we have a couple of professional traders in the Discord room that post these trades, as well as posting charts of their own and some you know, they put out information on sectors and economic information, etc. Yeah, that's how they're done. Okay, so what we're looking for, I mean, Heikin-Achi candles are going to help identify trends. You can see them much more smoothly. You're not going to get as much noise in the candlesticks as you do with regular candlesticks. But the key way I use Heikin-Achi candles is to find reversals back into a trend, right? Looking for what's called a Heikin-Achi reversal candle. We're going to identify here as a Heikin-Achi reversal candle. So here's a bearish trend. Now, let's assume we're looking for this stock to come down to a support and then bounce, and we want to confirm that that bounce is going to continue. In other words, we're looking for confirmation of a return into the original bullish trend, right? So here's the bearish trend. We're getting bearish Heikin-Achi candles. What we're looking for is a bullish Heikin-Achi candle that reverses that direction. Now here's one here, right? Flat bottom. We get a couple of dojis, we get a flat bottom, right? So this is technically a Heikin-Achi reversal candle, a bullish Heikin-Achi reversal candle right there. Would I take this? I wouldn't. And the reason I wouldn't is because when you get your Heikin-Achi reversal candle, you want it to be about as big as the candles that created the original trend, right? It's much more difficult to break a trend to the upside when we're breaking it with little candles. So I wouldn't take this. Now, it would have worked. You could have got in and made 3 or 4 candles out of this. But this is what I'm looking for here. See how this big trend down, then it moves up, comes back down. There's another bearish Heikin-Achi reversal candle here and here. Here is my Heikin-Achi reversal candle to the bullish side, right there. Flat bottom, big green candle to the upside. That's a Heikin-Achi reversal going back in the original trend. This is where I would take it, right there. Now, an interesting thing about Heikin-Achi candles, let's say these are 5-minute candles. If you're looking at a regular candle, you really don't want to make a determination as to whether that candle is going to work or not until after the candle closes. You want to, because it could reverse back again. Once you're about halfway into the cycle, if this is a 5-minute candle, once you're about 2.5 to 3 minutes into that 5-minute cycle, this Heikin-Achi candle is 99% likely to maintain that flat bottom, right? So you don't have to wait for the candle to complete as a Heikin-Achi candle to get into the trade. You can into the trade during that Heikin-Achi candle. And here's your Heikin-Achi reversal trend. Confirms right here, because the Heikin-Achi candle, because it's made up of 2, the Heikin-Achi candle itself is a confirmation of the reversal into the trend, right? It's really important. So notice how this worked. Get in here, boom, 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 keeps going up. One right after another. You get a couple of wicks and tails, but still green. This is where you would get out. Starting to lose some momentum. You lost momentum here. You're out of the trade. That's the trend you took. And see how nice and smooth it looks on there. That is your Heikin-Achi reversal. These are what the Heikin-Achi candles look like. And you can put them on any kind of platform. You just change from standard candles to candlesticks to Heikin-Achi candles. I'll show you in the SPY Super System in just a bit. Okay. So here's what you take from that, what we just talked about. Bullish Heikin-Achi candles have flat bottoms. Bearish Heikin-Achi candles have flat tops. Bullish Heikin-Achi candles are identified by flat top Heikin-Achi candles, followed by flat bottom Heikin-Achi candles. They don't have to be right together. There can be some doji candles in between. And bearish Heikin-Achi reversals are identified by flat bottom candles, followed by flat top candles. All right, that is how you use Heikin-Achi candles to watch the trend, and also how to find Heikin-Achi reversals, because those are critical. This is what we just talked about right here. Here it is. This is a little bit different setup on it. But let's assume that you were in the stock was you wanted to take it. It was long for the day. This is the VWAP, for example, right here. This blue line. You want to get into this trade as a long trade. but you want to confirm that it's going to go up. So it comes down, you see how it's Heikin-Ashi candlesticks, bearish, bearish, bearish. You get a Heikin-Ashi reversal here, you're still below the VWAP. The pink line, the blue line's the blue dotted line is your VWAP, let's say. So the stock comes down and it bounces here with a Heikin-Ashi reversal, another Heikin-Ashi reversal. This Heikin-Ashi reversal went through the VWAP. That's where you would take the trade right there. That's right there where you would take the trade. You get another Heikin-Ashi candle, another Heikin-Ashi candle, then you get a red candle here, right? A Heikin-Ashi reversal, but it does not break below the VWAP. Then you go right back into Heikin-Ashi candles again. So this is the trend you would be riding, all right? See how smooth that is. Flat bottom candle after flat bottom candle. Then you're starting to get these wicks and tails. You get out right here. And that's the profit that you made on that. That's a very big move right there in that candle. Do I pay any importance on Heikin-Ashi continuations? Yeah, I do. I mean, Heikin-Ashi continuations, and this would be a Heikin-Ashi continuation right here, okay? Because you get flat bottoms and flat bottoms, then you go to a flat top, right? So that's basically a Heikin-Ashi reverse, a bearish Heikin-Ashi candle, but it's definitely not a reversal because it's so small. And then you go to another Heikin-Ashi flat bottom here. That's a Heikin-Ashi continuation candle. Anything that's a Heikin-Ashi candle gets created inside a trend after you've got a candle that is not a bullish Heikin-Ashi candle, is a Heikin-Ashi continuation. These are all Heikin-Ashi continuations. And yes, they tell you that you're still in the trend. What do I mean that the Heikin-Ashi are made up of two candles? I'll tell you in just a second. I'll tell you how they do that. But there's two regular candles. The way that it's calculated, and I'll show you how they do that to come up with a Heikin-Ashi candle. Could you consider that an entry? Yes, you could consider it an entry there, but what you'd want to like if you took an entry here, you'd want to kind of think about how far am I away from my support level. In other words, if I get in here and it reverses on me, I get tiny losses. If I get in here, I've got to determine how far am I away from the level that I would want to exit on if it goes against me. How much downside risk do I have? You wouldn't want to be taking it way up here, all right? You're too far away. Too far away, you're chasing it. All right, so what's the advantage of these Heikin-Ashi candles? First, they smooth out the price action, reducing noise, okay? Makes identifying trends much easier. Improves identifying confirmation of trends and trend reversals. This is the big one. And it helps identify potential exits when the candle bodies shrink on reversal occurs. What are the dotted lines, Maz? They're not. The way I use this is I'm just saying if these are probably Bollinger Bands, but what I'm trying to show you is if you have a chart and you've got a support level right here that you're going to take it. This happened to be I mean, if you were trading off a Bollinger Band, you could use this, but I'm assuming that like this is the VWAP. This is just an example. That is not. I'm not telling you that these are any particular indicators. Okay. Now a couple things here. I think I have a calculation of this somewhere. You know the way these Heikin-Ashi candles. Somebody's asking about this. The way the Heikin-Ashi candles, what they do, you have high, low, open, and close on two different candles, and they take the first one and then they take the second one, and they take those high, low, open, and close information, and they merge them together to create one candle. That's why there's two candles that make one. That's why they always open in the middle of the previous candle. Now, I wanted to show a couple charts here, and I'm going to show a couple of live charts in a minute as well. But this is an Uber chart. This is way back in 23. But what I'm showing here, this is, if we look at May 1st, this is a standard. These are standard candles. These are not Heikin-Ashi candles. And you see right here in May 1st, you get this move up, then a gap up, then a gap up, and a nice continuation move here. But tough to trade off of regular candlesticks because you're getting big gaps. So let's go to a Heikin-Ashi candle on the same thing on Uber, looking at May 1st, right? So here's May 1st, right? So here is your Heikin-Ashi bearish candles coming down. Here's a Heikin-Ashi reversal, bullish reversal right there. See how big that is relative to these? That is where you would enter the trade. Right there on May 1st, you would take this trade off that Heikin-Ashi candle with a nice flat bottom. And then look at how nice you move up here. It goes up, moves up, moves up. See, in the middle of it, in the middle of it, in the middle of it. And here's where you'd be getting out. That is your Heikin-Ashi reversals. Now, a couple things to notice here is on May 1st, on the regular candlesticks, you had a gap. See the gap? No gaps. No gaps on Heikin-Ashi candles because it's using 2 candles to create that 1 candle. So you don't see any gaps on Heikin-Ashi candles, but it's much easier to trade from something like this than it is something like this. All right, and it's much easier to stay in it as well. All right, so those are Heikin-Ashi candles. All right, I'm going to. This is, by the way, this chart is based on TC2000. This is a charting program that I use, which allows me to do charts and some additional scanning. And then I use this SPY super system to tell me whether the institutions are in the trade or not. But this is a TC2000. Okay, so I'm going to look at some of the live charts here, and let me look quick at a couple of scans for today, because I'm looking to try to find I'm going to switch to my TC2000 chart right here. And I'm going to pop a couple of trades in there. Okay, this is Kava. Okay, CAVA. All right, so this is a regular chart. If I switch over to Heikin-Ashi candles on here, which I'm going to do right there, there's a Heikin-Ashi candle today. This is today. This is right at the end of today's trading, right? So this is Kava. Here's a big downtrend in Kava. You see how these pink candles, how they are? Now, I'll explain to you that on my TC2000 chart, I color my candlesticks red and green and pink and blue. What the difference between a red candle and a pink candle is, a pink candle is a bearish candle, it's a red candle, but it has Bollinger Bands expanding, which means the stock is breaking out of compression. So it tells me that I've got some force to the downside, and blue tells me I have some force to the upside. All right, so here's Kava. There's a Heikin-Ashi candle right there. You see the flat bottom? It's actually a continuation. I had some Heikin-Ashi candles here, a long compression and a break above the 8 right there with Kava. That's a nice bullish trade for tomorrow. Now let me show you something on Kava. Let's look on Kava over here on a SPY super system. All right, so let me go to the daily chart. All right, so we go to a daily chart, and I got to put up Kava on here. All right, what do I see on Kava right here? Is it tradable? What's the current time frame and multi-time momentum telling me? Yes, it's going from selling to buying. Multi-time frame is buying. This tells me that I can buy Kava tomorrow. If the market is giving me some bullishness, you could take Kava as a long entry tomorrow. And if I switch this to Heikin-Ashi, and this is how you do it, you go from chart type, from candlestick to Heikin-Ashi. There's my Heikin-Ashi reversal candle right there, or Heikin-Ashi continuation candle right there on this chart. All right, so let me see if I can find a couple of others. Put this down for a minute. This is WSM, that's another one. You see the Heikin-Ashi reversal candle right here, continuation actually. And I'm just going through and see if I can find some decent ones. Market was pretty awful today, by the way. Let me just show you something. When we're here, let's talk about the market for a minute. Let's take a look at the SPY. Is this S&P 500 chart, right? This was a candlestick right there. It was Tuesday. Moved down, went down to the 50-day moving average, which is the red line, bounced off of it. This is yesterday, a horrible day. This was a brutally bad day for trading. Well, not for trading short. We took Roblex yesterday, but this was a nice, and look what we did today. We pretty much traded inside of that candle right here, bouncing off the 50-day again. So we don't really have any indication of which way the market's going to go. As I told them in the room today, if the market trades below the 50-day moving average and stays below there tomorrow, then you can go short. If it goes above these 2 lines right here, which is the 8 and 15, and closes above there, you can go long. Right now we're in the middle. We are in no man's land right here on these trades. All right, so I wanted to show you a couple more Heikin-Ashi candles. So basically what we do is we find Heikin-Ashi candles, then we look at the SPY super system to see if the institutions are indeed in that trade. All right. This TAK, that's a nice Heikin-Ashi candle. Let's switch to Heikin-Ashi. There it is. Fibonacci continuation on TAK. Another good one there in Dawn, pretty cheap stock, but a big Fibonacci reversal candle, very large. You notice that when you typically get a blue candle, you get multiple blue candles, and this is off of my TC2000 chart, right? But if I'm looking at Dawn, and I go ahead and look at that on my super system, all right? I just go and look at Dawn here. Is that good? Yes, it is. It's also, it's got blue and blue, telling me I can take that. So that's how I determine whether Fibonacci reversal candle on the daily chart is a tradable or not. Does it have the institutions in there? All right, and I'm sure there was a few shorts today, as a matter of fact. Let me pop that up again. Let me bring up the TC2000 one more time. Right, this PNW. Fibonacci, this continuation of the Fibonacci right there. VNet, Fibonacci reversal there. Another one here, Pepsi. Another one here. There was going to be a bunch of them today. This is Sarepta. This is a pretty good one. This is a pretty good one on Sarepta. So if I go over to the SPY Super System and I look at Sarepta, does Sarepta qualify? Can I short Sarepta tomorrow? Whoops. Can I short it? I cannot. See how the SPY Super System tells me that the current multi-time frame momentum across multi-time frames is still bullish on here. We don't have agreement on the multi-time frames that the institutions are selling us off, so I wouldn't take it. Okay, so that's how that works. Now you're looking for now. We'll take a look at now. Right, there's now. This is the daily chart, and now this is pretty ugly. You can see the Fibonacci reversal candle right here. This actually was a pretty good entry on it. Notice it went yellow here, and here it is today on regular candlesticks. That's Fibonacci, and if I look at TC2000 on now, there it is. Definitely bearish. So this was obviously it's got something there. I don't know if that's an earnings or a dividend, but this is a big downtrend. And what you'd want to be looking at on something like this is you want to be looking at your regular chart and determine how far is this thing away from support and resistance. But if I look at the bottom of this candlestick, you see the bottom right there? That's going to tell me that it's broke down below it today. I would want to see it below there to take it short tomorrow, right? But it definitely is qualified as a short on now. CTNT, that's another one. INSG is another one. So I can find a lot of these to be Fibonacci reversal candles. So that's what I look for. And then when I find them, then I look at my my SPY Super System to make sure that they qualify to be taken short. I mean, that's the whole key. If they're good shorts, do they have bearishness on the multi-time frame and current time frame momentum? In other words, are the institutions selling these? They certainly are. And the trend is also that way. So that's how you use those. Dividends, okay, good. PayPal looks like a good short. Yeah, I think I looked at PayPal. There's a lot of good shorts right now. But PayPal is actually putting in a doji candle today. On one of the things I do in the room is I do what's called high volumes, resistance and support levels. That's one right there. That's something that likely that level is likely one that the institutions will adhere to, and you see how they did today on that. So I wouldn't take it until it broke below there. Anyway, I'm not going to get into a lot more technical analysis on those. I just wanted to go over the Fibonacci candles so you can see how they work and how to use them in your trading. Okay, so those are some Fibonacci candles. So again, you can see how they smooth out the trend. They take the noise out of the trade. They let you find reversals into back up into an original bullish trend or an original bearish trend. And you can use them on 5 minutes as well to trade intraday trades. If you're looking for an intraday reversal off the VWAP, you can take a Fibonacci candle. And if you get a Fibonacci candle, you get confirmation that it's confirmed going back into that trend. Okay. Okay. Now I'm going to talk about the results we've had in the room, and I'm going to show you some of the results over the past couple of years. I'm not going to go through them all. There's a lot of them, but I want a couple of things I want to point out. In 2023, using $2,000 per trade in the room, the room produced 60,000, a little over 60,000 in profits. Okay, a little over 5,000 a month. In 2024, we did about 55,000, about 4,500 a month, a little lower. And the reason for this, because what's the market like? You get a trending market during the year, you get a lot higher profits. If you got a choppy market, you got to take fewer trades, and you got to take the profits quicker. So it comes down a little bit, but not much difference. In 2025, this is up through September, 47,765, 5,307 a month. That's better than what we did back in 2023. This is our best per month average so far since I've had the room open, right? But it's pretty consistent. It's pretty consistent. These are some trades, and I just kind of point these out. I guess I'm kind of proud of these, but this was back when the tariffs went on and tariffs came off in April. They put the tariffs on, and then they took the tariffs off because the bond market spiked. They couldn't keep them on. This is the trades we had on. We had 4 trades on in the room and on the alert service. We had all 4 of these on. They were all bearish. We had all bearish trades on. And AVGO, we get in for $75 a contract. We get out for $1.04, 39%. We get into Nike. We get in for $285 a contract. We closed it on for 216% profit. This one we got lucky on, I think, because we were in it short, and 2 days later they announced the tariffs. And the tariffs were going to be 39% on Vietnam. Vietnam is where Nike makes all its product. It crushed the stock. I mean, absolutely crushed it overnight. And as soon as it gapped down the next morning, we took it off. We didn't wait around. Sarepta, we get 78% profit and 25% profit at NNE. We had these 4 trades. That's the only trades we had on in the room and on the alert service, and all of them had great profits. And the SPY was down 10% in 2 days while we had these on. Right, so it's anecdotal, but I'm proud of these particular trades that we had on. This was June this past year. I was out on vacation for a couple of weeks, so we didn't have a lot of trades. 10 wins, 1 loss, 91% win rate. That's pretty high. 37.90 in profits. Here they are. These are the kind of profits you're going to see most of the time. 20, 23, 25. This is the range that most of our profits per trade are going to stay in. Please don't be expecting you read about these 300, 400, 500% winners. Listen, you can't trade like that consistently and be profitable, right? It just doesn't work. But you're going to read about it all the time, and you hear webinars about it with people standing in front of Lamborghinis about how much money they make. Please. Okay, so that was June. In July, these are the trades. We took a lot of trades in July. I guess I was rested up from my vacation and took a lot of trades. But see the percentages again. This is what I want you to see. And we do have some losers. You can see the losers here. 32%, 52%, 21%, 23%, 10%. These are the kind of profits you're going to see trade after trade after trade. We had Sarepta, which was good for 166%, but that's an outlier. This is mostly what you're going to see on every trade. July, 30 wins, 3 losses, 91% win rate. Again, really high. And this was really a big month. Again, this is an outlier. 16,000 in profits that 1 month is an awful lot. But we had a big month, and it's proud of it, of course. But this is not. Please don't get it to expect this kind of profitability on 2,000 per trade every month. It's not going to happen. August 20 and 4, 84% win rate, but almost 6,000. September, again, I pushed some of the trades in here so you can see them again. Here's the percentages to see how they stay the same. We take some losses, 4,700 in profits, 84%. This was January through September of this year. 155 wins, 28 losses, 85% win rate. 2,000 invested in each trade produced 47,765. Again, just as I showed you a minute ago, 5,307. Right? These are the profits. Remember what I said early on. The results we get are based on the fact that we're using the SPY super system to tell us whether the institutions are in the trade or not. All right, I'm not going to keep going. This is back to January 2024. Again, every month except for one, last year was profitable. I'll show you the losing month. Right, so here's the profits. See how they stay the same. 90% win rate in January, 92% win rate in February. This is very high. I can't consistently produce a 92% win rate. I can consistently produce an 85 to 90% win rate. I cannot produce a 92% win rate consistently. It's very, very, I don't think, it may be possible, but not for me. May, 88% win rate. June, 86% win rate. The alert trades actually had a high win rate in June. I had 75.90 in the room. The alerts had 83.16 because the alerts missed out on one of the losing trades. July, 85%. August, 89%. September, my only losing month last year, right? Eight wins, 5 losses, an embarrassing 62% win rate. And we lost 1,786. In August, we made 45.35. In September, we lost 1,786, 295 in the room. And in October, we jumped up to 7,400 in the room and 6,000 on the alert service. So we kind of swamped those losses, but I want you to understand there will be probably a losing month here and there. I think I've had maybe 2 in 4 years, but they do occur. I mean, they do occur, and you're trading with the market. Market is very dynamic and it's very unpredictable. November 14-2. So this is, we already kind of covered these. This is January through March through April. We covered these already of this year. I guess we didn't, but you can see 84, 89, 83, 81, 45,000, 7,800, 3,800, 3,100. That's the kind of profit just that you get. Okay, so that gives you kind of the profitability of what you're going to see in the trades that you take. Let me take a sip of water. Okay, so on the alert service, what you're going to get, this is what an alert looks like. You're going to get, this was the Nike one. This first section right here, that's what the first alert's going to look like. It's going to get the date. It's going to show you the ticker symbol, Nike. It's going to say to buy the April 11th 67 puts. Right? What's that telling you? Here's your strike price, 67. Here's your expiration date, April 11th. So you're buying the April 11th 67 puts, and this is what you should pay for it, $285. That's the whole alert. Now there'll be another alert to come out once they decide where we're going to take profits. So you see this alert with this added to it, sell order for $9. Then when they were sold for $9 on April 3rd, there's your whole alert. Now there could be additional alerts if I adjusted it from $9 to $8.50 or $9.50. You'd have another alert on that. Okay, that's what the alerts look like. How do we achieve these results? I think we know right now. We're tracking the institutions, right? How are the institutions trading? We're going to take those. We're going to watch when the market internals are bullish, and we're going to trade only the very best ones. And again, how does the super system identifies this? Triple screen, momentum, trend, also has money flow built in there as well. But this is the main thing that we're using right here is momentum without the divergence in there. Okay, momentum. A lot of people misunderstand momentum. They think if they see two or three green candles in a row that the stock has momentum, but that's not how momentum is measured. Momentum is measured by looking at the let's say 2 5-minute candles. How close was the close of this candle to the high of the candle? As the candles are produced, if the close of the candle is getting closer to the high of that candle, then that's momentum. That's how momentum is measured. It's the close of the candle is moving up closer and closer to the high. In other words, there's less and less selling as the stock gets closer to the high. Okay, so again, we're going to look at some more charts. Then we're going to wrap up this. I don't want to take too much of your time. I appreciate what you've all done here, how much time you spent here today. I appreciate that. I'll be willing to answer any questions you might have. But this was the SPY. We looked at this one before. Here is your SPY super system. Market internals, VWAP, 8 exponential, 15 exponential. This is what we use on our 5-minute trading. On the daily chart, we switch over to, we do use the 8 and the 15, but we also switch over to the 50-day moving average, the 100-day moving average, the 200-day moving average, all of those moving averages. Now, here is your key indicators. Current time frame momentum, multi-time frame momentum, long-term trend. All right, this is what we use. This is how we trade intraday, and on swing trades, we use multi-time frame and current time frame together along with trend. Okay, and again, this is the other template. If you get the SPY super system, you'll get this template and you'll get this template. This is just for folks who want to be able to just trade off the 5-minute. They don't really care about these other indicators because they're just trading off the 5-minute chart. So we have an indicator, we have a format like this, basically a template for you like this. You get them both, you can flip them back and forth, but just so you know, if you're just going to do that, it kind of isolates it a little bit better. All right, so here's the SPY super system that trade that we took. This is a SPY super system. I can actually reversal candle on the SPY. Right, this is where I get in. Right, you see, notice it went from buying to selling on the 5-minute chart right there. This is where I get in. You see the weekend at tail, you see the flat top, I can actually reversal. I take it here and I use this red line, which is a 15 EMA, as my stop. And I just ride this thing down, ride this thing down, ride this thing down. I don't even know how far it went. Notice as the selling just continued and continued and got even more pronounced. Right across the board, they're selling the Qs. This was the Qs. So we took a big trade in that one right there. These don't happen all the time. A lot of times you get a lot more chop and you're in and out of them just in several candles. Again, the SPY super system, this is when I talk about the SPY super system, what I'm talking about is the methodology of trading off of the SPY super system on a 5-minute chart. And this is for like SPYs, Qs, IWM. And these are the trades that I took because I cannot post these. I can't alert on these. These are very quick. But these are the results I had from last year, 2024, when I first started this. And you can see how many trades I took in August. 56 wins, 6 losses, 2 scratches, produced good profits. I have not had a losing trade with this. But the important thing to remember about these is you're only going to be in one trade at a time, and they're going to be very quick. So this is for traders who like to make intraday trades, not necessarily hyper scalping, but fairly quick trades. They're going to last 1, 2, 3, up to about 10 candles, right? As long as the trend continues, right? And this was November last year, December last year. It's very strong results. And this was the last quarter last year. This was the SPY super system trades methodology, just trading off the 5-minute chart. Again, 840, 831 in October. Now this is the room trades. If you're in the room, you would have. This is about what you would have made if you took all the trades. This I can't post. This I do post. These totals are not included in each other. These are completely separate results, separate methodologies, and separate results of profits. They're not included, right? So that was the room. Is November 9,300, 7,300 here, and December 10,500 here, and 4,500 down here. So that was the last quarter of last year with the SPY super system. When I say SPY super system methodology, I'm talking about trading the SPY super system off a 5-minute chart only. Okay, the room trades can be mostly 5-minute charts or mostly swing trades. There can be a lot more swing trades using the daily charts. Okay, so here's the SPY super system right here. This was a big one, $220 profit per contract. See how we get in right here? Again, see the VWAP right there? Notice how it broke above the VWAP, and you see that the institutions went from selling to buying right here, current time frame momentum. That's what we look for on these quick trades. It's another quick one there. And again, I think you can kind of see it here. Again, this was it off the new format. Just the simple current time frame momentum holding on there. Get in here, get out here. Right? Same thing here with the new layout. Just to kind of go over the layouts. This was a 11/15/24. This was $120 profit on the IWM, so Russell 2000. See that breakdown pop out of the box? The stock's breaking below the VWAP with a compression break. Take it right there. We have the institutions selling it. They absolutely are. We take it right down here and write it down. This was before I put the actual gear indicator on there. This is the current time for momentum right there. Okay, and here's some high probability trades. These are trades that we take in the room that are going to be, these would be trades that we posted, right? This was for ALGN right here, a line. This was meant to be a swing trade, but we get in right here. You see how it went from selling, from buying to selling, green to yellow, and we got a pop out of the box symbol. This is where I took the trade right here. And it was going to be a swing trade. I took some puts, but within an hour, we were up 51% on those puts in the line. So we took the trade off. I didn't hold it overnight. You could have, but I didn't. If you can't hold it overnight because you're under PD2 rules, PDT rules, any trades that you get that come to the alert service are meant to be used on a daily chart, which means you can keep them overnight if you need to. Okay, this was urgent. This was when we took here. Again, institutions buying. We bought it right here as the stock compressed, popped up. We took it again. The VWAP should not be here. That pink line going to go away eventually. NVIDIA, I showed you this one already. This was the pullback opportunity and a bounce right there. This was SMR. We saw that one as well. Here's Nike. Here's the one I told you we made 216% on. Here's what we took it. Notice that the institutions are selling the heck out of this thing, right? Selling across the board. So we take it here. Actually, we actually had a profit that day. I didn't take it, but we could have. And then we stayed in, and it kind of moved sideways, but it's still below the, right now, below the 15 exponential moving average. And there's the tariff announcement, and there's where it went, and that's when we get out, right there. Right there where it opened in the morning, we were out of that thing for 216%. Sarepta, same thing. Sarepta, we rode this down as well. Nice profits in this. Are they selling this? Anybody can look at this chart and see that the institutions are selling it, right? You don't have to really do much delving into, don't have to go into much detail to see that. This was HIMS. This was the one we took. All green, took it right here, rode it up, 25% profit. I made 269% on a run that I left on, but I didn't post that, and I didn't include that in any totals, but I got lucky on it. Okay, so that covers the charts, covers the SPY super system, it covers the alert service, it also covers Fibonacci candles. I tried to cram this in, as quick as I could. I have, limited amount of time to try to do this, but I kind of want to get you a flavor for what we teach in the room, because I'm in the room every day talking, except for taking an hour for lunch. I talk all day long, talking to traders, going over the trades, going over the charts. They give me charts that they want me to look at. We look at those, we analyze them, we do technical analysis on them. We look at the SPY super system. All of that is done in the room. So there's a lot of education going on. I try to be very focused on trying to help traders become consistently profitable, because listen, trading is a tough business. Believe me, if anybody tells you it isn't, they're lying to you. Trading is tough. If you got the tools, and you got the expertise, and you got the proper strategies, you're going to be head and shoulders above other retail traders, where we take their money from. Again, you're going into a battle here with these other retail traders. It's a war you're fighting with other traders. I mean, that's what it is. And if you've got the SPY super system to tell you if institutions are in there, you've got good technology like the SPY super system, if you've got good technical analysis, good strategies, and I have a lot of strategies, and I have videos on them all that looking for very specific criteria set up, you're going to be head and shoulders above the other retail traders. You're going into battle with them with basically jet fighters and big bombs, and they're coming at you with pea shooters and pop guns. It's just not the same thing. You'll crush them. Right. So there's all the strategies that we use. I've talked about that. I'm not going to go ahead and repeat them all. And these are the offers from Rightline. These are really good. This is on I got two different offers. One for the room and text alerts, and one for the SPY super system, which is the software. Right. This is the options room and text alert service. And by the way, those in the chat box, Rory, I believe, has posted all of those links. Yeah, he's got links in there for the SPY super system and the text alert service. So this is the options room and text alert service. Again, they're 50% off on the annual membership, 50% plus 500 off on the lifetime memberships. And these are the codes you would use for that. Save 50%, save 50 plus 500. These are the coupon codes. So you can get a 2-week trial if you want. 2 weeks is not very long, especially in this crappy market, but 2 weeks will give you the trade alerts. They'll give you the trading room, and you get a chance to look at the videos that I did. About 32 of them now on the different strategies we use, how we use the indicators, all of the strategies, time spreads, weekly ATMs, straddles, strangles, all of that. After the trial is up, if you don't cancel, you can cancel anytime, of course. It rolls over to $396 a quarter after that, right? Or you can do an annual on the room and text alert service at 50% off, $11.95 for a year of the text alerts and the trading room, right? And the options masterclass, they call it, but basically it's my videos. training videos on how to trade this stuff. And then you also get in the private Discord chat room. We have 2 other professional traders where you can be in the Discord room, or you can do a one-time payment. This is a one-time for the alert service in the room and forever. So you never have to renew. Options: you get the training room, you get the alert service, you get the master classes of the training, basically, and the Discord room. All of that for $24.96, $11.95. These are really good deals for the rooms and the alert services. If you want to just try it out, this is what you would do, but you're not going to get these kind of deals. Okay, and then we have the holiday special on the SPY Super System and the scanners. This is a software, right? This is a software. Software is an annual membership of $9.98, which gives you the SPY Super System software that we talked about, and you'll get all the updates to it. Any updates we make, you get the scanners. You get a month in the trading room, so you can give you a month to try out the trading room, see what you think about it. You get the market scanners. You get my again the training videos, and they'll get an installation of what's called white glove. But Rightline will take over your machine, and if you don't have Thinkorswim on there, you can download Thinkorswim for free. They'll take over and they'll put the SPY Super System. It'll look exactly like mine. They'll put it right on your TOS platform, and then you'll have it. You can trade from that. You really don't, if you do that and you look at the videos on how to make the difference, use the different strategies and how to trade the indicators, you'll have about the same thing that anybody's got. You just won't have the experience. All right, so that's the annual membership right there for the SPY Super System and the scanners. And this is the one time, 50% right here, coupon code 50% for the annual, 50% for save 500 on the lifetime SPY Super System software, lifetime access to the trading room. All right, lifetime access to so you get the trading room for forever when you do this, which is as opposed to 1 month. Over here, you get it forever. You get the scanners, of course, that come with it. You also get the master classes or the training videos, and plus you get it installed on your machine for free by Rightline. And so you don't have to worry about any technical issues trying to get the thing on there. All right, so those are our offers. One thing I'll point out here is I did an analysis on return on subscription investment, not the trading investment, what your return has been on the subscription. So basically, I put $1,600 as the max. That's based on the quarterly. Average trade size of $2,000 per trade. Assume you take all trades. The historical results every year has been 40 times your ROI, 40 times ROI over what you've actually paid for the room access and the alert access, right? 40 times the subscription cost, not over 4 years, but every year. 40 first year, 40 second year, 40 third year. This subscription has consistently paid for itself many times over, and it's got a higher ROI, return on investment, simple math, and proven results. And of course, we always have the disclaimer: past performance is not indicative of future results. Trading involves risk, and individual results may vary. Absolutely, we do have losing trades, so just be aware of that. So those are your options. You can go into the chat here, and you can hit one of the links down there. You can call Rory at 786-732-4656. He'll talk to you about these. And again, look forward to seeing some folks in the room on the alert service. And if you're in there, just shout at me out, because I answer every question I get in there every single day. So I do spend a lot of time on that. All right, everybody. So thanks so much for coming today. I appreciate it. I hope you have a great weekend. If I don't speak to you between now and Christmas, I hope you have a great holiday and a great Christmas and a great New Year and year coming up. And then we're going to have a fairly slow trading between now and Christmas and New Year's before things start to pick up again. So we use this a good time to go back and analyze our results, maybe tweak our trading a little bit, use it to improve ourselves as far as trading is concerned. All right, everybody, have a great evening, and thank you so much for being here. I appreciate that, and look forward to seeing you in the room.
Thank you, David, for an excellent, insightful presentation on trading options with laser accuracy with the SPY Super System. David has also put together a very generous holiday special offer, and his offer is posted in the chat box, so be sure to check it out. Some pretty